EMA. See a lot of these structural technical levels actually holding up a lot better than maybe a daily chart or even a 30-minute chart, things of that nature. This has only happened 6 times in the last 33 years. We actually did see this in the early 90s, past the the 1987 Black Monday event. We also saw this as we got out of 9/11 and the internet bust. We saw it in 2010 after the housing crisis. We saw it in 2016 with the foreign exchange fiasco that we saw in Switzerland and Greece, as well as in China. So this is actually a very big development for those long-term traders that are out there. I'm not saying it's going to be a guarantee, but we rarely see this cross actually being violated again in these economic cycles. And I think that's always something that we have to keep perspective in, because sometimes it feels like the world's going to heck, you know, and at the end of the day, it does, we can look back at a chart, and all of these events that we've seen over time have been able to, we've been able to digest them and continue to move higher in the long-term trend. And I just wanted to highlight that one today.
I completely agree. The market, the VIX, a pretty good reflection of how it may be a little too early to pull that Chicken Little costume out of the closet and start running around the cul-de-sac and screaming about how the sky is falling, because according to markets right now and the price activity we're seeing, it's not. Appreciate you joining us here. Kevin Green, the chart master here, and thanks to you for joining us this morning to talk futures here on the Schwab Network. Stick around, lots to come. We've got Oliver Rennick, we've got Morning Trade Live is headed your way next.
Good morning. October 17th. We're going to be streaming the stock market today. Sub up, like up, comment down. Happy Money sticks around. Follow us on Twitter at HappyMoneyYT. And you can join us on Discord. Link for those are in the description. You guys had a good evening. Good morning so far. We've got about 10 minutes to open. October 17th. We'll be watching SPY, GME, AMC, Top Wars. Got some pre-market action. Whatever you guys want to watch, we'll do it. Be trading some options on SPY most likely today, and whatever else comes our way. Yeah, SPY a little gap down here. We did have some data this morning with retail sales at 8:30, which, yeah, that was the reason for this. Retail sales and retail sales minus autos. So was that 9:15? We had capacity utilization. I don't think that does anything to the market. Nope. 10:30, Fed Bowman speaks, and 10 o'clock we have business inventories, home builder confidence index, and then at 10:30 we also have Kashkari speaking. 10:45 we have Barkin. So potentially some volatility in the first couple hours here with Fed speakers. I'll be keeping that in mind for buy options. We'll see if we make a break for it on this handle breakout, or if we did just triple top there. Had this this cup here that we formed. They will be opening up basically at the bottom of the handle. So potentially retest of the high and maybe a bust through it, or maybe that triple top does play out and we come back down here and fill some gaps. Looking at the daily though, it does look like we're probably still in an uptrend, even with this bit of volatility in here and some engulfing candles. Just looks like some consolidation first. We're above the 20 moving average, and we're still in this channel with a gap above us, so I think we probably still hit the top of this channel. As far as Bollinger Bands, we haven't hit the top of it. We have crossed over the middle. So if you see when that's happened prior, usually we hit the top of the band once we cross over the middle. That said, it is coming down, so might meet right at that gap fill. And near the top of the Bollinger on daily, I'll probably be looking at more February buy puts. Do swing trade, but we'll see. This can hit the top of the Bollinger and just keep ripping, as you see here, and pushing that thing up. Oh, have to look out for other signs as well. But yeah, so far gap down on SPY, down 0.64%. Top's up 14.25. We got GME down 1%, AMC down 1.6. Just looking at Thinkorswim, a platform, trying to figure out how to get hotkeys for options, but I don't think you can do it on Thinkorswim. Just for trading shares, hotkeys would be nice. Got about 7 minutes, so depending on how long these guys speak, could see Fed speaking volatility till probably at least 11:30, I'd say. Gotta be careful. Careful with that. Morning, Tasty. Morning, Guts. You guys are doing well today. Thank you guys for your pre-market thumbs up. I appreciate the 5 of you. Well done. We out here. Looking back on yesterday, reviewing the trades and in the chart, it's pleased with how it went. The big part of the move yesterday I missed, so to still be green to be able to trade through that chop, pretty happy with. Move from here to here I missed. Caught it from here to here, and then the bulk of the profits actually were just from this little drop. So can't always get the biggest move in the chart, but going with the one that you're most comfortable with or is most obvious to you, that's the best, because then you can go in with confidence, you can go in with bigger sizing. So yeah, and then all of this, I did get back quite a bit of the profits in here, but still green, so happy with that. Oh yeah, so RAD moved to an OTC market. Now RAD CQ.
Market as it is the case today. History also tells us that the companies in that top tier, if you look at the top 10 in market capitalization decade by decade, on average 2 or 3 are still on the list 10 years later. So which two or three of today's top 10 will still be on that list 10 years from now? I would be reluctant to guess, but I sure would want to fade those. As for the rest of the market is so concentrated that it's almost an anything but the FANG Plus opportunity set. Also anything but US, because the US stock market is priced at ballpark of a 50% premium on price earnings, price to sales, price to dividends, relative to the rest of the world. Both developed ex-US and the emerging economies of the world are comparatively cheap.
Yeah, love the international point as well. Rob, before we let you go, back home here for a sec, because we've got earnings season coming up. Can you give us any pointers as everyday investors, what we should look for as like red or yellow flags in an environment like the AI trade, which I see, as you write, is going to be transformative and a big deal, but probably in a bubble too. How will we, what are the red flags bubbly stocks give off early in their stages?
Well, we wrote a paper just a few weeks ago called the AI NVIDIA Singularity, Breakthrough, Bubble, or Both. And the takeaway is it's both. It's a breakthrough. It's going to massively change the world. It's one in a long series of breakthroughs, whether you're talking railroads or planes or radio or TV or computers or internet. This is one in a long series of transformative technological innovations. They're going to massively change the world. But as is the case in so many of these transformative circumstances, the beneficiary is the customer.
It's open. You heard the
bell. The shareholder is a secondary beneficiary in that, because
sold
the
off there
stocks tend to be priced for perfection.
Great stuff.
Top Wars up
Thanks a lot for your time. Appreciate it.
Thank you.
Absolutely.
GME down 0.5%.
The shareholder and the consumer and the customer. Rob Arnott from Research Affiliates. You just heard the opening bell, and stocks are trading. Let's keep it going here as equities start off under some pressure here this morning. Bonds selling off.
Nail is up 9.8.
Tech earnings, but we do have banks, and they're a little bit mixed right now. Not exactly leading the market by
RAD trading.
means.
Oh, big sell off on RAD.
They are on the higher
RAD's
end.
down 61%.
Down just 20 bips
25
right now.
cents.
Much worse problems in technology.
Oh, 34 cents.
Good timing there from Rob.
It is now an OTC stock.
The risks of even being in transformative technology when valuations are as lofty as they are in some of our leaders. NVIDIA is down 4.5% this morning. That's a pretty big swing to the downside, even by NVIDIA standards. You're also seeing little pressure in Tesla and Netflix going into their earnings, but it's pretty marginal for a few of these names. Netflix might be going positive here in a sec. Alphabet's pretty close too. As I mentioned, Bitcoin down this morning, so there is a little bit of risk off. Energy is the only sector higher as we begin the trading session, with crude oil basically. The dollar is higher, and yields are too. We're at 4.8, so the 10-year still is below our year-to-date high, but not by much at this point. Okay, trying to get a little bounce there in the Dow and the Russell to offset some of the tech weakness. Got a little story in the travel world. Let's go to Caroline Woods, the New York Stock Exchange, and talk about a bid for Wyndham. Okay, so this is fun, Caroline. A little Tuesday merger potential action. Tell us about it.
Hey there, Oliver. Yes, a potential M&A Tuesday that could create, a pretty big budget hotel giant here. It would combine two big names in the budget hotel space. That's Choice Hotels. They're proposing to basically buy Wyndham Hotels for $90 per share in a cash and stock deal. Breaking that down, it'd be $49.50 per share in cash, and then the rest in stock. That represents an 11% premium to Wyndham's 52-week high, a 30% premium to Wyndham's latest closing price. It implies a total equity value for Wyndham of about $7.8 billion on a fully diluted basis, including net debt. That number goes up to about $9.8 billion. And at this point, this is a hostile takeover offer. They want shareholders to take a look at the offer. They're going public with the decision because conversations fell apart in September after 6 months of dialogue. More specifically, Choice said Wyndham decided to disengage from further discussions. In a release, the Choice CEO said a few weeks ago, Choice and Wyndham were in a negotiable range on price and consideration, and both parties have a shared recognition of the value opportunity this potential transaction represents. We were therefore surprised and disappointed that Wyndham decided to disengage. While we would have preferred to continue discussions with Wyndham in private following their unwillingness to proceed, we feel there is too much value for both companies, franchisees, shareholders, associates, and guests to not continue pursuing this transaction. So a hostile offer in the making here. Taking a look at shares of both companies, Wyndham shares actually popping today, up almost 13% in the first few minutes of trading. Choice Hotels, on the other hand, down more than 5% on this news. So it'll be interesting to see how it plays out. I believe Reuters first reported on this back in May. We've since seen the potential offer price go higher. I believe it started around 80, then 85. Now it's at 90. So should be interesting to see how this plays out, especially at a time when budget hotels, I think, are going to become more important because we know the dollar is stretched. People want to keep traveling, but potentially could be running out of money. That's right.
And Airbnb ain't the deal it used to be. With all the fees and the cleaning, my goodness. Whatever price you see on Airbnb, you have to add like 25% to it before actually making your decision. It's not even close.
Yeah, I found it's only worth it to Airbnb if it's a big group of people. Otherwise,
yeah.
it's hotel
or it's like something
way.
really unique, like a tree house or something.
True.
Which I'm into the tree houses. Okay. Thanks, Caroline. Appreciate it. Okay. Little merger action potentially here. Wyndham loving it, of course.
Buy below VWAP.
Caroline Woods. Let's bring in Jeff Pierce, our man from St. Louis, and let's talk about that pressure on NVIDIA stemming from some trade developments as the U.S. continues to tighten restrictions. Shares are down. Jeff, how come they're down this morning and not yesterday when it seemed like this story started building? I mean, is this particularly saying, okay, NVIDIA, you're not allowed to sell? I mean, it seemed like yesterday that was the obvious implication.
Yeah, I mean, there's certainly more pressure, I think, being put on the giant chip company that NVIDIA is. As the Department of Commerce said that they're going to curb that sale of the more advanced AI chips to China. These restrictions are going to include those NVIDIA A800s and those H800s as well. And we know that they're trying to close that perceived loophole that they have. And NVIDIA has already been focusing on putting out versions that fall below the performance threshold that can go out to China. They certainly this regulation that we're seeing is to try to curb some of that, as well as them getting delivered to other countries that might then put them in the hands of China. And I think we've heard a little bit from NVIDIA about this in the past, and huge impact from them having to ship these different types of chips to China. But some more regulation like this could certainly mean an impact to the revenue in the long haul.
Okay. Yeah, it's a pretty steep drop-off here. The commentary from the Bloomberg interview with them, they say that it's not going to meaningfully affect. I don't know. I've been noticing this thing a little bit about NVIDIA, and I don't want to I don't want to phrase this the wrong way, but it seems like they're getting kind of a habit in their public communications to paint with pretty bright colors and
GME
kind of
bouncing
brush
there.
over
1.25.
potential stuff in a way. I mean, I get that they're excited. They've got this great development. They're the leader on this front, and that's indisputable. I do kind of wonder sometimes, though, about the sort of dismissive nature of any of the negative stories. It seems like they really don't want anyone to get in the way of their narrative right now around AI. I don't know how this wouldn't affect them. I mean, it's going to. They say Bloomberg says they don't expect meaningful near-term impact. So there's kind of two questions in there, which is, one, how do we define meaningful? Would it be meaningful for the shareholder or for the company or the customer to kind of take a piece of Rob Arnott's message to us there? And then what does near-term mean, right? Like, is this quarter? Is it
SPY just kind of consolidating here.
Because they're not
Be up shopping for now.
Customers, I mean, that's a pretty big deal.
Yeah, certainly. I mean, it's a huge market share, a huge marketplace for them to sell. And I mean, especially if you're focusing on just the consumer product side of it, smartphones, laptops, gaming, all of that, which, in the past has not required any sort of real licensed export. But we have heard from the company, and I know you're talking more short term a little bit, but in the long term, they've said restrictions on China, we've heard out of their CFO, could result in a permanent loss of opportunity for the U.S. industry to compete. And that impact to their future business and financial results is certainly there. So, we know that NVIDIA thinks about this. They are on this AI run. There's tons of build up around this name. And I think, the runway is long, and certainly here in the U.S. And I think, you cannot take away from their AI story. But you also, to your point, you look at this story and you think to yourself, this could have a major impact. That revenue stream for NVIDIA in China right now and in the future could be huge. And to restrict that, it's impossible to say this is really not a big issue for us long term.
Okay. And yeah, I mean, we don't know specifically just yet exactly which products. So look, I mean, I know there's a range of outcomes here, but any restriction is definitely going to complicate the way analysts and investors price out expectations for this company in the future. The other thing, too, is that recall that China retaliated last time by, prohibiting Micron sales. So, I mean, would they do something like that with NVIDIA, too? It's just a little bit of a black box. And the swiftness with the company has kind of dismissed it is, I don't know, a little suspicious to me. All right, shares down 5.5% though, so the market I think is kind of on my side. Let's talk some earnings and some of the other notes out. Lockheed, after its report, following a $50 bounce roughly on the Israel-Hamas conflict. How do earnings kind of fit into that short-term geopolitical narrative?
Yeah, short term, we're not seeing a lot of reaction today. I mean, it's really flat, up about 0.5%. Came in with, earnings per share beat at 677 versus 666 was expected. That was down about 1.5%. Revenue beat as well, up 2% at 16.88 billion. But look at aeronautics segment, that fell 5.4% to 6.72 billion, missing expectations. Missile and fire control up almost 4%, beating expectations, coming in at 2.94 billion. Rotary and mission systems up almost 9% at 4.12 billion, also beating expectations. And the space segment actually saw sales increase by about 7.6% at 3.1 billion. They reaffirmed their guidance as well, 66.25 to 66.75 billion. Really in line with what we saw from analysts. Earnings per share for the full year, $27 to $27.20. They're saying, their backlog is robust, about 156 billion, as both domestic and international orders are strong. We know that they have had some issues with supply chain. It sounds like that is still an issue, but it is starting to kind of come together a little bit. They've, overall, the commentary of the company has been positive in terms of what they're going to be able to produce, and they're going to be able to keep up with orders. But we saw those shares of contractors jump last week after the news from Israel. And, there's expectation that we could certainly see that have more of an effect on Lockheed and some of the other names as well, RTX, General Dynamics, as we work through this quarter.
Okay. So some of the stuff that had been factored into their sell-off since last quarter, as far as parts go,
rallying up there a bit.
That now has been understood.
BBBYQ's going crazy this morning.
Prioritizing perhaps the short-term
Not sure why it
kind
just
of
ripped up
narrative
there.
to the demand for their products in war times, but they are showing a little bit of a unique jump this morning compared to their peers in the defense sector, which is up about 0.5%, and then Lockheed up more than 1% now. So beating the estimate certainly provides a little bit of relief to this trade because it has been really beaten up the last couple months. I mean, there were some real concerns that they weren't going to be able to make the stuff that they've got all these contract orders for.
Sure, and certainly we've had to evaluate too the fixed contract pricing and the inflation that's come along with that, right? So they have have inflation issues, got that fixed contract pricing. That's put pressure on these companies, and Lockheed has not been immune to that pressure. Obviously, what we see going on, the potential for a longer term war, that's certainly something that's going to put demand for products for companies like Lockheed out there. Now, I think that's something that we're going to have to see develop, and I think we're going to see that over the next couple of quarters. And it looks like, especially what we're hearing from the company, that they're going to be able to meet that demand, and maybe some of those issues in terms of the supply chain have started to ease. Okay.
Let's talk some notes out this morning. A few that you're looking at. Bang through them real quick. Another stock that was beaten up and getting a little bit of a bounce this morning is Dollar Tree. Goldman Sachs analysts upgrade the stock to a buy on the back of a big retail sales. I guess it's a good time to maybe switch the view to something more positive here.
Yeah, maybe a buy from neutral, but price target at 137 down from 150. Analysts said they see strong earnings growth potential supported by continued market share gains from improving traffic trends with sticky new customers and an improving discretionary cash flow outlook for lower and middle income consumers in 2024. They also talked about better shoppability in the recent investments. In addition, they think Dollar Tree's lower freight costs should start to become a meaningful tailwind in the second half of 2023. If you've looked at the news for Dollar Tree, they brought back a former CEO, which did have some success. He was there from 2015 to 2022. We know Dollar General, Dollar Tree, Five Below, they've all been trying to keep up with inflation. That's been a major issue for them, rising prices and trying to stay competitive at the same time, all trying to compete with Walmart. We've seen that. One of the bigger issues is that they've got low margins to begin with. The things that are selling right now, these consumables, are pretty low margin items for them anyway. So they're dealing with inflation. They're dealing with competition, and they're dealing with selling low margin items. It's been a struggle, and a lot of these companies, including Dollar General, are having a tough time with their inventory side of it as well. How do they get through the inventory they have? How do they make sure they make the right choices for the inventory that these customers are going to need going forward? Because the consumer right now has a very up and down appetite for what they're buying.
Yeah, and it seemed like Dollar Tree was going to be in a good place to capitalize on that, but
945 though, do have these Fed speakers.
Very well after an early kind of bid into the economy last year around that pricing down, lower price point type of narrative, and then just gave it up dramatically since the last earnings. Maybe a little bit of family dollar fatigue somewhat. Okay, let's keep it going here. You got a note from Bernstein out on a bunch of energy companies, all downgrades. Doesn't seem like the stocks care too much. Even with crude oil, a little change today. It's now positive. At least energy stocks are up. So market's finding a bid there.
Yeah, all downgrades. It's worth noting that it seemed like it was mainly a cyclical thing. If we look at APA Corp, they moved them to market perform from outperform, price target at $50, down from $51. They said the company is a value name with oil-focused global portfolio with exposure to the Permian, Deepwater North Sea, Egypt, and the Deepwater surname. And they said the firm, however, they're downgrading the stock due to the cyclical timing despite their rich international growth potential. Devon Energy, they moved them from 48 from 62. They moved into market perform from outperform. They said the company has occupied core in Delaware acreage for many years. The performance has occasionally been marred by shaky strategic decisions, but they add that they're downgrading them again due to cyclical timing despite that good balance sheet. EOG, very similar thing. They moved into market perform from outperform, $146 price target, down from $155. They've been pretty impressed with their record of high hits. Their drilling rate per day. But they said, even with the robust balance sheet, the cyclical timing is a call for a downgrade.
Okay, interesting. Just when it seems like crude oil was showing some strength and holding up into the mid 80s, high 80s. Interesting timing for a downgrade. So thanks for the heads up, Jeff Pierce. Appreciate it. I know you had one on Microsoft too, but we're out of time. We got to jump. Long story short there, Microsoft gets a little love, higher price target, doesn't matter. NASDAQ's getting hammered right now down about 1.3%. Bonds selling off. Treasuries getting shredded with the 10-year future down almost 80 bips. So heads up, yield is moving to the upside again.
SPY's bouncing.
Let's talk some more earnings when we return. Do a little trading for Inside Out.
Choppy
we'll
morning
look
so
at
far.
J&J's numbers, which are out, and look ahead to the next airline reporting, which is UAL. So we're going to bounce around some sectors here as we keep eyes on the market. Definitely getting hit here.
I was just waiting for these Fed speakers and data, I guess, at 10 o'clock. Out of some of these puts. It's too choppy. AMC rallying 3.3%. I'm out of those puts. $10 minutes. Business inventories. There's a new low on SPY. Guess could have held those puts a little longer. Oh well. I like the chop. %. 1.25 on GME. AMC up 4.
$500 million on the revenue side, which is roughly 12% year-over-year jump in revenue. I think this is another one that's a better trader. And if you look at the charts here, it's obviously a more volatile name. And in the near term, we do like the stock. Like I said, using that Delta crystal ball, I think there still is enough push from the consumer through this quarter. Our fear from a long-term fundamental investment standpoint is we do believe that we are starting to see a cycle turn and the consumer starting to pull back in certain areas. So our fear is as we get through the holiday shopping season and travel numbers start to come out, that it is going to be a little bit weaker than what's expected. So like I said, short term, we would own this through the earnings season, this current earnings season, but we would be a seller going into the end of the year. And as a long-term investor, we would not own United.
So you think that just the market move here has gotten too extreme to the downside in the short term?
Yeah, in the short term, we do think it's too much to the downside. That there's obviously a lot of fears of cost. That's really the big headline, right? We all know that energy prices are high, and the geopolitical issues are going to keep them high here in the near term. So that is a real issue. There are some concerns around labor. We're seeing more and more strikes, and those strikes lasting longer and longer. So those are real concerns. But right now, we don't think that's going to be something that's going to move the stock in the near term. I think if for the most part that's all priced in and probably overbaked. So that's why we would be a buyer, in the short term and through this earnings season, because we do think that they're going to come in better than expected. But the long-term story just really isn't there.
Interesting. Okay, I like that. Almost seems like we should be doing another call calendar there. Thanks, I appreciate the thoughts and a good setup for this afternoon too. Short versus long term. Kind of seems like the trade we just did would apply there to.
Well, he actually flip-flopped it. He's more bullish long-term in J&J.
Right.
Short-term, not so bullish. And then in UAL, he's opposite where, hey, over 32% drop since those July highs that
Who
we
wouldn't
saw.
Want to take a stab?
Right.
You don't have to be a believer in a long term, I guess, to try and make a trade.
Right, and I think that's the key here with implied volatility, elevated option market, pricing in about a plus or minus 5% move in the shares, about $2.10 either way on this one. So I looked at a strategy that takes advantage of higher implied volatility because you have that earnings event after the close. Shorter term, though, I looked out in the November monthly cycle here, Oliver, about 31 days till expiration, so just about a month in this position where I'm going to take advantage of that higher implied volatility, selling a put vertical that's slightly out of the money to the downside, selling the 38 strike put, and then against it because it's earnings, right? Anything can happen. Stocks can move 2-3 standard deviations, not just what the option market's pricing in. So buying the 35 strike put against that, so a short, neutral to bullish $3 wide put vertical that takes advantage of either some consolidation here or it rallies. If you're collecting roughly about a 75-cent credit, that's what you can make on this trade. But the risk-reward setup doesn't look great, right? You can only make $75 per spread, but at the same time, you're giving yourself a better probability of success because you're selling an out-of-the-money put vertical. Your break-even down at $37.25. That's $2.25 below the current share price, and it's about a 6% cushion to the downside before you start getting hurt on a strategy like this. So unlike the Johnny John, where we're taking advantage of lower implied volatility, the UAL, we're taking advantage of higher implied volatility because you collect more credit on the neutral to bullish short put vertical if you think this stock's going to at least remain where it is, maybe pop after earnings.
Makes sense, given the extreme move that we've had going into this.
Yep.
I feel like there's going to be a lot of trading in the airlines this quarter. Thanks, Tom, for the trades. Adam Coons with the analysis on the fundamentals. When we come back, we're in hour 2. Got plenty of trading ahead. Watching the NASDAQ get pummeled right now by the bond market. Pretty clear what's happening here as those big tech companies respond to a real sell-off in treasuries again. If you thought bonds were done, that does not look right. And is our focus when we come back after a good retail sales this morning.
AMC holding up here, 3.75. SPY, a little choppy. There's 10 a.m. business inventories data. And then home builder confidence index. And Bowman starts, and Kashkari starts at 10:30. GME up 1.6. Upward sold off a bit, still up 10.5. Little break on the channel to the upside. Yeah, I grabbed some puts there. Broke the upper channel, I got calls instead. I was rejecting the top of the channel, breaking the top channel. Okay, closed one of them, stopping the rest. Just hit high a day. Love Fed speakers coming on, so be prepared. In the morning, I'm on these little trades. My position size is quite small.
Rating. So some competitions, but basically not helping the stock today. Though, like I said, it's rallied here about 4%.
Only down 0.4% now.
But Amazon
filling in this gap
from both Stifel and Deutsche Bank today.
Okay, yeah, pretty strong timing there with both those analysts coming out at the same time. And I do think that there's something to be said for it because I've kind of described the chart as looking more like a Walmart or a Costco as opposed to a cloud stock.
Sure.
You know, because the cloud stocks are up less than 20% on the year, whereas, Walmart and Costco are not up that much, but they are closer towards their highs. And that's where it does seem like the market's kind of traded Amazon on the retail and the consumer as opposed to the very long time focus on the cloud growth. And I feel like that is kind of a sign of maturation for the company in a way.
Remember,
but if they got competitors, it's not going to help.
Yeah. Remember, decelerating cloud growth has been a sticky point for Amazon. They've had a great first 6 months of the year. The numbers have been big. The stock's backed off its recent highs, but any stabilization in the number one player in cloud platforms will probably help. And then there's advertising, Oliver. There's always advertising. Bringing that to Prime in 2024, just another big number to put in the pile.
So is Temu? It's the first time I've ever even heard of this.
I had to look up what it was, Oliver. Sorry.
Yeah, I thought when I was reading the rundown this morning that it was like a foreign company or something, like an international.
Sounds like that animal in the commercial, Temu. I didn't know what it was.
That's an emu.
Oh, sorry.
Yeah. All right, I'm glad somehow I knew what you were talking about there. Okay, thanks, Kevin. All right, Amazon shares getting hit, though, despite some positive tone from the sell side here this morning, but we also are getting a little bit of a bounce as the Nasdaq tries to firm up after that opening sell-off. Let's do some trading with Tim Bigham, lead option strategist at Delta Derivatives. Tim, a great year for Amazon. A little bit less of a great month, though.
Seven barbecue? I don't know yet.
$15 off the highs.
I don't know.
How does that make the trading look in your mind?
Yeah, you know,
Yeah, you can't buy it anymore.
Talking about Amazon as well, and at that time I was a little more
That's true.
bullish on Amazon with the stock a little bit lower.
Nice,
It's had
Guts. Well done, man.
nice rally over the past week or so. So we sold out of the money put spread that expired this Friday, but with earnings looming next Thursday, I'm kind of using the chart out here to take advantage of
I will not
lift
be
and implied
partaking in gambling
volatility,
today.
not only from earnings but the weakness today. So I think selling an iron condor here that expires basically right after earnings. Earnings next Thursday. This expires a week from Friday on the 27th. So I'm just looking at selling towards the recent highs around 142, buying at the recent lows around 120, and capturing some nice option premium here. Obviously hedging both sides here. So going out selling the 142, 144 call spread, simultaneously selling the 120, 118 put spread, bringing in about 65 cents or so. I like the return on risk around 50%, and you're giving yourself about an 8% cushion to the upside and downside both from where the stock's currently trading at. So I think, as you and Kevin talked about, you know, Amazon is Amazon, and obviously the, you know, big player in the space. No one's really going to cut into them too badly, I think, going forward here. So I don't mind being a buyer on weakness here. But again, with interest rates pushing towards, you know, multi-year highs here, we're seeing valuations start to get trimmed back. That's why we're seeing the NASDAQ get hit a little bit harder here on the 10-year, poking towards 5%. So I think valuations will be tough, certainly to expand, and probably got to come in a little bit more with interest rates up here. So I think the upside is somewhat capped. So I don't mind being a seller at, you know, the highs around 142 and a buyer around 120 and getting overpaid, I think, for that. Okay.
The trade fading kind of both tails with the iron condor is essentially a range-bound trade at a time where you've got earnings ahead. I mean, it kind of almost seems like kind of a bold trade. You know, it basically is saying that the earnings are not going to create a huge event, right? Because they're coming out 26, because you were going to capture earnings by the day here.
Yeah, exactly right. This is basically you'll know it when you see it on Friday morning, right? Or even after the close on Thursday to some extent. But I like the fact that, you know, return on risk is 50% or so here. I define my risk, you know, to about $1.35, bringing in about 65 cents. And more importantly, because of that lift in implied volatility, right, getting an 8% cushion here. So Amazon can certainly move as long as it doesn't rip higher by, you know, more than 8%. Both sides should expire worthless, and you'll know it instantly. So this is really a straightforward bet on earnings, and I like the fact that, you know, Amazon to the downside 120 has certainly held here. I think it will continue to, and I think you know, valuations will be challenged if it tries to head much higher. So unless we get an absolute blowout or an absolute miss, which I don't think will happen with Amazon, I think it'll probably be somewhat of a non-event. So I don't mind selling what I consider to be overpriced option premium going into Amazon earnings, especially given the fact we've had the pullback in Amazon stock that you alluded to, and we've kind of held the lows. So I think it will continue to probably move sideways to perhaps grind higher into the end of the year.
All right. Okay. So you get a range here to where you're still making money on the trade. And the preference, I guess, would be that it would firm up a little bit.
Yeah, I mean, really, as long as it doesn't get hammered or, you know, lift off to the moon.
Yeah, it doesn't matter.
That 8% area is, you know, a wide swath here, and it really fits in nicely with the chart recently, too. So I like it on that aspect as well. So, you know, an 8% move is a decent move post-earnings for a stock the size of Amazon and as widely followed as Amazon. So it's getting more and more difficult for Amazon to kind of, you know, have that huge beat, similar to kind of Apple and these other mega cap stocks.
AMC rallying, man,
usually
6%.
when they report, it'll be reported probably with a slight beat at best and a slight miss at worst.
All right. The Iron Condor on Amazon. Like it. Thanks, Tim Bigham.
You bet.
All right. Not a Temu user.
GME also up 2.5.
Not
Amazon.
a Temu, no.
More Owned by PDD.
Another RSI divergence
Pinduoduo,
here, so maybe it'll bounce up to this
international sense
resistance
that
again.
It's owned by a Chinese entity, but based in Boston. Okay, coming up, let's talk some other retailers, especially those connected to the ground and the brick and mortar world of Kroger and maybe Albertsons together. We do have the Albertsons earnings to look at. We've also got a bunch of notes out from Instacart as coverage began there, so we'll have a fun and broad conversation about shopping and groceries and consumer staples and retail with Arun Sundaram joining us from CFRA. Coming back, equities are trying to firm up, and the Russell's really leading the way. Look at those small caps. Heck yeah, a couple days.
Low was up 6.5. Got a little small caps. What's up? New high there. Rally. Whew. Got just a little bit of consolidation, not very big, not much of a pullback there to reload. Gallons down 2 1/4. FLT is up half. Pelodoc. Pelodoc's up 1.9.
And a little bit hesitant on the merger. The biggest concern is still about market overlap concerns. Albertsons and Kroger recently announced a divestiture package to try to address these market overlap concerns. And right now, they're planning to divest a little bit more than 400 stores to a company called GNS Wholesale Grocers. They're mainly a wholesaler, but they also have a small grocery business. We think that divestiture number, that 400 stores, might need to be a little bit higher. There's still a lot of market overlap concerns in the West Coast, places like Oregon, Seattle, Southern California, even in the Midwest like Colorado. There's still a lot of market overlap there, so we think that divestiture number will likely move up and be a little bit higher than the current projected amount.
Okay. Not to get kind of over in my skis and in the wrong department a bit, but with Amazon, Costco, and Walmart, I mean, how is there any concern about limited competition in the grocery space? Is it a strictly regional thing? But I mean, Amazon hits everywhere. Walmart online hits everywhere. I mean, it would seem like it would be an easy call for these mostly brick and mortar stores. They've got pickup and stuff, but to combine and be able to compete.
So yeah, I think that's where the argument really lies between Kroger and Albertsons and the government. And it's really on the definition of the competition. Historically, the FTC has taken a more narrow approach in terms of competition. So they only include supermarketers. And if you include that narrow definition, then
sure, well, that's
number one grocer and Albertsons number two.
That's like a world from a decade ago, though.
What was that?
That's like a world from a decade ago.
Yeah, so that's why, Kroger and Albertsons have been arguing that you can't take that narrow definition. You need to have a more broader approach, especially now that people are buying stuff online. So we need to include companies like Amazon, Walmart, Costco. So I think that's where the argument is going to really lie on what kind of definition they're going to take. But historically, like I said, the FTC has taken that more narrow approach. Yeah,
seems like it doesn't make any sense today, frankly. But that's just my opinion, of course. I'm not a lawyer. Okay, let's talk some of the other, since we're on the subject now of kind of online, Instacart and the analysis that begins this company now.
% on GME.
Walk us through how you think this fits in.
Yeah, so we initiated coverage on Instacart. It was last Friday. We initiated with a sell
AMC.
rating and a 12-month target price of $20. Clearly, this is no surprise, but clearly Instacart was a major beneficiary of the pandemic. And now we're starting to see growth slow, and growth is significantly slowing. So if you look at this year, we're likely to see about 18% revenue growth, but in 2024 we're projecting just about 4% revenue growth. And a lot of that has to do with the fact that food prices are coming down. So food disinflation is proving to be a significant headwind for Instacart, because that brings down their average order values. And if you have lower average order values, that's less. The dollar amount of service fees, things like that will come down. And also now, just given the tough consumer spending environment, we see consumers returning back into stores. And for Instacart, its business model is really predicted on efficiencies. So in order to generate efficiencies, they need a lot of orders, they need high order values, but we're not really seeing that right now. And because of that, they're likely to experience more inefficiencies in the upcoming year. So we're actually projecting their margins to come down in 2024. If you look at Instacart's margins right now, its EBITDA margins, it's currently above DoorDash and Uber. And we don't necessarily think that's sustainable. So right now, its EBITDA margins are around 19%. DoorDash and Uber are sitting just above around 10 to 12%. So we're projecting Instacart's EBITDA margins to fall in 2024, and that's not right now baked into consensus estimates. So that's why we have a sell rating.
Now, is that just because you can't maintain those margins at a scale along the same level as like an Uber, or what am I missing there?
Yeah, it's like I said, it's really this business model is really dependent on generating efficiencies. So if a lot of, let's say in a certain area, many people are placing orders on Instacart, then you can have one person go to the grocery store, pick up all these orders for multiple people, and then go deliver it. But if this one person has to go to a grocery store, pick up orders, deliver it to that person, then go to another grocery store, pick up an order, and go deliver it to that person, that costs a lot more money. It's also more that Instacart's paying to that delivery driver. And in that sense, they'll likely see more inefficiencies there. And the other aspect of that is that lower average order values. Right now, average order values for Instacart is sitting at an all-time high, and a lot of that has to do with the fact that food prices are up, and it's been up significantly. But with food prices coming down now, we're not likely to see that really high average order value, and if that's the case, then we'll likely see more inefficiencies there as well.
Wow, fascinating. Makes sense. Okay, so $20 gets a sell rating, which is also applies to some of the staples too. The one that you guys sell rating on, I wanted to just hit this morning after a massive drop off last week, is Hormel. How bad does that get? I mean, we've been watching a lot of these staples drop like flies, but this one in particular was a total bloodbath.
Yeah, so for Hormel, they had an investor day recently, and it sounds like the company's in a big investment cycle, and that investment cycle is going to last for probably about 2 years. So we're not likely going to see much earnings growth for Hormel over the next 2 years. Now, they do project pretty strong earnings growth down the road, but that's, they're looking at targets in 2026 right now, and there's a lot of uncertainty whether they'll hit those targets. So that's why I think we're seeing investors sell off this stock right now.
Okay. Wow, a lot of action in the staples category right now.
Head and shoulders up here, maybe we'll see.
World too. I guess that's kind of what happens when inflation has big ups and downs over a 12-month period. Creates a little bit of volatility, maybe some opportunity too. Arun, thanks a lot for the analysis. Great stuff, and really good distinction between businesses that to the naked eye look so similar, like a Kroger and Albertsons. So helpful to us to understand those differences, as well as Instacart's valuation and margin differences between some of their competitors. Very helpful. Arun Sundram, CFRA Research. Thanks a lot.
Thanks, Alan.
Coming up, let's do some charts on some companies.
It's a
we got JB Hunt Trucks tonight. Morgan Stanley tomorrow morning.
Close one more.
Also got
Just
Procter & Gamble in the mix, which has been looking a
ridiculous
little bit better
procedure
than
to
J&J,
close.
but not a ton.
Open and all right. Enough Fidelity complaining. hard to deny that head and shoulders there.
And up over the quarter.
Exactly. But analysts are expecting that top line to be weighed down by the weakness across the majority of JB Hunt's segments. The intermodal revenues in particular
Fed speakers going on right now, I think.
By almost 16%.
Yeah, Kashkari
and then I'll give you
Barkin.
another one. When we look at integrated capacity
Or no, Bowman and Kashkari.
They're expecting to see
And Barkin
a
at
30%
10:45.
decline in that. One of the only rises that I see are in dedicated contract services. That segment is expected to see a modest increase by a little over 2%.
Okay. And the intermodal you mentioned, which is a big part of their business. Walk me through that number again. I just want to make sure I got that right.
Expected to have declined by almost 16%.
That is a part that's going to hurt because
They got more calls there.
and kind of the growth potential there being down is definitely going to weigh on the earnings. But I don't know, the market's been okay with it so far. I mean, the chart seems all right, Kevin Green. Still off the highs, but definitely well off the lows too.
No, I didn't.
Yeah, definitely. We are actually seeing a really nice
Dang it.
setup when you're looking at JB Hunt,
Got
especially
puts,
on
I
a
meant to get
1-year
calls.
daily time frame here, and it kind of aligns with that fundamental context that you all were just talking about. They actually did lower their expectations fairly significantly, and we probably can see that being translated in the chart. The first thing that I'm actually looking at is point A. So we actually seen this the stock actually trading this upward channel here for let's say the last 3 months or so. Now it is potentially going to test the $200 level. It looks like it may have actually hit that on an intraday basis already today, but we also saw this strong move to the upside off of that 200-day SMA in red on strong volume as well. That means that there were some buyers that were willing to come in and be able to find some value for the stock. That was around the same time that we heard a lot of that commentary coming from them when it came to demand. Now, from a support area standpoint, we're going to be focusing on the $183.10 level. That's going to be the 200-day SMA. If it does fail that, then the point of control at $176.06. Also looking at the RSI, it is moving to the upside along with the CCI, so that's bullish in nature. And then last but not least, I wanted to highlight
I jumped in on them anyways.
Very significant to say the least here. We saw a really good green candle on large volume, and I did highlight this with that blue line. If you actually look in the past and we see volume reaching these particular levels, that's actually an indication of continued strength or a reversal. So that's one thing to kind of keep in mind. A large green candle, price action does confirm, along with the volume, that this is actually a bullish move. I think the near term is bullish for the stock right now.
Yeah, all right, looks pretty good, especially in the second and third panels there. We were showing some of those secondary momentum indicators, pretty steady uptrend, where, you know, sometimes the price in the stock is not as obviously in an uptrend when we're below the 1-year highs, but that secondary look is very helpful to see how momentum is favoring bulls right now. All right, JB Hunt, could be a fun one here, especially considering that the chart looks that good after reading through some of the expectations on the numbers, where some declines are definitely going to be part of the game. All right, let's switch gears. Let's go back to banks for a sec. Morgan Stanley tomorrow basically rounding out the suite of the giants, Renita.
Yes, they will. And they're looking for their analysts are expecting adjusted earnings of about $1.27 a share, revenue of $13.08 billion. Now, analysts are looking to see higher interest income, of course, from Morgan Stanley, and then a decline, however, in outstanding share count. That's what they're expecting, and that was to support the bottom line. Yeah. But they're expecting to see some changes and some challenges rather than changes in investment banking, also challenges in the trading revenue segment to continue. The analysts are expecting all of those things to continue to pressure revenue and earnings when they come out. So this is another one of those banks that has high exposure to investment banking, obviously. So we'll look to see that and whether or not its own portfolio is impacted negatively
not recently.
by that as well.
Their trading has
get
been
some
a bit
drug
of a
approval
letdown the last couple quarters, but they did manage to beat the expectations.
Action the last few days.
Just hasn't really been a huge success story like it was a couple years ago.
That's why.
Especially during COVID, when there was so much equity trading happening as
good
well.
for probably day trading.
Kind of, in the same camp as Goldman in a way. where the stock's
one
been
I
a
don't
little
think
bit
I'd swing trade.
weak. I mean, everything's kind of been weak compared to J.P. Morgan, I feel like, Kevin Green, as far as the big banks go.
Yeah, definitely. And when it comes to Morgan Stanley, the trading revenue is really going to be key. Now, we actually did see that Goldman Sachs actually knocked it out of the park for trading revenue. I think that's why we are seeing a little bit of a bid when it comes to Morgan Stanley. But looking at a one-year daily chart, there's some critical areas that we need to keep in mind here, along with this earnings announcement. If we look at point A, the stock has been trading in this downward channel actually since March of this year. We continue to see it trading in a range, and then it tried to break out, failed that breakout, and then went right back into another range-bound, downward channel, if you will, which is not a really good sign. That is actually bearish. We are also looking at support at around $76.50. If it does break that level, Oliver, we could actually see some continued selling on pretty high volume coming into the marketplace, because that has been a critical area, not only just in the one-year time frame, but over the last 3 years to keep in mind here. And then last but not least, we have Stochastics. Stochastics is actually moving higher, which is bullish. And we are also seeing this cross on the MACD between the 12 EMA and the 26 EMA. We did see an official cross, or a potential cross, that is actually occurring today, and that is actually short-term bullish. Now, a lot of traders like to wait until that those moving averages move across the zero line on the MACD, but you can look in the past, which I have highlighted, that when we do see that cross along with the stochastics move to the upside, we have seen short-term moves to the upside when it comes to the stock. It doesn't mean that it's going to sustain itself, but it's not surprising that you could see a short-term rally post-earnings if we do hear a good report.
Come back.
Okay. It seems like,
I mean, this was just from Fundamental News, I'm assuming. Got approval or something.
A good bit of legwork on some of those short-term momentum indicators with the stochastic and the MACD.
It's not really one you can just trade on TA necessarily.
Or else, because
I guess you can, but you're susceptible to these crazy catalysts.
Still has a pretty deep entrenched downtrend. So whether or not that real short-term 24-hour
took some more profits up there.
Translates into something tomorrow. Could make it a fairly dramatic second half of the week if the numbers don't propel it into the right direction for bulls. Okay, like that analysis from Morgan. Last one here, Procter & Gamble. I'm really interested to see Kevin Green's take on the chart. It's got a lot of ups and a lot of downs here, but it should be kind of a stable business in most respects, I would think, Renita.
That's what people think about Staples. That's what's been the story historically, but we're not sure if that's actually going to carry through. We've seen Staples be very volatile this year as people went to the higher growth names, right? And so analysts are actually expecting adjusted earnings of $1.71 on revenue of $21.67 billion. This company obviously is responsible for several different brands, Tide, Charmin, different shampoos, paper towels. But what I see when I look at their brands,
got one for the homies there.
That are very substitutable.
Looking for upper reload. There's a larger position too here when I
that are out there
puts instead of calls.
Gamble brands that are out. So if we see a trade down effect, if we hear the company talking about a trade down effect, that would be interesting. But traditionally, it's been pretty strong. It's been a staple. Now, year to date, this stock is down around 4%, but it is up over the past 12 months, more than 12%. So we'll find out how the stock action goes around the actual report.
Okay, and tomorrow morning as well, Kevin Green, it's, I guess, compared to some of the other staples that got Ozempic, is a bit of a bastion in the sector, but it's not short of volatility itself.
Yeah, definitely. It's been able to hold up, and if you compare it to, say, Coca-Cola or Pepsi, things of that nature here. But the chart setup, if you're looking at it from a longer-term time frame, I would be just a little bit cautious, but there is some optimism here if you're looking at some of the secondary indicators. The first thing to kind of keep an eye on, point A, we've seen this huge and very drawn-out channel here that we've seen pretty much for the whole year, and we are actually breaking below that channel right now. It did actually, well, it did break below that channel about 2 sessions ago. We're trading right above it, so that's something to really keep in mind. It can actually stay below that channel for about a month or 2 months, so it's not surprising. It's not a huge indicator to say that there's going to be an immediate sell-off to the downside here, but it's something to kind of keep your eye on, to say the least. We also broke that longer-term trend line to the upside, and Oliver, that's probably what you were kind of highlighting here when you have a little bit mixed results when it comes to this chart. You don't like to see the primary trend being broken. It had that little pennant type of pattern, or you could call it a wedge pattern, and then that is where we actually did see the stock break down pretty large volume. So areas of support to kind of keep an eye on, $143. Area of resistance, that point of control on the volume profile at $150 here. I would not be surprised if we do continue to see this bouncing or this range-bound movement for the stock in the near term. Last but not least, here's the bullish side of these indicators. We have the RSI moving to the upside. We also have stochastics moving to the upside. Once again, if we look in the past, when we see these crosses occurring at the same time, we do see a short-term bullish move to the upside. That's not a guarantee, but that's something we tend to see when it comes to not only this stock, but a lot of stocks within the S&P 500, and hopefully that's going to be the trend for this one. But as you said, some of the fundamental factors, especially when you're talking about Ozempic, has put a lot of pressure on companies that have exposure to staples or even healthcare.
All right. This short-term couple sessions here, really, they're kind of the last week of trading. Seems like it's doing a lot of work to get Procter & Gamble back on track, but earnings need to follow through. So some good chart work. Thanks, Kevin Green. Thanks, Rita Young, for the look ahead at the numbers. Got a busy 24 hours. We've already had a busy session already as the market is coming back. Russell is leading the way. Still some casualties in the tech world, though. We're going to talk about another one we haven't hit this morning when we return. Caroline Woods will tell us about the sell-off in VMware. As the NASDAQ is still down, but it has shaved off a good chunk of its losses, more than half, and it also is fitting with the dollar that's flipped red. Bonds still very much down on the day, but the selling also has stopped in treasuries, so investors have an opportunity here. We'll see if bulls show up and firm things up.
Fed speakers going on. So far, it doesn't seem like they've moved the market too much. Nothing crazy's being said. I'd like to listen to it live, but I can't find it. Got faked out on this. Just rip, I got more calls. Gotta remember to go lighter after we've made that morning move. Doesn't always work that way, but as it slows down, I tend to go heavier. I have more confidence, more confirmation. I'm not sure, but it should be the opposite, because this was the move right here. Given we could have a much bigger move later for the upside, but there's going to be some liquidity being built, and I have to be patient for it. So yeah, my position sizing on this one was too heavy. It was greedy. Especially now it looks like we're starting to roll over on the top. See though.
I still think that's low and unlikely between now and the end of the year.
Okay.
They're pushing the cuts up till May and back for the Fed funds when they're going to start cutting rates, which is always the
so that's where it comes down to the
no RSI divergence or anything, so
I guess, and,
it'd just be
Nick,
bulls building
that's where
liquidity.
This
We'll pull back. Might even average into these.
For markets gets kind of nuanced, because it seems that indeed there is no pricing of a high probability for a hike. However, if the odds of the cuts keep going down because the consumer is so powerful, then I would think that also factors into stock valuations.
It does, but it also leads to stability, Oliver, in my opinion. If you look at what happened over the last 2 years, it was an unprecedented, rate move, and we're seeing stability. And I think the Fed can tell that story eloquently for the next 6 months, and equities can hang in there. And I think that could potentially yield that soft landing if we get that, right? There is enough rhetoric out there that continued rate hikes will cause a recession. You're not seeing it in the numbers yet, but there are some signs. When you look at that retail sales number this morning, it's pretty strong across the board. Autos were up, the most, I think, over 1%. So, you look at, again, it's kind of sector and specific, sector based. I don't think it's just runaway inflation at this point. I think the Fed sees that, and it fits very, very well with their narrative of, restrictive for longer. But restrictive, to your point, doesn't just mean continuing to raise rates. We are restrictive, right? And then, equities, I feel like, can hold in there if we have a stable dollar and we know the Fed's path. Everybody can position around that. Companies that are looking to have capital expenditures can budget correctly in this rate environment. Nobody's scrambling because rates are still going up so much, and individuals as well, right? So I think stability is a good story here, and if they're able to orchestrate that, I think that would be the ultimate win for them coming out of this really, really aggressive rate hiking cycle.
It seems like right now they're doing a pretty good job of kind of navigating that softish landing or whatever it may be, and maybe even getting a little bounce in the economy. I mean, it seems like at this point the Fed should deserve a little bit of credit here, because when the recession calls by basically every economist on the street keep turning out to be wrong, I mean, that means something, right,
we
Dan?
were, right, 6 months ago, 8 months ago, everyone was like panicking the bell, inverted yield curve, massive rate cuts between now and the end of the year. We're close to the end of the year. We're not getting them.
Exactly.
Right, and the
Morning, Dink.
taking a breath here. 30-year rates probably going to have a hard time getting above the 2-year note, right? At 5 1/8, we're at a little under 5% right now for the 30-year bond. Don't know if it can get up above that. It's going to have some really a big economic event or some sort of news to get the rates to blow out again. They are blowing, they are gone up to the 2-year note, so we're flat.
No, this is a really good point because we got up to a flat curve for the 30s to the 2s, and in the case of the 10s to the 2s, I mean, we got real close to uninverting fully. Yeah. That's a big deal.
And the market rejected it, right? The rates backed off hugely. Don't know that that's right. So if you're a bond portfolio manager, where's your risk, right? Are you worried about rates going lower right now? No. You're worried about the exposure to higher rates and the bonds that you just bought at auction decreasing in value. So your hedges have to be pressed as the market goes down. You have to continue to sell futures.
Yeah. Hey, Nick, you got a quick 30-second for us as we wrap it up?
Yeah, guys, I think the bond talk is fascinating. I think getting back to a normal shaped yield curve, fascinating. In the much shorter term, United Airlines earnings and Tesla earnings. You saw this powerful auto number this morning in retail sales. Tesla's down on the day. Really interested to see what they report tomorrow after the close, Thursday after the close, I think. And then tonight, the demand for travel has been crazy high. What's United going to tell? I think there's sort of fascinating earnings that tie into this sort of retail strength that we're seeing.
Definitely. The airline just getting crushed going into this report. Seems like United would have the odds on their side for, a beat or a balance. And then I'm with you too. Tesla, which is coming out tomorrow after the bell, is of course my highlight for the week as well. Thanks, Nick and Mr. Dan Grant, Oliver Rennick. Thank you for joining MTL. Cole Pedalese.
Average into those. If you get a break on this top level. Top break would be nice. We still have gap to fill, I think, right? Yeah. Didn't quite fill a gap. A bit more. The least the SPY could do. AMC back to VWAP. Top below VWAP, up 11.8.
To the Chinese market, the Commerce Department on Tuesday did say it would significantly constrict exports of AI chips, making it tougher for a lot of these U.S. companies, as well as like NVIDIA, Intel, to sell their existing products in China or introduce new chips given these various rules. The move does aim to sort of close these perceived loopholes in export controls that was announced about a year ago, which they themselves have faced strong opposition for, just given some of these escalating tensions. Of course, we did see NVIDIA sell off about a year ago. I can recall a monster move lower in reaction to this news, but they've obviously been able to shake that off quite well. The exports of NVIDIA's A8100, H800 chips will be restricted. The rule does specifically expand the license requirement for advanced chip exports to more than 40 countries, per reports we've gotten from U.S. officials. It also expands license requirements for chip-making equipment to 21 countries other than China and U.S. So that's or other than China, so that is also per these officials. So it's going to be interesting to see how this impacts more than just obviously NVIDIA, but I think for a name that has risen so much, that has gained so much of the AI attention, it is important to note that we could see some weakness here, and we could see perhaps what has been such a high bar set forth for the stock. We could see the fact that right now these tensions are definitely going to be in focus for now these coming quarters.
Right, understood. And you see all the names here, as you noted, AMD and all of these lower today. Thank you for that. And then Bank of America, one of the banks that we focused on, beat the street this morning. Tell us a little bit about Bank of America.
So Bank of America did say that they had a really nice third quarter. We have a nice 1% lift, hanging on for dear life here amid some of the overall selling in the market right now, Nicole, like you mentioned. But they did say their net income for the quarter was up 10% to around $7.8 billion, or around 90 cents per share. That was higher than the 81 cents per share reported a year ago. Revenue rose to $25.2 billion from $24.5 billion a year ago, and did come in slightly ahead of estimates. Now, Bank of America, they said all in all, their net interest income was lifted by a lot of this revenue growth in credit cards and capital markets, despite the modest rise in deposit costs. While continued reserve build is another sign of now some responsible growth when looking at the company. Now, their CEO did say the bank added clients and accounts across all lines of their business, and they managed through a healthy but closing economy that saw the U.S. consumer that is still facing some headwinds, obviously, on a year-over-year basis. All in all, though, their global markets revenue still increased by 10%. They added 200,000 new consumer checking accounts and 1.1 million credit card accounts. And what's interesting to me is when you look at the performance of Bank of America, for example, it's down 18% this year because this name does perform. I know it's a major bank, but it tends to perform more like a regional bank. It's a different
See if we can break this top channel. If
JP
so,
Morgan or Wells Fargo. So
at least a retest to the high.
Taking
profits up here. And then more. Another gap fill.
Nice to see you. Thank you. Let's get some insights in the news shaping the markets. For that, we welcome in Dana Dioria, co-CIO at Investnet PMC. Thank you for being with us. So you look at our market today, you want to be a little more defensive. Today, for example, we got in retail sales where we saw consumers are still spending. We're seeing that element. Some of the earnings have come in. It's earnings season. What are you watching most closely?
Yeah, thank you. Well, it's hard to be a bear, right? I was listening to the broadcast earlier and just, so correct that we really started this year with an expectation of recession, market volatility that just never materialized. And, I think at this point,
bulls building liquidity? I
seeing
think
even kind of
so.
the most diehard bears sort of say, okay, maybe we're going to stick this landing. And so, from my perspective, working with retail clients, retail advisors and their clients, it's more about, what could happen as opposed to necessarily predicting exactly what will happen. So when you ask, kind of what you're watching for, I think from my perspective, I still am kind of watching for the potential negatives, not necessarily to say that, we're going to have a recession, but I think there's enough that we can see in the numbers that we're not completely out of the woods, right? So we know monetary policy acts with a lag. We know, corporations are rolling over debt into a different environment that they've been in before, and that's coming. We know consumers are going to get squeezed, right? Loan repayments coming back online, probably a shutdown coming. Typically, shutdowns don't, have a huge impact on the market, but we're in a period now where the deficit all of a sudden is a big problem because our carry cost of debt is much higher than it was. And so we should expect some fiscal austerity combined with the impact of the monetary lag.
Oh,
so
SPY's just shopping around now.
We're really not out of the woods.
Right. Or we just double top there and I missed most of my exit.
Have this sort of back and forth action and the uncertainty, and that received bank numbers on Friday, for example, and what we've been seeing in earnings this far. We'll have about 10 S&P 500 companies reporting this week, but so far it seems like so good, and so the risk and the worry on Wall Street, I guess, is that the Fed will continue to hike. What are your thoughts there for this year and next? What the Fed may or may not do?
It's such a nice little opportunity.
Yes, it is and always seems to be the big question. I think the base case is that they don't raise. The market's done a lot of tightening. I mean, notwithstanding, obviously, what's happened very recently where rates actually did come back down a little bit. The market had done a lot of tightening for the Fed. I think, I think the Fed's going to lean towards a pause in November, just because the data is such that, and obviously, look, it could go either way, but I think the data is such that they can afford to pause and wait and continue to see what the impact is, because they see all the same things that we're talking about here today, right? Growth for this earnings season does look like tepidly better than, the year-over-year declines that we had been seeing. But at the same time, the markets have a lot to contend with coming up, and the Fed sees that. So my expectation is the Fed doesn't hike. The question is when do they pivot, right? So, higher for longer, how serious is that? That's more what I would be focusing on is, how long that long is. Typically, rates only plateau for, half a year, right?
We
8
have
months
Fed speakers maybe moving the market a little bit.
Up cutting again. And I think a big question is whether that's going to happen in this cycle.
Right, understood. And at this point now, and you look at this market, do you also sort of put in some defensive trades? Tell us about your advice to investors at this point, because you still have geopolitical risk, right now. Could it expand? Of course, that's the worst case scenario. But people have all the scenarios in place, the good, the bad, and the ugly.
And I don't mean good like it's a good scenario, but the best case scenario, I should say. Tell me about the geopolitical concerns and how you set up a portfolio for the next 6 to 12 months.
Yeah, right now, of course, it looks constrained, and but let's face it, we now have 2 wars going on, right? And we're entering a period where I think a lot of economists are looking at it from the standpoint of sort of deglobalization, right? This nice dividend that and the benefits to stock multiples, the benefits to inflation, to price control, et cetera, of having just a globalized world, lowest cost supply chains, right? And that's kind of going away. And this latest conflict, just is an extension of that, right? I think it will just increasingly move us more to a world where we're more concerned with individual energy security or security in general, right? Defensive, and I mean, country defense posture, and that is not necessarily conducive to better stock returns. So, that is absolutely in the mix, as you've said, and kind of goes in that bucket of as position from your perspective. Your question on positioning is. Look, most retail investors are going to have something that's similar to market, whether they're actively managed or they're just absolutely at market in a passive investment. The actively managed is not going to have huge tracking error. I would say to the extent that you're tracking error to the market, you're positioned a little more defensively. And by that, I mean traditional quality stocks, low volatility stocks, not because you necessarily, again, are predicting market problems. You're just, it's a more probably disciplined and comfortable place for the retail investor to be. And the big thing, of course, is having the appropriate amount of fixed income in the portfolio. That was, more painful in the last 10 years when you earned no income. Now at least you're earning income on that.
All right, Dana Dioria, thank you. InvestNet PMC. Thank you, Dana. Up next, it's the big 3. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes through the technicals.
Lichtenstein
takes us through the trades for Airbnb, Super Microcomputer, and Uber. That's next here on Trading 360. Be right back.
Here we go. Alright, this boy. Ooh, there's the pop from all that liquidity. Gap Philly. Taking a little profit here. See if we start to roll over now. We don't retest the same high.
I do think that it's holding that. And so I'm going to play that passively with an iron condor. Selling that support that we see at the 200-day moving average, and then selling a reasonable resistance, which is up at that 100. There's a confluence of resistance up above at that 150 and 20-day moving averages. So bullish, but also not too bullish.
The volume on that breakout is pretty crazy.
What do you think here, Ben, when you take a look at Airbnb?
Well, I did notice the 200-day moving average, Mike. We have seen some weakness as of recent, but Nicole, I think this is a situation where the bulls are just kind of waiting for that next bounce, and ultimately, and then we'll see some buying come into play here. But you can also see on the chart behind me some of that weakness I mentioned and how the stock's basically sold off from 150 down to 120. No rejection of this lower level as of yet, and as you take a look here at this trend to the downside, you can see it's pretty well defined. You're also going to see some of the areas of value that I went ahead and identified on this 60-minute candle chart. And as I mentioned here, we've been in a bit of a downtrend, so this is not necessarily something you want to get in front of, but we're currently balancing around this 127 level, and as long as we stay below 135, we're still in a downtrend. But if we were to take out 135, that could be the signal of a bit of a shift in terms of sentiment. And let me show you why I'm giving the benefit of the doubt to the bulls in this instance, because, yeah, a bit of a downtrend on the hourly candle chart, but take a look here. We've got a longer-term, high-conviction trade to the upside, sideways consolidation, acceptance of a big move up that we saw in June into July, where we topped out again around 154. So we are below the pivot level, again around 137, but I want to show you here in terms of how this is a key area. We've been holding right around, again, this 120 level. So potential here to see some movement to the upside would open up a door of a retest to 137. Strength there opens up a door for a retest to the upper extreme around 155. I'm also giving the benefit of the doubt to the bulls, because as we step back and take a little more time onto this chart, you're going to see that we have been and continue to be forming a very bullish pattern since the beginning of the year. Areas of value that formed higher and higher levels, and in this instance, as long as we're holding above 120, this is a very bullish pattern that's playing out here. Again, you can see the significance of this lower extreme. I did want to point to that 200-day moving average because Mike mentioned it, and you can see how, well, here it is. We're currently testing that longer dated,
a little more off
below
up
the
here.
50, the blue line, but yeah, you can see we're holding up on this key area of support, as Mike mentioned.
Might be starting to roll over.
Okay, thank you for that. And that's the key area. I know you're both on the same page with at least that part, right, Mike?
1 for 1 so far. Let's keep going.
All right, next up, Super Microcomputer, which has been soaring. This is a real winner year to date, up 251%. Tell me about this one.
Yeah. The same sort of pattern, but with more conviction to the upside. I think that this is one of these stocks that people want to go up, and And when they get that sort of sentiment, then we're just looking for value buys. And it started out the day right at this confluence of the 50, the 100, and the 20-day moving averages. And we've seen it has moved up a little bit today. So, I can kind of Monday morning quarterback, I guess that would be Wednesday morning quarterback, and see that support. It's a name that if things generally go well in the markets, this is going to do very well. It's also one of those ones that when things kind of go where, is the first one to be sold. But right now, like I said, there's this underlying bid to the market, and
there you go,
this
Spy.
is one of those names that can really run along with it. Everything fundamentals, what the sector that it's in, everybody loves it.
Right, understood. Okay, and then what do you think, Ben?
Well, we're seeing a reflection of that in terms of price activity. It has been loved. It's been a little bit more sideways as of recent, but I'm still in the bullish camp and going along with Mike on this one as well. I think there's a lot of reasons to be optimistic about shares of SMCI right now. As we take a look here, you can see high conviction trade to the upside basically from 228 over the last couple weeks all the way up to 317, and then you can see a bit more sideways since, right? I think there's a couple different ways of looking at this as we step back and look for these areas of value that form to help us determine if trend is present and if it continues to be. The recent weakness here, not necessarily what the bulls want to see, but still kind of holding above this 280 level, which I think is significant. And if you take a bit of a fatter crayon approach, step back one more time here, you're going to see that, well, I went ahead and just drew this as one larger area consolidation. Again, kind of sticking with that bullish narrative here, and the idea being that we're actually balancing around 290 right now. Let me show you why I leaned on the bullish narrative, and that's because, well, taking a look at the longer term trend, right, a very similar pattern playing out here. These areas of value that continue to form at higher and higher levels going back to the beginning of the year. Stock was trading down around 60, 70, and you can see again all the way up to that 357 level we just marked. You can also see the sideways consolidation currently balancing around 280. And in this instance, similar pattern, right? You can see how we've held some key lows right now. Actually, you could probably do that one more time right there around that 230, 240 level. Take another step away from this is a 4-hour candle chart. Let's look at some daily candles here because Mike mentioned here a very similar pattern, but even a bit more bullish. He said, well, I would agree with that. Our last example, we were talking about holding above an Airbnb, that 200-day moving average, well above it right now in SMCI. But take a look also above the 50-day moving average, RSI supportive of this move up. I can understand the bullishness here as well.
Well, Spy went from red to green there on that pop.
So the bullishness is okay for the moment, Mike. Any final thoughts there? And then get to Uber, please, Mike.
3 for the boys.
For Uber, that was
I
just
think
kind
some
of
for the homies. So what I've been doing is just stop loss to break even, but I've been moving the stop loss up so it's not break even, especially if I'm leaving a larger position size. Instead of just like one, I'll have 2 or 3 or 4 or whatever.
This is not a crazy bullish pattern.
If there's still like quite a bit of profit left in what I'm leaving out there, I don't want to see it all go away if it was break even.
And earnings, I'm not even going to play it. But I think that we probably.
But yeah, it looks like we might be starting to roll over the top here. I'm looking to exit some more.
Call calendar, we get to get that.
I'll just close some more there. Missed that exit on that pop. It's so slow. So slow.
Right. It's almost surprising when you look at how incredibly well it really has done and really popping on the last, well, at least the earnings that we saw in May. What are your thoughts here, Ben, when you take a look at Uber?
Well, earlier we were talking about Airbnb and how investors have been willing to stay with that longer term trend. It looks like with Uber, they've been riding this one out, that's for sure. Taking a look here at some of the weakness first and foremost, but still in a bit of a longer-term trend. Let's start with some of the movement. You can see a trend down in this instance over the last few weeks. We're talking from 50 recently down to 42.70, and limited in terms of rejection of these lower levels, right? We haven't really necessarily V-bottomed or taken out anything significant yet. Let me show you what's going on here, though, because when you look at some of the areas of consolidation that have formed on the way down, you can see the line in the sand, or next big area, if we are balancing around 44, is going to be that 45.50 level. Interestingly enough, you can also see how it was $1.50 from 48.50 to 47. We go sideways around 45.50, and then again another $1.50 drop if we start to balance a little bit more a rotational around this 44 level. I just kind of wrote this as a hypothetical as of right now, but still in a bit of a downtrend again as long as we hold below 45.50. But again, longer term trend has been to the upside in a very similar situation as the other two we looked at, where we've Mike mentioned kind of a bottom feeding type trade associated with this one. Well, you can see why. We've tested key support. We're in an uptrend. We're holding above the key level where the bulls would have to be concerned if we were to take out. That's 38 right now. I want to step back one more time and just show you what's going on. Again, longer term, but this is interesting because we had been in a bit of a downtrend. We always talk about the significance of these areas of value that form in terms of determining the existing trend, but they also help us determine when one is, or the prior trend is no longer present. In this instance, we were balancing at lower and lower levels. You can see this chart goes all the way back to the beginning 2021, end of 2020. So what we've seen here in terms of this move off the lows from last summer, a very well-defined reversing trend here right now as we've taken out a key area of 45 on the left side of your screen there right now. Pausing a bit here right now. This is going to be important for the bulls here, looking for that follow through to the upside to take out recent highs at around 50 and really solidify that bull trend we've seen off the lows from last summer, again around 1990.
Okay. Thank you for all those charts today, Ben. Amazing. Big three as always. Mike Shore, you get the last word here.
I guess my last word is that we are showing resiliency, which I'm a little bit surprised and I'm encouraged by. So buy those dips, at least for right now, until you're wrong, and then we'll pivot off of that. But the overlying trend is that dips are bought.
Right. Understood. And look, you got to stay nimble in this kind of market. I mean, we see the VIX today up at 1752. That's been gaining. So to your point, I understand. Mike Shore, Prosper Trading Academy, Ben Lichtenstein, thank you both for the big three today. Really appreciate it. Coming up next, we're going to spotlight some of the upcoming earnings reports. How about United Airlines? That's due later today. Plus Procter & Gamble and Tesla are due out tomorrow. All here on Schwab Network. 360 will be.
All right, EU closing 3 minutes. Got 13 likes on there. Thanks, guys, for your likes. Appreciate the support. I should do a trailing stop on these last couple. If we can break out of this kind of tapering range, that'd be pretty bullish. Be sad to close so many. bump back up into this more aggressive channel. Expecting it at this point, but could happen. There's a close.
You see this drag when it comes to their consumer or their retail business, and they continue to get a little bit of frustration when it comes to investors that really want to see them accelerate some of the sell-off and try to really focus on their core business that they've been known for over the years. And I think that's been one of the reasons why we are seeing the stock down not only just today, but over the last couple of months.
All right, thank you for that. And then we'll turn to a completely different sector, watching Johnson & Johnson, which actually spun off Kenvue right here at the New York Stock Exchange earlier this year. It came out with the numbers. I saw that the stock had been trading higher, has now turned lower as we speak. Tell us a little bit about what that story is there.
Yeah, definitely. So when they actually had their announcement here earlier today, we did see a nice little move to the upside here. That is because sales actually did increase around 6.8% on a year-over-year basis, and their operational growth also increased by around 7.5% on a year-over-year basis. But you continue to see a little bit of a drag when it comes to their orthopedic business, and that is actually what made them move to the downside, because they did announce that they are going to implement a 2-year restructuring plan. They will stop selling certain products within this segment. And that is also an area that they've been trying to really focus on here in the near term in order to, once again, kind of focus on their core business here. They did actually project double-digit profit growth in 2023 after the spinoff of their Kenvue business. So I think that was a bright spot. But once again, kind of a mixed picture when you're looking at Johnson & Johnson. And, you know, they have been able to hold up a little bit better because of some of this Ozempic news. But once again, kind of seeing these restructurings, a lot of these investors are just really not happy about that. And when it comes to not only just the medical care business, but also when we're talking about banking, Nicole.
Okay, thank you so much. Good to see you, Kevin Green, Senior Markets Correspondent. All right, time to spotlight a few names to watch. This week we have about 10% of the S&P 500 reporting, and so to help
There's
us
the top of that tapered range.
is with us, Chief Global Strategist, Freedom Capital Markets. Thank you for being here. First up is United
Retesting
Airlines,
it.
third quarter, getting ready. I saw, you know, obviously the year over year is up. What are we thinking here?
Yeah, well, I looked just last week to Delta to kind of give us some guidance here, and they said strong summer travel season. Demand is still there. Worried about fuel costs, and then the price action. The stock didn't really take off.
Okay, closing
take that back right now,
the last one from this morning. Both did 100%. It was given as a small position size for the morning.
To turn it around. It looks like it's starting to settle into a range. Delta didn't really lift like we hoped it would, but I think United Airlines could be the one that gets the sector to turn around. It's still up 5% year to date, even though it had a 33% drawdown from July. So
and the other one's closed also, the trailing ones.
You know, guidance from them.
And you still see consumer spending. I mean, you had the revenge travel theme, right? A lot of people who hadn't gone abroad were doing a lot. We saw summer travel season, but just even in retail sales today, I mean, just shows the behavior of consumers, and they are still spending. I mean, that's not to say we're going to see these planes loaded
I'll
over
be
the holidays.
trying to be patient and
we'll
slowly scale into puts.
on that. Next up, Procter & Gamble.
Yeah, Procter & Gamble. This is an important stock to watch. Why? Because it makes up 14% of the consumer staple ETF, the XLP. This is very telling because the staples, as the 10-year spiked, what got hurt? The safer stocks, the staples and the utilities. Procter & Gamble, from its August peak down, lost 17%. That's
Starting
a
now.
ridiculously big move in a stock that's supposed to be safe and stable. We saw it across the board. Pepsi, they released earnings last week. They didn't mention Ozempic. That's one thing I want to see if Procter & Gamble mentions, because Walmart kind of changed the narrative that Ozempic was going to affect its bottom line. Right. Are snack foods going to be affected? It got 2 downgrades last week, at least target price changes from Barclays and SC Bernstein, and they were worried about these weight loss drugs affecting their bottom line. Will they address it? I don't know, but technically,
And my stop is if it actually keeps going here.
Setup is there for a nice little
and open it as close to your stop as you can.
Going back to June's lows, and we can rally right into the 200-day moving average and maybe be above it, because I think it got down. The downside was just a little too dramatic. So let's see what they say on the guidance. And as you said, the retail consumer has been resilient, and we're not seeing that weakness that a lot of people have anticipated, so it could bode well for Procter & Gamble tomorrow.
Yeah, and I think we should also bring in the currency issue. UBS talked about that. Some headwinds from the unfavorable foreign exchange rates, rising oil prices, some of the things that are headwinds just for companies in general, for multinationals. Procter & Gamble, UBS saying that this fundamentally may be a standout among the peer group. But I think that point about the snacks, just going back to that, we've been talking about that for probably 2 months.
Break in there. All right, there you have it.
Finally coming into conversation.
So we're going to be retesting. It looks like the highs already.
Only time will tell on that, and I don't mean to be funny, but
this triple top that we had.
I mean, obviously, if the whole world's on these weight loss drugs, they're probably snacking less. It just seems logical, but I don't know the answer. Any final thoughts on Procter & Gamble? You know, there are still some pressures.
Didn't have any left for the homies. Because that trailing stop.
What has been the story with the staples, and we saw it with Pepsi,
and
Procter & Gamble's the same exact way. They passed on
their
costs
again.
to the consumer, and the consumer has absorbed it. The spending habits haven't changed. And,
yeah, this volatility right here got my trailing stop.
Forex, I think that'll be an interesting thing to see if they address that. But technically, the risk reward setup is there.
So this popped it back up into kind of that more aggressive channel.
In a staple like Procter & Gamble.
Interesting.
So I think we have the floor there. I don't see the stock breaking below the floor. It doesn't get overly volatile on earnings day, but right now that risk reward setup is favorable to the bulls.
All right. Last but not least, we've had some recent recalls from Tesla. Also, what will happen with all the subsidies for Tesla? But it has been a clear winner. It's off the highs, but still has been an amazing performer. We're waiting on those numbers this week, too.
Yeah, and we can't go into earnings season and not focus on the Magnificent Seven. And Tesla's the first of those to report. And as everyone that trades Tesla knows, it's one of the most volatile stocks after earnings day. Its last 4 quarters, it was down 10%, down 10%, up 11%, down 7% after earnings. So this stock is going to move. Technically, it's consolidating right around its 50-day moving average, and it's making higher lows and lower highs, and something's going to give. And what is that catalyst that's going to break us out of that range? It's going to be earnings, because it moves on average about 10% every earnings cycle. So technically, we see something's about to give.
Yeah, I say one for the homies. Normally I do a normal stop loss, but I did trailing stop on 2 of them, and then the one I manually closed. So
it drew down 28% from its all-time high, or its yearly high, and now it's starting to lift its head. If we see Tesla lead and break out and start to make a run towards 52-week highs, I don't think it may get there, but it will lift the rest of this sector, because you had NVIDIA, you had Microsoft, you had Apple, all have strong quarters. And what happened in price action? Price action decreased. So let's see if Tesla can have a solid Q1. Now, they have their own headwinds, as you said, with sales decreasing, lowering prices in some of their models. But if they can surprise to the upside,
still very early actually. It's only 11:30.
That bodes well for that fourth quarter seasonal
we could keep rallying today.
It'll be interesting to watch.
Don't necessarily have to reverse. You might see just a bigger pullback and a bigger rip, breaking the highs from here. We have the cup, we have the handle. Are they retesting it, rejecting, or it'll be a big break if we do break that. Pretty big resistance. I think before it actually breaks, it'll need some liquidity. So it should give us another entry long. If that happens today. Understand these stops or what? What's nice about SPY options is you can just do stop. You don't need a stop limit.
This was something they'd been talking about for months.
So stop limit's like you have a stop and you have a limit price. So basically once it hits the stop price, then it triggers the limit order. If you just have a stop, then it's that price triggers a market order. So SPY options are so liquid you can. I just stop market. I just do stops on them. I don't do stop limit. But that said, I do sometimes don't. I don't always get filled at my stop as it goes a little past it. So. But usually, unless it's quite volatile, usually it's right at my stop. Depends on which way you were going, but yeah. So say if your contract was $100, and it's, or you bought it for 100 and now it's worth 200, you can put a stop limit. You put a stop price of $1.50 or 150, and then put your limit price at $1.48. Be below it. Once it gets to $1.50, it'll trigger the stop, and then if or $1.48 would then get triggered too, because that's below it. As long as it didn't gap below that with a lot of volatility. But I usually don't do stop limits. I usually just do stops and then market orders. But that's because I guess I mostly just use these on SPY options. New high there on SPY. Whew. I was gonna wait for a pullback and get out of these puts, but not ready. Doesn't need it. The 437.33 is the high from this triple top.
Solutions, which is basically
position size. That's why you want a starter position. My position size on this one was pretty small.
That, of course, Zscaler, for instance, is a company we've covered.
That helps me hold through this.
And if you look at the growth for CyberArk, considering last year they grew about 20% sales growth. Their growth is expected, and it hasn't been adjusted based upon what's going on in the Middle East right now, but they're expecting to grow their sales at 23% and earnings close to 30% in the next 4 quarters. And I can see why JP Morgan's upgrading the stock, because the fundamental profile of the business is improving. But if you look at the stock relative to some of the other cybersecurity names we've covered versus Palo Alto or CrowdStrike or even Zscaler, you will notice in the last 30 days or so that CyberArk is flat relative to those other names, which are all about 10 or so % higher in the last 30 days, because there seems to be a trend going on with perhaps geopolitical risk, but at the same time, enterprise spending, especially cybersecurity, is going to be in high demand going forward, because you have to think about the threats that artificial intelligence can create from the standpoint of cybersecurity breaches.
Yeah, I mean, there were concerns about some of the names like Checkpoint, CyberArk, the ITEQ, Exchange Traded Fund, which tracks Israeli cybersecurity companies, so people can follow that as well. And that's what we were talking about last week. But now, to your point, catching an upgrade, that's some good news to an overweight. Tell us more about how you would go with an example trade here.
Yeah. So, I mean, looking at, like I said, in the last 30 days, I look at the market as approaching it as sort of a wait and see kind of way about it. In other words, it's really just trading sideways. And they do have earnings coming out on the 2nd of November. In fact, if you look at the estimates, it's 23 cents of an adjusted profit, and that's considerably higher than the 6 cents loss of last year. So the earnings profile looks positive, but I think the shares are being weighted down because of what's going on in terms of the tension in that region. So we can still participate, but we're going to play this in sort of a modest capacity. Now, if you look at the chart on the daily, there seems to be a congestion area around 160. So I'm going to go out to November, which is going to expire post-earnings. This is the 3rd week in November. We're going to sell a 165, 155 put spread. So we're selling the 165 and buying the 155 put. Now, altogether, you could earn about $3.25 a share, or $325 a contract. So effectively, if the stock holds 165 or higher, that's the sweet spot, because the premium will erode to zero over time. Break even is a 161.75, forgive me. And then again, max loss, if it hits it, is 155 or lower. But ideally speaking, looking at that short put that we're selling at 165, the delta on that is about 30. So that implies a 70% probability that it'll expire at or above that between now and expiration in the 3rd week of November. So it's a play on probabilities, and the way the price is acting more in a sideways capacity, that's why I structured this trade in this way.
All right. Thank you for that. Really appreciate it. Today's disruptor, CyberArk. Thank you, George Silas. Coming up next, we'll pivot from cybersecurity straight over to the defense sector. Our panel is ready to take a look at Lockheed Martin, which is up about 2.5% now after the quarterly report. Let's break that down.
You hi there on Spy. Oh, Etsy's had a nice bounce there. Up 4.4 today. They have earnings on the 1st. I did like Etsy at these prices. Wait for earnings. That at 437.22. Pretty much. That's the high from this triple top. Ooh, busted through there. New high. Broke that range. Wow. The homies are happy. This was quite the move from, I closed a lot of them right here on this right shoulder. Have patience. Patience.
Well, it's interesting because Lockheed Martin, did very well when Russia invaded Ukraine, and there was a spurt up, and then it came back down, and then it happened again recently. But I just don't like the company or the industry itself, because we have a lot of money that is going to start to dry up from the U.S. government. 70% of the income to Lockheed comes from the U.S. government, and the U.S. government, last time you looked, they're $33 trillion in debt, and they're going to start cutting back on budgets. So I'm not a big fan, even though they're one of the better
tapering,
players
so that's why I closed.
in the defense contracting business. I'm just not a huge fan of the sector itself. If I was forced to buy something in the sector, Lockheed is selling at one of the lower valuations at this point.
Right, understood. I mean, when you check names like Lockheed Martin up 10% this month, Raytheon's up 4% this month, and General Dynamics is up 10%. Your thoughts, Lee Bowl? We did see the details from Lockheed Martin in particular. What stood out to you?
Well, I think what stood out to me was their margins got cut a little bit. And one of the reasons is 62% of their contracts are fixed price. So they can't pass on the costs, and inflation is picking up. So that does decrease their margins a little bit. So that was the first thing I picked up. The other thing was just what Ed said, that, we had a nice spurt up, but we fell back and reversed the entire move on the Ukraine-Russian situation. And I think it's unrealistic to think that we're going to have an immediate spike in some of these, just because defense contracting is such a long process that any increases in budgets are going to take a while to filter down. So I think that it's good that they beat a little bit of margin pressure, though, but they're still a major player.
Right, understood. And so with this, at first we saw these names moving higher. And as I said, look, month to date, they're winners. But the takeaway here is a lot of this is ground warfare. There were articles that the Israel-Hamas war not seen boosting the defense companies. Ed, to your point, I mean, ideally, don't we think that the U.S. is going to be moving money into our military and our safety? But you think that Lockheed is the best position of the group, but just you wouldn't touch any of them, really?
No, I would not touch any of them. Anytime you have the source of your funding getting weaker and weaker. It'd be like owning a high-end restaurant in New York and then finding out that most of the wealthy people were having less money. They're going to stop going to that high-end restaurant. And that's what's happening with U.S. government. There's just not, that impulse and that much more money. And also don't forget, about 70%, if I'm not mistaken, of Lockheed's business is airplanes. These take a long time to build. I mean, there's a long leeway that you have to really look into. So this is not something that's going to just turn around on a dime, and all of a sudden you have this money and they're going to start to get these big budgets, and you're going to start seeing a lot of airplanes being developed. I mean, they take 3 to 5 years to build, if I'm not mistaken.
So we talked about a lot of the negatives. I mean, even though the company did reaffirm guidance, Lee, you mentioned earlier, with inflation that they're not able to pass on some of the costs to those contracts because those contracts are set, right? 60% of them are set. But you do have some potential positives. So let's give folks something to sort of chew on here on the positive side.
Yeah, sure. So the book-to-bill ratio is still very strong. So they have, decent backlog going forward. So that's it. Also, Ed's, is saying that the defense spending might be cut. That's probably true, but in the short term, the forecasts are for a 5 to 6% growth in the defense budget from 23 to 25. The 10-year trailing average of defense gains is only 1%.
Breaks are a good thing.
At least in the short term of the next couple of years. The other thing is they've been very generous, if you will, with providing cash to shareholders. They bought back $1.8 billion worth of stock. They raised their dividend, granted by not as much as they had previously, but they have potential authorizations for over $13 billion going through. So there is that as a positive as well.
Thank you. Thank you both so much. Ed Butowski, always great to see you. Chapwood Investments and our own Lee Bowles, CMT at Charles Schwab. Thank you. I'm Nicole Petalides, live on the floor of the stock exchange every single day here on Schwab Network. I'll see you at 2 o'clock. Fast Market is next.
See if we're building some liquidity to keep rallying here. The tapering broke out of the tapering, so I was pretty bullish. And now we're trading, broke out of that. So we're either going to end up with a wake up here, or we're going to find support and keep going.
When I look at the other asset classes, I would say, oh, yields are up again. We're going to get hit.
Do not get in between the U.S. consumer and their discretionary income, Tom, because this is I'll tell you what, this is a powerful statement that the market's making by coming back here, led by the Russell 2000.
Right, which has been
was
underperforming.
the first to go positive,
yeah.
Right. So remember, in the last 10 days, 3 of the 4 indices are up. The Russell's the only one that wasn't up. So for that to lead the way here, that's another leg. But remember something. This is a market. What would we be doing if there wasn't geopolitical risk everywhere where it seems out there? I mean, this market is telling shorts, be careful here. You know, there's risk out there. And there's risk of escalation, and there's a lot of risky things out there. But the U.S. economy, holy cow. These numbers, not only the numbers that they put out for retail sales, but the revisions, powerful.
Yeah, it was a double whammy to the upside, and it marks that resiliency that we've seen
I got some calls
from
there.
the consumer, lending some
Hedge
support
my
to the
puts, I
economy.
guess.
But to help us break down some of those numbers, let's bring in Caroline Wood, Senior Markets Correspondent here on the network. Caroline, as Kevin mentioned, retail sales better than expected. And it seems like, we're pushing back against higher yields because the consumer's able to kind of digest it at this point.
And the consumer is able to keep up with inflation and outspend it, essentially, because headline CPI came in at, 0.4%. And the latest read on retail sales, which is not adjusted for inflation, saw a 0.7% uptick in September, more than double what analysts or economists were expecting at 0.3% increase. We also saw it was an uptick from August's level, but also we saw the previous 2 months revised higher as well. So the 0.7% uptick was the headline number. Excluding autos, it still was up 0.6%. Excluding autos and gas, also 0.6% uptick. And breaking it down into categories, we really saw broad-based strength from the consumer. Miscellaneous store retailers up 3%. Online sales rose 1.1%. Motor vehicle parts and dealers also saw a 1% increase. Meanwhile, food services and drinking grew by 0.9%. That represented an annual increase of 9.2%, the strongest category there on a year-over-year basis. In terms of declines, we did see electronics and appliance stores down 0.8%. Also, clothing retailers were down 0.8% as well, and furniture sales were flat. But overall, some pretty broad-based strength, and it's just the consumer continues to surprise us despite some of the headwinds that should only continue to tick up as we head into year-end. Now that student loan repayments are back in place, that could continue to stretch the consumer a little thin, and obviously we have savings rates that we're hearing about. Those are lower. Credit card balances are higher, but consumer is keeping up with inflation.
Don't always get those.
Shopping season. Caroline, should we be so surprised by this number? Because think about all the labor negotiations going on right now. Think of all the different ways that wages are staying stable or going higher. And wages, higher wages leads to more discretionary income. More discretionary income leads to more retail sales. Isn't it just that simple? We should expect the consumer, 70% of the U.S. economy, to keep up because they're all making more money. If you have a job, you're making more money. Big firms we saw in the last report are laying off, but small businesses, medium businesses, all hiring, leisure and hospitality, big numbers. People have more money in their pockets, Caroline.
Anecdotally, I certainly don't feel like I'm making more money, and I know a lot of people in my life, the teachers of the world, they certainly don't feel like they're making more money, and they definitely, I have a lot of teachers in my life, and I know that they feel like they're very much being stretched thin. So I think the resilience in the consumer, to me, is surprising. It's interesting. I was part of a conversation recently with Daniel Boulud, one of the top chefs here in New York, and they were asking him about inflation. Obviously, we're seeing it moderate, right? And they said, you know, are you feeling the moderation? And he said, absolutely not. Not in terms of food, not in terms of labor, not in terms of, he said, maybe it's stabilizing. But he even said, you know, and he runs some of the biggest restaurants here, that he's not feeling what the economic data is showing. Obviously, wages are a key component for them as well. So potentially there are people out there that feel richer. I don't necessarily know that that's necessarily the consensus, and I don't think that this necessarily bodes well for the Fed in terms of, you know, I think it could complicate things, especially those people who think the Fed is actually done with their rate hike campaign, because it certainly doesn't show any need for the Fed to actually loosen policy anytime soon based on this data. I will say I was taking a look at the CME FedWatch tool, and it's interesting because the expectation is for 88% chance of the Fed being on hold in November, 39% chance of a hike in December, but actually a little bit higher of a chance, 41% chance of a hike in January. So, you know, it's kind of interesting to see the percentages increase on the heels of this. And of course, we're seeing, as you said, the yield on the 10-year tick higher. And I think that's likely because this kind of supports the higher for longer scenario.
Yeah, and that on top of jobs data being robust, people aren't losing their jobs like everybody thought. And hey, Caroline, I just was at that Bar Boulud in the spring. Pretty good restaurant. I'm not going to that Daniel place, although I don't think you can get reservations anyway.
Well, maybe I can put a good word in for you. Danielle was giving me some cooking tips, actually, because I'm going to be switching to an electric stove. So I you know, probably won't be going to his restaurant as much, given how much I'm paying in rent. But maybe Kevin can, because, you know, the wages just keep ticking higher for you, Kev.
All right. I know. Gauntlet thrown. All right.
Wow.
Thanks to Caroline Wood, senior markets correspondent here, breaking down the data for us.
Shots fired.
Yes. But now let's bring in Randy Frederick, managing director of trading and derivatives at the Schwab Center for Financial Research. Randy, you know, you heard probably some of our commentary here. The consumer remains robust. Jobs data is still, you know, doing really well. Wages are still rising. This is all based on, you know, the consumer still being resilient at this point. But then on the other side, you know,
that's hilarious.
The kickoff to earnings season's gone pretty well so far, right?
Yeah, and I think you guys were covering what I think is a really critical point that oftentimes gets overlooked, and it's the difference between attitudinal measures and behavioral measures. If you ask people how they feel, they're grumpy, they're unhappy, they complain all the time. If you ask them, are you still going out to restaurants? Well, yeah, but they cost a fortune. So their behavior has not changed. I know everyone says they feel the pinch of inflation, but what we've seen, as Kevin pointed out, with the consumer driving 2/3 of GDP, we got a GDP estimate coming out here in a couple of weeks. It's going to be 2.5%. That isn't even close to recession territory. And when you talk about incomes, the hourly income year over year is outpacing inflation at the moment by about a full percentage point. So, I mean, the truth is, I think if prices were flat and people and wages were flat, people would be in a better mood than if they're earning a year, 1% more than what the actual inflation rate is. People's attitudes, when you take some of these sentiment gauges, are horrible right now. But I think it's just something about inflation that people don't like, even if they are truly keeping up with it. So it's a very fascinating thing. Yes, from an earnings standpoint, but this is important because this happened previous quarter, is that every quarter when we start earnings season, The first companies to come out are the financials. And if it has been a good period of time for financials, which it has been, the early reports at this point, we're only about 7% of the way into the earnings season, are spectacular. The number of companies that have
I'm out of those
the
calls.
expectations. Last week there
Oh,
were
wait,
12
it's
companies that
building
came
up
out.
liquidity.
11 of them exceeded
Had
the
the break,
expectations.
but I didn't.
This week we've had a handful of them. They're
Didn't
doing
exit.
extremely
Good
well
spot.
also, and it's primarily in the financial
Still,
sector.
over
I know
trading.
the financials complain a lot because of these high interest rates, but the reality is it allows them to widen up that spread between what they charge for people who borrow and what they pay for people who save. Now, their long-term portfolio of holdings may look terrible right now, but if it's hold to maturity, it doesn't really hurt them in the near term. In the long run, they'll get that back at 100%. And so that's why some of these stock prices have been depressed. But overall, the incomes when the interest rates are wide is actually a little bit better in the short term.
Yeah, and
So
you
it'll
wonder
truly
if,
be a
lot of
trick or
these
treat
companies
for
are,
barbecue shareholders.
trying to figure it out as far as efficiencies go. Because if you look at some of the comments from Bank of America, CEO, he said consumer spending's down a little bit, lending's down, but it seems like they're making more efficient decisions. Goldman Sachs relatively flat today after their earnings. There weren't expected much. I was pretty surprised on the headline numbers that this stock didn't pop. But Bank of America having a nice day. LMT, Lockheed Martin having a decent day. Johnny John's relatively flat.
I think the Bank of America and Goldman earnings were fascinating to look at the different headwinds and tailwinds that both have. Bank of America had a great quarter. Their problem is they have a $131 billion bond portfolio that's not hurting them. Hold to maturity isn't going to hurt them, but hold on a minute. It takes away their opportunity to put that money to work in better places.
That's what I was just going to state.
They're stuck in small returns. Goldman's got a different story, right? They're trying to exit all these consumer-facing businesses and get back to what they do well, which is IPOs, which is mergers and acquisitions, which is raising debt.
Trading,
I mean, they want to get back. They want to get out of Marcus and Green Sky, and they want to get all those done and get to the better places, but get back to what they do well. But Bank of America did well, except for this opportunity cost that was lost because of their bond portfolio.
Yeah, but remember, a lot of those stocks.
Officially though, Tom, that's a mistake.
Right.
That's a trading mistake. They put too much capital in those bonds too early.
Yep. And that's you bring up a good point. It's opportunity cost lost at that point, but they're resilient enough where they've been beaten down.
Right.
Where maybe they were oversold at that point. You're getting a little bit of a relief rebound, even though they have that on their balance sheets. But Randy, you looked at the other data points today. That's a housing market index. 10-month lows on that one, ticked down 4 to 40 in October. I mean, give me your take here on this particular sector, because it seems like they've come off recession highs over the last several months. They're popping a little bit today, but it just doesn't seem like there's volumes moving around with interest rates at the levels they are and the mortgage rates above 7.5%.
Yeah, it's absolutely true. And in fact, I would say the housing sector has held up better than you would have normally expected given the rapidity that interest rates have gone up. It's only recently that we've seen a pullback. I mean, just literally probably a month ago, the top performers, every single one of the housing stocks was going to the moon. Every one of them was outpacing the S&P 500. And we've only seen a little bit of weakness here just, when we get to 30-year highs on mortgage rates. But it's that we talk about housing markets are always a buyer's or seller's market. It's really not either right now. Yeah, it's a seller's market if you can get somebody who's comfortable coming in and paying cash, which is not very many people, or if you've got somebody who, is willing to get a 7.5%, 8% mortgage. Nobody's really all that crazy about that idea. But we still have in our back of our minds that period of time just a year or two ago where we were selling our houses above asking price and were unwilling to lower that. But you also have a dilemma because the vast majority of people who sell houses are then going to buy another house. If I was to sell a house when I've got a 3.5% mortgage, now I'm stuck because my next house is going to have a 7.5% mortgage. That's really challenging. So one of the alternatives, of course, is to go to an adjustable rate mortgage or an ARM, but the ARMs have not been priced all that favorable. And if we do have higher rates in the next few months, I don't think we're going to get any more hikes this year, but I think there is a probability we could get one or two early next year. Those ARMs are going to adjust higher, so you really don't want that either. There just aren't a whole lot of good alternatives right now. Probably the best scenario is that if you're a buyer, You buy a brand new house from a builder who has an incentive to give you a below rate market mortgage or to cover points or closing costs or all these different things that they can do to make it a little bit more enticing. But for existing homes, that's just not there. And the market's just kind of frozen right now until we get at least somewhat of a pullback in these mortgage rates.
Yeah, I priced out what I would have to pay today on a mortgage where they currently are, about 7.5%, versus a year and a half ago when I bought, a little over a year and a half ago. It was ridiculous. The payment, how much it went up. Yeah, so I get Randy's point here, Kevin, that it's dried up. The existing home sales market's dried up a little bit due to those higher interest rates, but there's still inventories are at record low levels.
Right. The housing discussion is a fascinating one because we are still behind in supply for housing. Yeah. So the demand is always playing catch up, and people go to the sidelines and they come rushing back in. And I think I'm interested to see, based on this move in interest rates a week ago, what mortgage apps will be tomorrow morning. Yeah. I imagine they'll have a jump in mortgage apps.
Yeah, we'll have to wait and see, but we've still got the 10-year above 4.8% at this point, so still higher yields, but not hurting the equity market today. NASDAQ just popped into the green only slightly, so pretty spectacular rebound here that we've seen today. All right, let's take a quick break, guys. When we come back, we're going to take a look at NVIDIA. The AI chip maker is under pressure today after the U.S. Department of Commerce announced today that it planned to curb the sale of more advanced AI chips to China. Fast Market's coming right back.
Yeah, average down on my puts there, mostly just to get better price, and I'm not necessarily thinking we're going to be reversing up here, we could just bulls could build liquidity. So I'm just trying to get a better price to exit or hold if we are starting to reverse. AMC at 8.25%. Or at 12.5.
So I'd be a little bit careful with that. When you're the current leader, everybody's gunning for you, but it's not necessarily the easiest thing in the world to do. Again, I'm just kind of talking about different things that are going on. You're right. I think a point you made, which is critical, is that even if they are restricted from government intervention from selling in China, the demand for what they produce is so high that they can't keep up. So does that just simply give them a little bit of breathing room, and now they have the opportunity to sell to all the other people who domestically and in friendly nations that want to buy their products? That's something we need to think about. I don't know. I'm not sure if that's the case or if it isn't. When you get news stories that causes stocks to move down like this, generally the initial reaction is a little bit overdone. As you mentioned, it's $20 off of the low of the day. So obviously the knee-jerk reaction of panic is gone already, and it's bounced back a bit. But the thing about a stock like this is it's very expensive. It's very volatile. If you're going to trade it, you got to be really careful, really nimble. And I think probably the most important thing of all is to have risk-defined strategy, because if you're wrong, you can get clobbered. So I think you got to be very careful with this thing.
Yeah, the last couple earnings, well, not this past earnings before, kind of reflected that when the stock moved about 3 standard deviations higher.
I don't know why you have to bring that up. I don't know why you had to keep opening that wound. But the old double calendar that went whoosh.
Yeah,
right
exactly.
By.
Staying risk defined, really key in this name. Beta of over 1.7. So that's compared to the S&P 500, which is a beta.
All right, thanks. You too, man.
As Randy noted. But Randy, they're
Lovely
restricting the A800 and H800 chips. These are the ones that they initially allowed China to have. They're a slowed down version of their other one, the H100, that's allowed for sale here. When you look at the implied volatility expanding a little bit here on this, how do you want to look at this from an example trade perspective?
Well, so I would just take into account some of the things we were just talking about, which is that it's very volatile, it's very expensive, it can have huge moves on any given day. So risk defined is important here. As you talked about, well, actually we didn't mention this yet, but this company doesn't follow a standard quarter, so the earnings are not due out until November the 21st. Obviously, you could do a trade out that far, but again, it's pretty treacherous to trade this volatile of a position for a really long period of time. So what I thought was, let's just consider that this is a big news item. It may or may not have a material effect. The bulk of the response, as we talked about, is probably over right now, unless another news story comes out about this, or there's additional restrictions or something like that. As you mentioned earlier, Kevin, there's some backdoor ways where they can still do some of this stuff, and we know that's going on. It's been going on all over the place. So what I thought was, let's do something where we just stay really short term. We're very
Those are the puts on that break.
And we try to capture the benefit of that.
I don't like the best reward for calls
which makes
this point.
These options really expensive. So what I put together here is, you can call it an iron condor. Technically, it's an iron butterfly, where you're trying to predict that the stock will stay within a particular range. Obviously, today's range has been huge. But because this is so expensive, you can actually do that. So let's look out just to the end of this week. So we're talking about only a 3-day strategy. We're getting a big goose in the value of these options because of this implied volatility that's going on. So I put together an iron butterfly where you'd buy the 405 put that expires at the end of the week, sell the 435, then sell the 435 call, and then buy the 465. So what this does is it will bring in a credit, believe it or not, of $14.50. This is a 30-point wide iron butterfly. And because it's a 1450 credit, that means your maximum loss on this one is 1550. So it's pretty much about a 2-to-1. But the range that the stock has to stay in is pretty doggone wide. We're talking about almost 50 points from 420.50 to the downside to 449.50 is your break-even range, or anything in between those two levels is profit. In other words, those are your break-even levels. If it breaks outside of those levels and goes to the extremes, which would be below the 405, the lowest strike, or above 465, then you'd obviously get into that max loss range. But
8.8 on AMC.
A 50-point range here, and we're only talking about 3 days. Now, I know it had a big move today, but this is about in the middle of that range. If you look at the technicals, you'll see that there's some pretty good support around 405, and there's some pretty solid resistance up around that 470, and then a little bit more also around 440. So essentially staying short term, because this thing can swing a lot, but then we're just trying to forecast what might happen over the next few days and capture some of that premium. Because what we've done here is we've sold a credit call spread, and we've also sold a credit put spread. So we're basically selling the legs that are expensive, which have high juice, that they're going to lose time value very quickly as we approach the expiration at the end of this week.
Yeah, let's break this one down. October 20th weekly cycle that expires in just 3 days, as Randy mentioned. Selling a put vertical, selling the 435 put, buying the 405 put.
I don't
selling the 435 call, buying the 465 call, short $30 wide, neutral to slightly a little bearish now because the stock's moved up to 446 at this point. Collecting 1450 credit, Kevin, that's above $16 right now because the stock has moved higher and moved above that short 435 strike call. It's a neutral strategy. It's risk defined. If you collect 1450, you got $1,550 in risk on this one, but it's actually getting better, improved in price, but your probabilities are a little bit worse because it has moved up. Give me your take here. Randy's looking for some consolidation on this example trade.
Yeah, your risk on this trade is the width of the strikes, which is $30, minus whatever you sell this for, and it's moving all over the board. So, but this is one that collects theta, and you're playing for, it can move back and forth, but as long as it eventually makes it at or near that 435 strike, and you've got, like Randy said, based on the premium you collected, you've got a little room for this, right? A lot has to happen for you to officially lose money, but we all know that NVIDIA can move. Yeah. So the risk is defined, though, as you know. So it's one of those spreads that you want time to pass, and you want this stock, the movement, to slow down.
Yep, and as you get closer to expiration, that theta number or time decay picks up steam pretty heartily. And as Randy mentioned, those break-evens just below 421 and above 449 on this one. Probably a little bit better pricing on this, but a good look at an example trade here to take advantage of after the move, higher implied volatility on the move down, where you take advantage of those expanded option premiums on this neutral strategy. All right. Thanks to Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research, for joining us. But coming up after the break, Kevin and I are going to be joined by Landon Swan from Mike Bolio for discussion on United Airlines and the sentiment data on the stock moves. The company's seen its stock plunge over 30% in the last 3 months since hitting 52-week highs. Reports earnings after the close. Stick around.
New high there on SPY. SPY. Wow, we've come quite a ways from when I close my calls. I gotta leave one for the homies. Gotta leave some for the homies. Those would have gone crazy. Grab some more puts there. The starter. Got burned last time, so be careful. Break up this channel and I'll be adding to it. Very early, only 12:30.
All of this, because like you said, I mean, there's kind of a trade-off between, you know, supplying all of that demand and getting the price that you want as an airline, because we've all seen what happened to airline prices over the last couple of years. They've gone up significantly, and it seems like every plane I get on is full, where it used to be kind of half full, and I think they've kind of figured out the recipe for success here. But I will tell you that mentions are strong. They're up significantly on a year-over-year basis. Actually, web visits are up as well on a year-over-year basis. They're actually up. United's web visits are up more than any of the other airlines. They're all up, the big four, except for Southwest, down just slightly at -3%. Here we've got the mentions count, and you can see this is, you know, mentions, people talking about United. It's up about 40% on a year-over-year basis. Not surging right now. It's just a lot stronger than it was, and it's kind of holding. A little dip over the last couple of weeks, you can see there, but it's still holding at pretty good levels while the stock is very, very low. So this is a bit of a divergence opportunity, a divergence play here where the stock doesn't exactly match up. Now, of course, there's a lot that goes into an airline stock price. It's more than just consumer demand, but like Folio, that's what we can measure. And generally speaking, it's been a pretty good predictor, but it's not perfect. I will say, when you look at the web visits, like I was saying, United is leading the way. They're up about 18% on a year-over-year basis. Delta right behind them at 17, and American at 11. Southwest is the only one that's negative. And I think, again, we talked about this before. This has a lot to do with them dropping the ball last holidays. So we've got, you know, winter coming up. Hopefully United handles it well. I know that, you know, Newark is a big one for them, and they've got to be able to make sure they handle the weather up there in New Jersey, and hopefully they can handle everything that's coming their way. But the data is showing us that United is doing really well. This is not my favorite airline. It almost pains me to say it. I've only had negative experience with them. I avoid them pretty much personally, but you know, you're not here for my opinion. You're here for the data, and the data says that United is doing extremely well, and we're looking at a potential bottom here on this stock, and heading into this earnings report, we're actually positioning ourselves to be fairly aggressive to the bullish side.
Landon, I've said this on this show before. Airline stocks are volatile in normal times, right? We're in highly abnormal times right now, but everything about United's numbers are doing extremely well. But there's this one word that really poisons, not necessarily an airline, but the stock of an airline, and that is capacity. And capacity, year over year, Tom, up 16%. capacity. And when you hear that word, and when stock traders hear that word with any of these airlines, they hit the stock on capacity numbers. And so the fact that they held capacity low for a while and now are adding it by almost a sixth, if you think about it, that's how can they turn that around? Do you guys follow capacity data, or are you just pure web visits, things like that? Because you're right. I believe that every airline has their spin on the wheel where they're unpopular, but United has remained popular for a significant period of time.
They have, and I'll tell you what, yes, we primarily measure demand, but I would be very interested to know what those capacity numbers are on a year-over-3-year basis. Like, what was it pre-shutdown? Because I know that so many flights got not just canceled, but like those legs got eliminated during COVID, and it seems like they're really taking their time to bring them back. And so I'm not personally as scared of a plus 16% on a year-over-year basis, because I'd like to see the data. My gut is that we're not where we were 3 years ago. But again, I don't have that data. So if you have it, let me know if I'm wrong. But I know that the demand's there. We talk about this, this is kind of like the Tesla argument, is you can find a lot of things wrong with that company 5 years ago, 10 years ago, but everybody wanted one, right? Everybody wanted one of those cars. And so if you have the demand,
AMC new high there, 9.7.
With these companies, with
I'm
airlines,
back up.
especially United,
All those losses
right
from the
now
other day.
They've got the demand. People want to fly. People are talking about flying, and that's a good situation to find yourselves in. They're going to find a way to turn that into profit, and whether that's if they get a little greedy and they increase capacity to try to make more, okay, or if they keep it tight and they increase prices like they have in the past. Either way, I think it's a good problem to have, is people want to fly in your airlines. And what we're seeing, again, is pretty strong numbers on a year-over-year basis for both just social chatter and web visits.
Yeah, and if you go to those mentions and you overlap it on that chart that you've got there, Landon, I mean, the stock sold off pretty significantly. Kevin mentioned the capacity issues. Jet fuel prices are going to come into play here as far as margins go. But when you look at that, does that tell you that your data is kind of ahead of the game here, where the stock price is selling off unnecessarily, but at the same time, as Kevin mentioned, there's still a lot of headwinds?
Yeah, so that tells me that it kind of confirms that we don't track everything with airlines, right? I mean, this is not a retail shop where the number of people that go in equals the number of times the cash register rings. I mean, it is not a one-to-one. There's a lot more that goes into airline stocks. It's not our strongest sector like Folio. However, the data has been fairly predictive in the past. It's murkier, but if you've got the data on demand, it's definitely an advantage. And the fact that demand is holding and increasing while the stock is selling off puts me in the bullish camp, because this is, if the stock was basically where it was 6 months ago or 3 months ago at those highs, I'd be pretty neutral on it. I'd say, yeah, it makes sense because the data is strong. But given that consumer demand is strong and the stock is sold off, all else being equal, we're extremely bullish. But knowing that those other things, that all else is a little murkier, and there's a lot of things that nobody knows. I think that our guess is as good as anybody's on those, because the market clearly doesn't understand it. So that information is not out there. So with what we do know, consumer demand, I'm betting bullish.
Yeah, and I think you guys were bullish on Delta too, but sometimes it doesn't matter, as Landon made that point.
It doesn't matter unless you're Southwest. Then it matters.
Yeah, maybe a little bit there. Yeah, they might have some trouble there. All right, thanks to Landon. Landon, appreciate it. Thanks for the data.
Thanks, guys.
All right, that's Landon Swan, co-founder at Folio, bringing down the data for us here. Kev, you look at this, 30% slide.
I know.
TSA numbers are the same and a little bit higher than they were in 2019.
And all the numbers they're putting out are all stronger. They raised the full year from 10 to 12 to 12 to 11. They're tightening up everything. All the numbers are good, but that capacity number, man. Do they just hammer the stock? I don't know if they should. I don't know why. But all I know, Tom, in my career, they always do.
Yeah.
If you see capacity going up, they hit the prices of the stock. And capacity's going up across the board, across the industry.
Yeah. And Delta said the same thing.
Yeah.
Capacity going up a little bit, but jet fuel prices are going to dig into their margins, and a lot of analysts have come out recently and lowered expectations. That's why you've seen the stock, a slide in the stock, that, hey, their margins are going to get hit by these higher oil prices, which leads to higher jet fuel prices for longer periods.
One positive thing there, United Airlines ordered 187 Dreamliners with options to buy 100 more. They use 25% less fuel than the 767 or the 777. So more efficient jet engines are on the horizon, but they got to get them.
Yep, that's true. All right, so you got an example trade for us here, Kev. Break it down for us.
Use Likefolios data, use the overall look of the stock. This is it's in the diagonal family, Tom, but it's really a stock replacement strategy. Why would I go out all the way to January, Tom, 94 days to do that? Because I want to basically look at something between 65 and 70 deltas, something that imitates the movement of the stock, and then sell short-term options in the event week against that, Tom. And so I bought the January 19th of 2024 38 call, about a 65 delta. Sold this week, October 20th, 42 call, right in line with the expected move, Tom. And when you line that up, it comes in for about a 440 debit. Now, you look at a $4 spread, $4 diagonal, you're paid in 440. Yeah, but you've got 94 days in the January options to make that work. So if you want a less debit, if you want, not as further out, move that date further up towards expiration. You can move it to one of the closer options, and that'll take some of the premium off that. If you want to hold this for long term, like the stock, out till January, 94 days.
Yep. Let's look at this example trade Kevin brought us. January 2024 38 strike call. It's got the higher delta. It reacts more like the stock, the higher the delta is. Buying the 38 call, selling the October 20th monthlies that expire in 3 days, the 42 strike call.
Being that my trade is a reversal trade,
bullish call
probably won't
diagonal, paying roughly.
add to it on a breakout. I'll probably wait for bouncing more liquidity, retesting of highs.
For this example here on the risk profile, takes your break even to about 39.30. Your risk is the 420 debit that you're paying on this particular spread. With that ability to roll that short 42 call repeatedly over and over again, if the market's open, liquidity is provided where you can adjust it and collect some more credits, which might increase your potential profitability and lower that break-even point. But definitely a bullish trade here, Kevin, on UAL. It's a lower price stock, not a ton of option premium. But if you think this is going to move that $2.10 move that the option market's pricing in post-earnings to the upside, this one takes advantage of it.
Yeah, and the question that one of our viewers might ask is, why do you want to go so far out? You're just paying more premium. Well, because the theta is almost non-existent in an option that far away. There is negative theta,
Oh,
but
I got
it's
it
smaller,
straight.
so
Nice.
it adds more positive theta to the net position. Remember, if you move that closer to expiration, the theta number would pick up.
Right.
So it's less theta,
Even see it
more
straight out there.
vega
More
if
vega.
implied vol were to go up.
Yep.
So
And
it's just more time. It's just that constant trade-off that you have.
And it's
Raise
that
more on the
duration thing. You're
block.
going out over 3 months in this particular example trade, but the goal is that it grinds up above that break even, stays above maybe the 39.5 level, and grinds up towards 42. All right, Kev, let's take a quick break here. When we come back, we're going to take a look at Procter & Gamble. Consumer staples stock has fallen about 3.5% so far this year, and reports earnings ahead of the open tomorrow. Fast Markets coming right back.
Took a little profit there. I'll add to it if we get a bounce up to this right shoulder, 437.80. Excuse me. It's breaking back down into that tapering channel. I don't think we have anything else going on today during market hours. Yeah, nothing else today. Tomorrow, housing starts, pre-market, building permits. Waller speaking at 12. Williams speaking at 12:30. Fed beige book at 2. And then Thursday is the big day with initial jobless claims. And J. Powell will be talking. This kind of sucks. I have like the lowest full house out here. But they don't have a full house, so there you go. They're the same hand.
George?
Well, I think the primary reason is more exogenous. I think it has to do with interest rates, because if you actually look at Procter and Gamble from a price standpoint, I mean, it's taken a severe decline since September. And if you look at the 10-year rates, for instance, that's where we saw this most recent run up to the levels we're at right now. So I think this is a function of interest rates, because again, if you can buy Procter and Gamble and get a yield, let's say about 2.6%, there's risk in the stock because it is equity. Why not essentially buy a longer dated, let's say, treasury and get a risk-free rate of return that's paying a little bit more? So I think it's interest rates, because it's not just the staples. If you look at utilities, they've been down. If you look at aerospace and defense, outside of what's going on the past 2 weeks with what's going on in Israel And of course, Palestine, those stocks were down as well. And I think also
So it's basically a retest on that breakout level.
trade down because of interest rates. I think that's a
So
primary factor for Procter
could still be
Gamble, but
ripping
this is,
from here.
again, you know, from a products packaged products
He
company.
wants to end the
this is one of
day
global leaders,
review up, or
from a Staples standpoint.
got
They're
a
expected to earn
plenty of
tomorrow,
day to still
and they
keep
release
rallying a
their
lot.
earnings about $1.72 in earnings. That's about 9% higher than last year, with about 4.8% increase in sales coming in around $21.6 billion. But the stock itself, from a multiple standpoint, it's trading around 22 times forward earnings, where historically it's around 24 times. But I did look at the growth prospects for Procter & Gamble on a forward basis. Their estimated sales growth is rather modest at around 3%, but their earnings growth is expected to be closer to 6%. So those two percentages are higher than their 5-year averages, but their multiple is trading below its 5-year average. So what I'm trying to say here is that this may be an opportunity for those who are looking for value stocks, which may have been oversold because of the fact that interest rates have been moving higher.
You know, George, this is really the story that's gone through consumer staples and a lot of retail stocks, frankly, in these past quarters. It's lower volume numbers, but higher prices and cost cutting is making these companies still really profitable, even though their volume numbers are down, George.
That's right. And if you think about staples, they're needs, not wants. So that reflects essentially the inelasticity of demand. So ideally speaking, if they're selling less, it's fine. They're making up on price. And I think that's what's reflected in the earnings estimates for this particular company going forward. Because if you look at the sales number, they're actually relatively modest. And so they're expecting total volumes to be down. But if they cut costs and increase the margin on a per unit basis across their multiple product lineups, which they sell quite a few, they don't have exposure in the foods, because I know there's been talk about Ozempic and some of the aspects of the food companies trading lower. But this is a company that sells personal care products, not necessarily food. And I think this is one that's been really oversold, considering, again, the earnings profile of the business. And you're right, lastly, it really comes down to higher price, lower volume for things that people need, not want.
Yeah, you wonder if they can continue to pass on those price hikes to the consumer, because they did during the pandemic, and that's why they were growing profits. But they global market leader in 7 out of the 10 categories as far as popular products there. All right, George, great breakdown here of Procter & Gamble going into those earnings results. Kevin?
I challenge you to have less than 5 of these in your house.
Oh,
their products.
Come on, Gillette razors. I mean, Gillette razors. My head alone.
Tide and Bounty.
Yeah,
I mean, that's what I love to cover these stocks, because once you get into their product portfolio, you realize how massive these companies are.
Right, definitely. And as I mentioned, the global leader. So, Kev, when I looked at this, implied volatility is about in the 50 percentile range over the last 52 weeks. So a little bit elevated going into the report. Option market's pricing in about a $4.60 move either way in the shares. So, not that big of a move expected. So I looked at the strategies based on implied volatility divergence here. So I looked at a 1 month wide call calendar here to the upside around the 150 strike in Procter & Gamble. Now, the reason I looked at this, and this is just an example for illustrative purposes, but you got the 200-day moving average at 148.50, the 50-day moving average about 151, Kevin. So I was looking at those
in that range.
Yep, as possible upside. If you're looking to the upside, possible maybe resistance points or where it settles in. So I looked at the 150 strike call calendar, buying November 17th monthlies. The 150 call, selling the near term October 20th 150 call. It's a month wide, paying $1 debit for that, roughly maybe a little bit higher, maybe a nickel or a dime higher than that. But if you
failed the drug trial or something,
your risk, $100 per spread. But you got a nice wide range here, Kevin, about 144 up to about 157.5 to remain profitable within those ranges of those moving averages. Your thoughts on the long call calendar?
Right around a 24 vol in the NOV. 47.5 vol in the front expiration. What does that do? That makes calendar spreads more affordable, Tom, and bigger levels of in theta as that front expiration is going to decay quicker. So a calendar spread right there is an easy way, not guaranteed to do anything. You need a move towards the 150 strike, but expect to move about $4.50. That's right in the wheelhouse of 150.
Yeah, and I mentioned that the debit you pay is the risk on this type of trade, Kevin, but you do have some assignment risk on that short 150 call, but you can adjust that if the market's open, liquidity is provided. You have up to 3 potential adjustments or rolls that you can make as those near-term short options get closer to expiration on this one. But it's a nice wide range for this to take in. You're basically buying a 23% implied volatility in the November 17th options and selling about a 47%. So there's that divergence that we talk about that lowers the price entry point on those calendars. All right, Kev, we got to wrap up here. Got about 30 seconds. Give me your take here. We've got stocks green right now, NASDAQ pinging back and forth, but can we rally with Amazon and Apple down and NVIDIA down?
Incredibly resilient stock market leading
See
up to
here,
tomorrow
we
afternoon.
reject.
Netflix
And stay in this
and
taper.
Tesla. Big day tomorrow.
Yep, we're going to be talking about those tomorrow. Well, I'm sure we'll be having, or we'll have some example option trades in those names too. All right, that's going to do it for Kevin and I today here on Fast Market. But stick around right here on the Schwab Network. Next Gen Investing's coming up.
Just flirting with getting out of there. I didn't mean to check that. Dang it. Could have a 6 though. 6? Oh, nothing. Ooh, he almost had me. Getting dealt some hands, man. I'm gonna grab a put on the small account. Oh geez, everyone has a straight now, don't they? Yeah. I might have a 6. Dang. Guy keeps bluffing, trying to bluff on the river. Every river he tries to bluff. These cards. Yeah, I'm adding to my puts. Staying in the taper range. Ooh, look at that fleshy flush. Yeah, don't mess with me on the WSOP. Getting dealt. I barely won on that full house, actually. His pocket tens. Look for VWAP for profits. Pretty safe to say it's, well, maybe it's not safe yet. Might not be safe yet to say if it's not going to keep ripping. It's only 1 o'clock. Plenty of time for the bulls to still party. Take a little profit here.
But as always, let's do upvote, downvote. They're
Next
not endorsements,
Gen I.
they're not recommendations. Jenny, the first one here on this list is VF Corp, and this is an interesting kind of unique headline that's sending this stock basically to the moon.
You know, I actually thought they had earnings with this move to the upside. That is not the case, though. They don't have earnings until October 30th. But higher today after an activist investor announced they built a stake in the company and are now pushing for some changes. According to reports we got from the Wall Street Journal, Engaged Capital has built this massive stake in VF Corp and plans to push for changes at the company, including these cost-cutting initiatives. The activist investor wants VF Corp to consider a strategic review to improve its operations, including cost eliminations that could be worth more than $300 million annually, as well as a review of their non-core assets and real estate and a potential refresh of their overall board. Engaged Capital is now believed to be, according to this Wall Street Journal report, among the top 10 shareholders of VF Corp. They did also say they believe the company's share price could rise to the mid-40s within 3 years if they focus more heavily on their gross margin improvement as well as some of these overall cost reductions. Now, VF Corp, I know we discussed this name, Alex, in terms of the retail space. It needs some revival here because even with a nice 13%
Wanna see revival tonight?
34% on the year and down 47% off of
Let
their
there be a
52-week high. And
revival.
why this name I think is so loved to us both is because they are, of course, the
Yeah.
parent company of Vans.
Saw North Face under, or the North Face on there as well, as it's starting to get a little bit chillier here in the Midwest. Maybe it's time to look at those type of products as well.
What's up, Jay?
You know, Jenny, these are fun headlines, maybe tough headlines if you're, you know, working at that firm or an investor in these firms or trying to figure out where it's going to go. Because basically somebody from the outside is coming in and telling you what to do. They're telling you how to run your business. They're trying to make some adjustments here. But they have a pretty, you know, straightforward plan that they've laid out. They talk about the upside being as much as tripling the stock price from where they're entered this thing. So when you're looking at that, your assessment now is, okay, this news is out. They're involved. It's going to be, the question now is, do you believe that one, they can get buy-in from the company to get this plan enacted, and two, do you think it'll work? Because those are really the questions now going forward, but certainly some excitement on the feathers being ruffled a little bit over at VF Corp.
Absolutely, and I would say that we know from other stories it doesn't necessarily always warrant a turnaround, but I think that any sort of reprieve right now for a company that has been underperforming the retail space is clearly seen as welcomed here. Our next name today, though, is Apple. Of course, we had to revisit the move in Apple today, lower on the session, although still up 37% this year. Now, earlier today, they announced this new $79 Apple Pencil with a hidden USB-C charging port that will be launching in early November. Prior models require users to charge by plugging the pencil into the iPad charging port. It is the cheapest Apple Pencil to date and works with all of their iPads, though it lacks some features of some of the more expensive Apple Pencils. Now, the move does come after the new iPhone 15 lineup features this new charging port in place of their previous Lightning port. That wasn't necessarily, obviously, Apple's decision, though. That was really following this compliance change with the European Union that passed, about several months. I believe it was about a year.
No, I haven't had a
at this
coffee
point.
today.
So
No,
I will
sir.
say that I know every time we talk about Apple, I mention that I have the iPhone 15, which is part of the reason really
Why do you
I
ask,
got it. So
Jay?
I could be a good sample size. But with the new USB charging port, it's amazing because it works with everything else. But right now, my Apple chargers are out of control because I have one for my AirPods, one for my watch, and one for my phone, and it's like too many chargers.
Look, when it comes to this new product,
You heard me
that's been
singing
launched,
like
this
the beautiful
pencil,
songbird
looks
of
really
my
cool,
generation.
Right? I mean, it's a useful item.
Followed up by a perfect
You're
depiction of
you're out
Smeagol.
of your mind if you think a $79 pencil for an iPad is going to move the bottom line for a company the size of Apple. This is really a cool story. It's an interesting product.
Straight.
As is
Didn't see that one coming.
basically all of these sort of niche launches that we've seen from a company like Apple over time. But when it comes down to it, Jenny, and we really think about Apple, it comes down to amount of phones sold, and it comes down to after you're in the ecosystem of Apple, how are you being monetized? The service component of Apple is so important when it comes to the long-term discussion for a company like Apple. I think I've made it very, very clear where I stand when it comes to this company on where the iPhone as a product fits. In America, it's a consumer staple product. If you break your phone, you're going to be the first in line the next day to get that phone replaced. But I just don't see that many people lining up around the door each iPhone release anymore. I know you got the new one, but you said your old one was maybe not in its best shape. And so I think that's more what drives us to the store. Look, I have the iPhone 11, I think. It doesn't even have 5G yet.
And it works.
It's working okay. I think that, I'm getting to that point where I'm thinking about it. But how many
Yeah,
years
after
ago
I'm
was that? I don't
quiet
even know
for so
now.
long.
You know what is amazing
Make
about
sure you
it,
guys
since
are
I was
not
on also the
dozing
11,
off.
what's amazing about the new iPhone is it holds a charge for so long, which reminds me
This dude just
of
loves
why you
to do his
upgrade, I
little
guess.
bluffs.
But yeah,
It's
it was a
hilarious.
complete need-be basis, was not necessary at all, but now I have a fully functional phone, so that is a huge upside. Now we'll shift gears here, though, and look at some of the
think I'm
companies that
bluffing.
do
I
have
love it.
earnings on
Call.
the
Do it.
horizon. United has earnings today after the closing bell,
Guess I could have a
and
full house
United
here.
is in desperate need of some good news. Although they're hanging on to a 7% rally this year, we have
That
seen
raised.
some lowered earnings
Oh, the
estimates
kicker.
that could make, in some
Not the
ways, for a more
kicker.
easy beat on these lower
The Queen
expectations.
A's kicker.
But we have seen shares dip around 30% from their July peak. United is expected to follow one of its closest rivals, of course, that being Delta, in posting a pretty big jump in its
Suck
overall
again.
revenues, which are forecasted to come in around 12% higher from the same period a year ago at around $14.4 billion, amid the ongoing post-COVID travel boom. Now, we have already heard some
I see if we
positive
break
numbers
this
from the TSA that did say
other
they screened
channel.
around 227
Not much of a
million
bounce yet. I mean,
passengers
had this
between
bounce added some
Memorial
puts
Day
there,
and
but
Labor Day. That's larger than we even saw
haven't
back
had
in
an opportunity to
2019, which
close
was, of
some. I'd
course,
like to be able to
our
get more.
marker of pre-pandemic levels. And they worked out to around 2.5 million travelers per day through all U.S. airports. So demand has remained robust, but I think what matters to all these airlines, Alex, and what we already know is guidance. It's going to be, what does your guidance now look like for the back half of this year now that this peak summer travel demand is behind you?
I'm going to be watching margins as well. I think this applies not only to United, but American. It's really going to be across the board. We're in a very strange environment when it comes to airlines. You have falling basically profits as a result of higher fuel costs. You have higher labor costs. All the while, domestic demand has slowed. It's not as robust as it was when we were first reopening. Travel is just not taking place at that same rate. I know we have holiday seasons coming up, but so much of this is not unique to United. It's going to tie into the next part of this conversation, which was with American as well.
You're right. So American has their earnings on Thursday before the market opens. Now, American's in a slightly different position because now shares are down around 5% on the year. Both names have pulled back in tandem, but the magnitude of American's pullback has been greater. And what was interesting to me is I didn't realize, I don't even know what I thought was the largest airline. The largest global airline as it stands right now is American. American. So they do have a pretty vast exposure overseas. They have a pretty vast exposure to some of the leisure as well as corporate travel. But expenses on fuel represent a significant input cost for the company. Fuel costs accounted for roughly 29% of their total operating expenses that were incurred back in 2022. There has been this upward movement, obviously, in oil prices, which is not a welcome development for American, likely to impact their bottom line. In September, management did state that they saw these fuel prices that have increased considerably since the company's initial third quarter guidance they issued in July. So they've already reset some of these expectations. They do expect fuel costs to be higher than what they had previously laid out. And due to some of these higher fuel costs, we've seen a lot of analysts then reduce their estimates on American. More specifically, at least than even United, which is interesting because you'd think this would be sort of the tie that hit all of these boats the same. That's not seen as the case, at least as of right now. We'll have to wait and see once we get these results.
13% on top,
interesting
8.5%
analysts
on
covering
AMC.
these names. United has 70% of all analysts at buy. American has around 20%, and then Delta has 100%. There are no sells, no neutrals. Analysts love Delta, and I think for good reason. I mean, the name has been relatively more stable, but American looks a lot more like Southwest now, which also has around 20% of analysts with a buy.
And you talk about it being the biggest. I think it's always important to kind of talk about, not in market cap. This is just in terms of
Delta's largest in market cap.
And then Southwest, then United, and then American, which is like half the size of United even. So it's the smallest by a wide margin in terms of market cap. But it's the biggest in terms of probably employees and fleet because it's super, super levered up relative to its peers and the amount of debt it has. So borrowed a bunch of money to build itself up. It's been unable thus far to get that paid down, but we know from our conversations with George that's been a huge priority for the company, and it continues to be going forward.
Yeah, unfortunately, that key lesson from George tells us in my mind whenever I think of American, I think about, well, they've got to shore up some of their debt levels, and that's a major concern, obviously, with some of the headwinds like fuel costs hitting their bottom line. But we'll be looking at our airline stocks more. And coming up next, we'll be diving into some technicals as well as some key example trades in both United as well as American Airlines. Stick around. Next Gen Investing will be right back.
There you go. That's what I was singing. SPY breaks this channel to the downside. More of a pullback to get some more puts, but might close a couple here for profits in case we do get a bit of a bounce. Oh, shoot.
of the downside. Anything above 43 invalidates that working assumption that value is forming at lower and lower levels. But taking another step back, I want to show you what's going on here with the bigger picture weekly chart. You can see a wide range going back to basically 2020 after, look at that, the big move lower in reaction to the pandemic after we were trading up around 90 prior to, and then you can see how shares have really struggled to recover. You got a couple moments where they were able to take off up to 65, but again, kind of in this range here, relatively contained, and this chart again really speaks to the significance of 41. Now that we've crossed back down below that level and kind of teetering around or just below, potentially opening up a door for a retest of the lower extreme here. Now, that'd be around that $20, $15 level, but you can see also some lows that we could be targeting here recently, again, from last year. Talking around the $30 level. So opening up the door for some further weakness here, Jenny. This is not the pattern the bulls are looking for here.
And this does a really good job depicting that we still have not recovered, I mean, even close to what we saw pre-pandemic. I know we keep talking about, we're back to 2019 levels in terms of passengers traveled, but this chart tells a little bit of a different story. So as far as big picture here, obviously into this earnings print, what are you watching? Well,
let me show you one more chart I have up as far as bigger picture here, because this really speaks to some of the weakness we've seen. I mean, until this stock even gets above the 50, the 200-day moving average, you can see that it's been struggling. 50 now crossing over the 200, speaking to some of the strength, the momentum we've seen to the downside. This is the move we just looked at from 58 lower, but here's the one thing I'm noticing is that United's still holding up a lot of those lows that we saw end of last year, beginning of this year. We're going to look at American in just a minute. You're going to see a bit of a difference here when we reference those lows from, again, end of last year, beginning of this year. A key level to watch here if this selling continues.
And the importance of time frames, because the last 52 weeks look a whole lot better than the last 3 years. But now in trading this name, I would say there's a bit of a mixed picture into United's print. Bar has been lowered, which is something to consider, but this name has also fared a little bit better than, say, like American, Southwest, Spirit. I know different companies, but something to consider there. So walk us through perhaps a more neutral leaning example trade.
Yeah, it feels as if bears and bulls are a little bit more balanced with this name.
Bears and bulls
more
balanced.
That Ben spent a lot of time talking about was around that 41 mark, and so one of the luxuries
up
of a
or
name
up
like
above
United
VWAP,
is actually has
15%.
$half wide strike availability. Well, right now, this stock trades at about 40.25, and so the closest strike to it right now is 40.5 if we wanted to lean slightly higher.
Eyes up 6.25.
So using that sort of 41 level, but really 40.5 for this, I created an iron butterfly spread. So essentially we start by selling that 40.5 straddle, and then in this case we bought $3.50 wide wings. That allowed us to do this for a $2 credit, creating a just better than, let's call it, around 3 to 4 in terms of risk reward. So we're risking 150 to make 200 here, but really it's more about the window of profitability that it creates. So you can have a profitable window between 38.5 and 42.5, where that $4 wide window this is a profitable strategy, the more closely it ends up around 40.5, the more profitable it could stand to be. But most importantly, risk defined, 150 in risk if it were to move outside of either 37 or 44 to the upside above 44, below 37. $150 in risk, 200 in max profit. Not the most likely, occurrence, Jenny, would it be to capture that 200? You'd have to perfectly pin that 40.5. But the closer we could end up, in that area, you can see that's the peak of this graph. So that's sort of what you're hoping for. You're looking for a boring, non-event-like response to these earnings. So as if we have to double check and be like, did these earnings even come out?
Okay, Delta was somewhat like that though, because Delta reported mixed picture, and yet the stock, it was unmemorable, frankly. And so
Broken margin does 434 puts.
Possibility. Obviously, we'll get those results today after the closing bell.
Jeez,
but now,
man.
American, Ben, and American looks quite different because we're lower on the year. We just haven't.
That's
seen
right. From those puts you opened up this morning.
Investors feels like sentiment is totally different in this name.
Yeah, but when you're looking at the more intermediate, more granular time frame here, I've got hourly candle charts.
It's
you're going to see a
sketchy.
very similar pattern playing out, right?
I ran
Trending
into
lower in this
losing
instance.
trade that
We're talking about from, well, you
showing
can see
signs of
1480, we'll call it 15
reversal.
down to this 1168 low. Again, top left to bottom right, pretty well defined here. And I went ahead and, in a very similar way as we just looked at United, I went ahead and identified some of the areas of consolidation that have formed at lower and lower levels. You can see we were talking about United, how we were seeing these, what was it, $2 intervals. In this instance, it looks like 50, 75-cent intervals. Every staircase that we take a step lower, area of value forms at a lower and lower level. Working assumption here is that we're going to continue this to play out, right? That continuation more likely than change, or the trend is your friend, different way of putting it. As long as we remain below 1250, balancing around 12, the idea is that we're going to break out again to the downside and form a new area balance at a lower level, right? We'll continue to watch and see if that plays out. We have a line in the sand to the upside where we know that's no longer
so
a
lucky.
valid working assumption
Oh
until
my
that becomes
gosh,
the case,
total
as we've
bluff.
been watching throughout this process. Again, it's just kind of let the market do the work for you. That's why I like positioning with the trend, because you're not constantly stressing out about pullbacks. They're short-lived, and in this instance, you can see a little bit longer time frame being brought into discussion here. Going back to July, we're looking at the move lower from almost $20 in this instance. Similar situation as
I'm
we
edgy
just
like
looked
that.
at. Here's the move lower we started off looking at from September down 15.
Well, you
Again,
can
remember
play both
this
ways. Just
1168 low, and so
you know,
we basically just
you knew it was a
added
gamble when you
another
opened it.
$20 of a very
Said,
similar
I'm
situation.
gonna close this
where we
call
have
in like an hour into the day and open
50,
puts.
75-cent intervals, $1 intervals to the downside, and then let's take one more step back here and show you what's going on in terms of similar patterns we looked at with United.
typically
the thing I
don't.
did mention is how
When you're closing calls is
we'll
not
look
the
at
best
it in
time
a
to open
second here,
puts,
but
typically,
notice, as
because that means you
mentioned
timed it
again, two
perfectly.
big areas of consolidation forming at lower
On
and
both
lower
ways.
levels. A stock that's come under pressure into the pandemic and really has struggled to recover out of, Jenny. You can
So
see
I
this
played
stock's
calls
trending
inputs
low
today. I
on
played
multiple time
both
frames.
lots of
Again,
times.
You mentioned at the top of the
Overtraded some in
segment
here,
how
but
these were
we flipped
stocks
fully
that
into
were in
puts.
desperate need of some good news.
Well,
Don't
here,
shoot
and then
the
I
messenger.
closed them out here,
really
then
bring it.
back in here,
It
and
is sort of
added
amazing
here.
when you traded as high as $59
Close
a
some
share. I know
here,
United's
added
been
here.
down as well, but
Close some here and
we've
here.
just been stuck. It feels like between
Yeah,
around
we're
$12 to $15 in
most
American
likely
for
going to see
so many
VWAP.
months now that I'm just used to this price range. It seems
But
almost
I'm not
ridiculous to
discounting that
imagine
we could break this and then
$45.
get bullish
Again,
again.
big
So
picture
it might be
here, what are
out
you
of all my
watching
puts
in
and back into
earnings
calls
Thursday
for one
before
today.
the market opens?
Well, stuck around 15 makes sense, right? Because that's the balance, the pivot that we're at right now. But I did mention here a little bit of a difference between what's playing out with United, which has been holding above that low from late last year, early this year.
can do
But
it, Guts.
take a look here. You can see what's going on. American Airlines has taken that low out. So the question is, has American overdone it to the downside? Or we start to see some strength and a bit of a lift off of these lower levels? Or is there some catch up in terms of where United is? Do they have some a bit more downside momentum here to see follow to come into play?
Even their move to the upside today is more modest than United's, and their move this week up 2.5% versus United's up, I believe, over 4% now. So a little bit less enthusiasm fueling American here, but really great breakdown. Ben Lichtenstein, our chart master for today. And now, Alex, when trading this name, say you look at American and you say you are the largest global airline in terms of passengers traveled, and you believe in this
These guys don't have
name,
anything,
and
but
perhaps
pretty much
just
everything
the fact
beats
that
me.
expectations have been reduced so significantly,
Like
walks
that.
within a bullish leaning trade.
And I think that last part is really what I was honing in on from a logical standpoint as to why someone may come to the conclusion. to be optimistic around this earnings. And the reason is you looked at Ben's chart about a month ago, the stock gapped down when American just flat out said, hey, we can't pass on these costs to the consumer. That's going to hurt our earnings. And so the stock was rapidly repriced. It's been in a downward spiral, largely correlated to crude oil ever since. And so maybe, just maybe, they outperform the extremely low bar set by themselves. And that's oftentimes something that you actually do see. So maybe the market has overreacted, overswung that pendulum here
There's a little
to the
flush on
downside.
SPY.
There's a chance for just a small pop back on this earnings event. If you believe that, I have this Friday's expiration, buying the 11.5 call, selling the 12.5. It's a $1 wide call vertical spread, where the best case scenario, Jenny, is just a move above 12.50. The max loss scenario is a risk is a move below 11.50, and the break even is at $12. Well, I just looked at American Airlines, and it is trading $11.99, $12. So it is right smack dab at our break even point, equal risk to reward. Those are our two loose guidelines for this type of a strategy. It's ultra short term, but there's an earnings event that maybe is the catalyst for a move one way or another. So very much a kind of boom or bust possible trade here, but it's risk defined. You know it, 50 in, 50 out, and either way, those are your worst and
Shouldn't
best
have folded
case
that. Was
scenarios.
stupid.
And of course, with
Only a 40
American reporting later in the week, we
40
can see
call,
somewhat
40
of a
raise.
move following United's earnings. It's almost like a double catalyst here when considering. And then we have Southwest reporting in about 2 weeks from then. So still lots of airlines to get through, but Delta did lead the pack relatively strong. We'll see if these names can follow. That does it for this segment. Now, coming up next, we will talk all things NVIDIA, down 4.5% today as we're seeing some semiconductor weakness following the ongoing battle of the U.S. versus China regarding the AI space.
Good thing I folded. Ooh. Full house. Kohl's is up 7%. We could bounce off those lows. All fun and games until someone gets hurt. Yeah, I've got retail up today. Oh, I folded King Jack. Wah, wah. Macy's is up. Shake Shack.
Companies and a lot of these resorts are really trying to figure out what their proper valuation is before trying to sell themselves off to a potential competitor.
So, Kevin, is there any whisperings if we could hear one of the big hotel giants come in and make a counter offer? Because I recall the days of Spirit being first sort of bid after, and we saw all these different airlines obviously didn't all work out. But what we do know is that right now, is this company going to be then a target for, say, like a Marriott, which is the M&A king of all hotels?
That might be a possibility here. I mean, no one really does know at this point in time. This space has actually seen a lot of competition. They have a lot of different brands, but as you kind of know, there's a little bit of a centralization, especially when you're looking at the geographic locations that they try to cater to. And that makes it a little bit difficult, once again, on how to truly value these companies. Before COVID, a lot of the hotel and resorts that were near, city locations were valued at pretty high premiums, but now we are seeing those that are a little bit more dispersed, especially in the suburbs, starting to gain a little bit more of a premium compared to what their book value is. So I think that's going to be the biggest risk and the biggest search for answer when you're trying to figure out who could take out another potential competitor, and then what the actual regulatory landscape looks like, because we haven't seen a lot of takeout offers when it comes to hotels or resorts.
And the upside about a lot of these more discount, more select service hotels is they just have, less operating headwinds to consider out, like versus some of these resorts. I mean, some of these companies, we're looking at these brands, La Quinta, Days Inn, they're just slightly different models than, say, a full-scale Marriott resort. So
flush out of that
interesting
channel.
story, though, nonetheless. We'll leave it there. Kevin Green, great
Going
breakdown.
for a VWAP test.
For the network. And I'd like to bring back in Alex. And Alex, we'll shift gears here and look at all things NVIDIA, because NVIDIA, as I'd say, not necessarily even just NVIDIA, but the semiconductor space is one of the biggest stories of the day, given the fact that we've seen now this ongoing battle between the US and China heat up regarding
some of these still move a lot. I mean, got a big update. We could.
The critical takeaway here on this is less so the what, but the more so the reaction.
We just chop around VWAP for the rest of the day too.
In a stock like NVIDIA, this is a name that is so widely traded now. It's a name that carries tremendous options volume. Over almost 1.2 million option contracts traded today, and on these headlines, you have a repricing of a essentially just over $1 trillion company by almost 5%, and this is nowhere near the lows of the session. The lows of the session are at 424.80, so it's already rallied $14 off of its lows, and it's still down 5%. It just goes to show that some of these names, the NVIDIAs of the world, have in some ways taken the baton from the names like Tesla that were really driving kind of equity volatility in indexes like the NASDAQ, but this is sort of what you get with this company right now. It has been, fortunately for bullish investors in the name thus far this year, for every one step back, it seems, several leaps forward, as the stock was down near $100 a share not that long ago. I mean, you only have to go back to October of last year where this thing bottomed out, sub 110, and it launches all the way up to $500. So I think it comes with the territory, but it's certainly something to monitor. And it goes beyond just the impacts to semiconductor companies, but it's also greater escalation in sort of those geopolitical tensions. While it's no sort of military tension right now between the U.S. and China, but it's continued escalation of sanction and breaking down of existing relationships.
And what I think is sort of the disappointment is the fact that NVIDIA did come out after we got these initial restrictions last year, make some adjustments to appease sort of the government in China. It doesn't seem like that's going to be enough, though, at this point. So the story is the U.S. is obviously taking these steps to now prevent these American chip makers from selling semiconductors to China by getting around some of these government restrictions. This is according to reports we got from a U.S. official. Now, the new rules will be added to the restrictions on U.S. shipments of these advanced chips, as well as other chip-making equipment which was again first revealed last October. But the updates are expected to be more thoroughly released later this week, so we don't even necessarily know the scale or in terms of which companies will be the most affected. We don't know any of this yet. This is still relatively preliminary, but these rules are expected to block some of the AI chips that fall under these current technical parameters, as well as the demand for companies in terms of their overall shipments. So that's why we're seeing not only NVIDIA sell off, we are seeing some other weakness in Broadcom, Intel, AMD. NVIDIA, though, definitely leading the pack with now, like you said, we're not at session lows, but we're slipping here in real time. The exports are expected, per this U.S. official, to include some of NVIDIA's A800, H800 chips, as well as the new rule does expand these license requirements for the advanced chip exports to more than 40 countries. So again, it's sort of beyond even just China. It seems like some of these restrictions could have more vast and more detrimental impacts, just given the fact that it doesn't seem like it's just China. But again, we've talked about NVIDIA so many times, especially for FOMO, because it's up 205% this year, even with today's pullback. It's up, 284% off of its lows this year. But then that begs the question, this is such a high bar. We have so much expectations going into their third quarter print, not due till November 21st. But with this expectation, it's like any sort of catalyst to the downside, and we just see sort of things slip.
Couple things to add. First, when it's come to these, I think you've kind of alluded to this, when it's come to these restrictions, be it in semiconductors or other things, it's been a lot of bark and very little bite. And so those initial headlines have sent things spiraling. And then it's like, oh wait, this isn't actually impacted. There's a quick little kind of, I would say, alternate way that they can adjust a component part, and they're like, no, now it doesn't fall under that. So like, let's call it loopholes in some of these restrictions. And so without kind of the clear guidelines as to what these restrictions are, it's a lot of speculation right now, and it does seem to be that the market itself has taken this sell now, ask the questions later approach. But there was buyers that came in. Like I said, it's rallied $14 already off its lows intraday. I saw KeyBank weighed in. They talked about it being a negative on the company, potentially having as much as a 20% impact on 20 to 25% impact on its data center revenues, and this being a $5 impact to its EPS. Yet they still have an overweight rating and $750 for a price target. So I look at this and say, either this stock is priced for very little to go wrong, and we kind of saw that, I thought, in the last earnings, where it was a blowout quarter, beat and raise, once again, astronomical beat and raise, and the stock couldn't even hold on to the pop. And there is no room for there to be kind of setbacks. Or you're in this KeyBank analyst camp where it's like, this stock's not even anywhere near what it should be worth. And yeah, it's a 20% setback, but it's still an overweight stock with a $750 price target.
Yeah, and I think that's such a good point, especially because it's like, I'm not discounting the impact and the reach and the scale in which NVIDIA can expand its AI offerings. But this is a company that also is a fully functioning company, even without the mention of AI. They have their hand in so many other areas of the semiconductor space. Gaming is another spot that has been weak for them all year long, and that's just completely overshadowed by the AI narrative. And it's like, not to say it's an AI bubble, but it's something to consider. There's a lot of hype around AI. NVIDIA is a company that's much larger than just its AI offerings. It timed the AI push very well, but then there's always the concern that there's other aspects of its business that could see some hiccups. I think illustrated today, we have tensions with China. What does that look like for them, their production and their shipments? And supply chain was a major problem for NVIDIA about 2 years ago, and we've just completely forgotten about the headwinds that we're facing in NVIDIA. Again, not to discount their nice move higher this year. I've been impressed with NVIDIA all year long, but they are so much more than just AI, which I think today's move illustrates.
60 out of 63 analysts are in the buy camp, 95.2% on a stock that's gone 5x almost off its lows. Like, to me, it pains me in many ways to see something like that. But there's still ways, and I think the FOMO feeling is clearly to the upside. It has been in NVIDIA. So we're looking at a bullish strategy, but there's ways to kind of protect through risk definition and strategy selection that kind of catastrophic downside. Look, a headline breaks, the stock moves 5% to the downside. What if these details are worse than expected? Is it another 5, 10, 15% to the downside, 20%, whatever it may be? You can use strategies and options to protect from those catastrophic declines, knowing your risk going in. And so that's the key difference, I think, between maybe being a stock shareholder and using some of these option strategies that we talk about, is how you can kind of structure your risk for different scenarios. And so what I looked at here was buying a call calendar. So it is quite speculative in the sense that it's going to need a big move higher. It's going to need a move towards 500 over the next few weeks, but it stays ahead of earnings. So earnings are slated for the week after the November monthly cycle. We're going to that November monthly cycle for our long 500 call, and then we're selling 2 weeks prior, November 3rd, to reduce that debit spent. If we're able to do this for $3, it would mean $300 in risk. So it's still risk, no doubt about it, and it may not even be a high probability trade, and quite honestly, it probably isn't if you have a 500 strike call calendar over the next month or just under a month. And the stock right now is trading at 440. And so you're going to need a big move, but this is a stock that has delivered big moves. And so if it does move towards its 500 strike, it'll be back a retest of that all-time high, and that's where this one does its best. But it is risk-defined. I think that's the critical takeaway here, alongside its customization potential. If you have a different strike in mind, different expirations in mind, different directional bias in mind for NVIDIA, likely this strategy could be structured to better fit that. But just looking at one, given that FOMO feeling to the upside, given the very lopsided 95% of analysts in the buy camp, and given that this move lower could be seen as an opportunity to buy the dip in a name like NVIDIA.
Yeah, that's a really good point, because if you liked it at 502, which is where it was just 2 months ago, you'll love it at 440 right now. So perhaps being seen as an opportunity with shares pulling back here quite considerably. Always an interesting move though in NVIDIA, and it always seems like it's a really interesting story that follows that move. But we'll leave it there for FOMO. Now coming up next, it's time to talk all things Amazon, also slightly lower on the session, although the street also still really likes this name. More analysts coming in the bullish camp. We'll discuss that more with Renita Young coming up next.
See if SPY has the little bounce here for us. I closed one more of my puts, just slowly scaling out. Very slowly. Really had a proper bounce. This was the only one that kind of made that right shoulder. So yeah, I might end up just chopped around the rest of the day. If we do break VWAP here, though, I think we could see some more downside. Maybe 434, 40, or maybe even low of day, which makes today a great big trading range. Tons of fun. I didn't quite get the top there. I closed out of most of my stuff right here. Been a nice big move up there. I didn't mean to fold that either. $145. Everyone would have had a straight flush. Are you kidding me? Alright. My first straight flush on this game. I think. Let's see. Yeah, I think it is. What a hand to fold. retest on VWAP there. Probably have to build a little liquidity if it is going to flush through here. We went up above, broke the resistance, now trading back below it. I'm just probably waiting on the data on tomorrow a little bit, but mostly initial jobless claims and then PayPal on Thursday. So much money lost. Maybe, yeah. It depends on if that flush guy felt really good about his flush. I guess he did. It was like jack high. There's only like 2 people that haven't folded. GME is red.
Alone and the ability to compare and contrast right there on the website is one thing, but then it's more opportunity to find better deals on that site than there is on other sites like Temu, which Deutsche Bank mentioned. They say that it's not necessarily a structural threat to Amazon when it comes to the e-commerce business, but they're still looking for Amazon to have more competitive earnings. Obviously, they have more competitive goods than any of these smaller websites.
I was almost thinking, like, just to myself while you guys were talking, Amazon has the toughest competition out of any company. You look at the cloud business, they're going to get head-to-head against Microsoft, Alphabet, I mean, just 2 little companies there. And then on the other side, you got Target, you got Walmart, firmly focused on how to get business back from Amazon. And hey, a lot of this is due to the immense amount of success that Amazon has earned over the last couple decades. But there's no slouches that
got a lot of liquidity over here. If it does
there are plenty of
break,
big companies willing and
ready
to win back any and all market share that they've lost to Amazon over the last couple decades.
Oh yeah, and as you know, Amazon is coming for the entire supply chain, really. They're trying to take over freight as well with the most recent initiatives, also infusing AI into their deliveries and trying to get into the storehouses, the warehouses of other companies.
Might even add on a break here.
Amazon as well. They're
Wasn't
not
planning
necessarily
to, but
connected. They want to be able
got
to
a
have
pretty
that
good downside
system for different products and different
Does.
places. So yeah, they're trying to dominate, just like they set out to do, probably.
And I mean, based on their performance this year, they are dominating. It's like what Target, what Walmart. Walmart's fared a little bit better than Target, but Amazon's still up 57% this year. Difficult to compare them, but it's just amazing the way they're able to keep their prices low, which then begs the case of the monopoly, but it benefits us as consumers. So I'm like, I will keep ordering on Amazon because it's the cheapest way to shop. But we will leave there. Really great breakdown on all of the analyst news surrounding Amazon today. Renita Young, senior markets correspondent for the network. Now, coming up next, it's time for Under 30. We are looking at all things TripAdvisor, also with some bullish analyst activity today. George Tells will have more on that coming up next.
We'll bounce around VWAP. Close another one. Perfect line. Worst you can lose is premium. Oh man. What a full house. Oh, there's a break on VWAP. Let's see. Yeah, I added. I don't know if Fidelity got a fill before that flush. We'll see. Probably got me a nice fill at the bottom of that red candle. Take a little profit right there, actually. There you go. That's always what it needs to happen. I just need to close a couple positions and that will trigger it to continue. Trick is closing enough to trigger it to go, but not too much that you miss out on a lot of profits. Oh, the GIF. The GIF. Closing another one there. someone gives you 10,000 to one on anything, you take it. 10,000 to one. Oh, okay. I mean, I don't agree, but maybe in real life, not in the options world. You get all sorts of 10,000 to ones. Everywhere. All throughout the money. No time. You can throw your money as much as you want. Wasn't another one there. Dang it, Guts, you can't forget that, man. Can't forget that. What's up, Psych You Up? Happy tears. Mabaya chapan and Dame Quell. What language did I just learn? One for the homies, put a stop on it. It'd be like half profit from where you are. Be at break even if you really think it's going to keep going. But if you're trading dailies, yeah, I mean, at some point you need to take profits as the day progresses on. You even do like a trailing stop, a lot of wiggle room, all that. I know I made that mistake today too. It's kind of an accident because I had the trailing stop, and then the one I had a manual stop on, I ended up just going and closing that one. I didn't realize my trailing stop had closed also. So I got out, where was it? Like right here. The trailing stop closed here. My manual stop, I think it closed just before there. So I missed that top. It was pretty significant. But as you run out of time, it's, you know, I mean, sometimes, I mean, you can trade these things, you know, after hours, you have 15 minutes, so. On dailies, though, it's maybe not a good idea. You're deep in the money. Irani, Bolivia, Paraguay, and Brazil? Wow. close in one more here. It's looking good though. It's looking like a bear flag.
Is ready with that and more. In the meantime, taking a quick look here at the markets, you have markets that have gone back and forth. The VIX continues to climb throughout this day. Now it's at 1820.
Back to the size I had before I added that VWAP bridge.
Is down 0.5%.
That makes
This
sense.
after yesterday, a nice big gain for the Nasdaq. In fact, it erased the losses that we saw on Friday, but now giving some back in negative territory. The Dow Jones Industrial Average is down 0.25%, and the Russell is up 1.25%. This is energy, materials, industrials helped to lead the way. Also, you had a strong retail sales, and people think about the Fed. You know, consumers are strong, and will the Fed raise rates? U.S. dollar 106, gaining. Gold is pulling back $1.50 at 19.32 a troy ounce. Oil is down 0.25% at 86.46, and Bitcoin just fractionally higher now at 28,580. For some of the biggest stories in the markets, we welcome in Caroline Woods, senior markets correspondent here on Schwab Network, to tell us all about NVIDIA. And it's obviously under some pressure now with some restrictions in play.
Hey there, Nicole. Yes, NVIDIA down more than 5% today. Actually, one of the worst performers on the NASDAQ, right behind Lucid and Moderna. It's the third worst performer on the NASDAQ today. And this comes after the U.S. Department of Commerce said it will prevent the sale of more advanced AI chips to China in the coming weeks.
Just fast to retest VWAP here.
Exports of NVIDIA's chips, as well as some of the other big chip makers. In turn, we're seeing weakness across the board. It's not just NVIDIA, although that's seeing the steepest decline, but Broadcom's down 2%. AMD is down about 1.7%. Intel is also down almost 2%. So seeing some weakness in chip stocks across the board, especially given robust demand for AI chips from Chinese customers. So this could definitely have an impact. Reuters is reporting that the Chinese embassy in Washington says China firmly opposes export restrictions imposed by the U.S. Of course, there's some concern that retaliation could come into play. We've definitely seen this tit for tat between the U.S. and China, and tensions have definitely heightened. NVIDIA seems to have kind of anticipated the additional restrictions. Back in August, they said they would not have a material impact on earnings, but might hurt over the long term. Obviously, there's so much demand from so many people for NVIDIA chips right now, given the AI wave. Definitely some concern from the investment community when you're seeing this play out in terms of stock prices today for some of these
both completely bluffing.
All right, and next up, thank you for that. And next up is all about UAL. We heard from Delta, which actually saw demand very strong. We knew that summer was great for the airline stocks. A name like UAL, I mean, people are gearing up for this report after the bell. But I'll tell you, as you look at that chart, since the last earnings report and that high of $58, it's been trending lower. But maybe we'll hear some good news. What are people watching for this report?
Well, there is some enthusiasm heading into this report. Shares are up about 1.3% right now. As you said, the report after the closing bell today. That said, United Airlines down 5% this month and has been under pressure since July, as you said. I mean, now trading at, you mentioned the $58 per share mark, now trading at $40 a share. So it's a steep discount compared to what it previously was trading at. It should benefit from international travel demand, similar to Delta. They saw a 35% uptick when they recently reported last week. They highlighted steady demand both at home and abroad. But similar to Delta, United Airlines is facing higher labor costs and fuel costs. Back in September, like so many of the other airlines, United warned that jet fuel prices
AMC coming down a little bit.
At that point, in turn, they raised their third quarter fuel price outlook, but they did back their revenue outlook for the full year of 10 to 13% growth from a year ago, and said they expect capacity up about 16%. We'll have to see what they have to say tonight. It didn't provide an update to earnings per share guidance back in July, but the range was somewhere around $3.85 to $4.35 per share when they reported back in July. But analysts, in terms of what analysts are expecting out of this report for Q3, EPS of $3.40 on revenue of $14.44 billion. So I will say Delta saw 13% year-over-year growth.
Trips.
We'll
Nope.
keep that in mind
There's
as
a
we
pair.
look at
No
the
clubs.
revenue growth that United is able to
There's a pair of nines. What is he doing?
post. But we'll really kind of have to see. I will say 70%
just touched, you
of
just
analysts
lost,
at this
dude.
point are bullish on United. 100% are bullish
Yeah,
on
that's
Delta.
pretty
so Delta's
risky.
clearly the favorite, but let's see how United
Too many people.
shows up tonight.
And just a little fun fact, I saw that they've been modernizing the fleet. Now you can use Bluetooth,
anything.
capability of new Bluetooth-enabled planes. You have emphasis on new AirPods for folks who like to use those. Might be something
was
to check
just
out.
on a United flight and didn't have
You didn't
those
have that
perks.
You didn't get that particular plane.
I didn't get a
upgrade.
good one.
Thank you so much, Caroline Woods. Good to see you. Thank you for those top stories today. In the meantime, I want to take a look at the bigger picture. Scott Ladner's with us, Chief Investment Officer at Horizon Investments.
these guys are
Thanks
aggressive.
for being with us. You know, even today, we're seeing a lot of volatility back and forth. Obviously, you have incredible tension coming from the Middle East, geopolitical tensions. You have the concerns about whether or not the Fed will raise rates. Strong
This guy's
jobs
known to
report,
quit.
strong retail sales report.
You too.
There's also slowing that's happening, and that's sort of what some Fed members have said out loud, that maybe we're going to have, this higher rate environment slow the economy enough. What's your read on the current market, this back and forth action that we're seeing?
Nicole, I think you set it up really, really well. I mean, the back and forth action is what we're seeing right now. And there are a lot of cross currents that investors are having to deal with. I think the chief amongst them isn't really on the geopolitical front. Nobody really knows how to handicap a war in the Middle East. Like markets have shown that through the years. So let's just put that aside for right now. And focus a little bit more on sort of the domestic picture. And the domestic picture really is a tug of war between what is, is the Fed going to crush the economy, or is the economy going to continue to kind of chug along, and consumers continue to chug along and do pretty well. And the market right now is trying to figure out which, is good news or is good news bad news. And depending on how you think about the Fed killing the economy or growth killing the economy, how you come down on that is going to determine how you think about economic data. And what we've seen, interestingly, over the last week or two, Nicole, is basically a turning. I think we're witnessing kind of a turning point in market psychology. Previously, everybody been just worried about the Fed. So good news meant the Fed was going to hike us into oblivion.
Close another one here.
And bad news meant the Fed would relent and we'd be okay. And what we've seen with non-farm payrolls first a couple weeks ago, and today with retail sales, is that the initial reaction was to sell everything. Initial reaction was the Fed's going to kill us because the economy is too strong. And what we've seen in both circumstances is midday, the market turn around and figure out, the Fed is probably likely done or very close to being done no matter what. And the economy and nominal GDP growth are really going to be the things that matter going forward. And those are the really strong signs for that.
Yeah, I mean, as you have, and you mentioned GDP, when you think about all the different things that are happening all at the same time, and we'll have this sort of higher for a longer environment, is there any part of it that worries you, or are you trying to take the best case scenario?
Look, yeah, there's always going to be worries, and the worries come along with, our companies going to, and our people going to have to borrow money at some point at these very high rates. Part of the resilience and part of the story of the resilience so far this year has been the fact that companies and people don't really need to borrow at these rates. So they don't really matter that much. But if we walk down a year or two from now, and refinancings are having to happen, people are starting to pay higher credit card bills, they're having to refi their mortgages or move because of job situations or whatever else, and they're exposed to these higher rates, both corporations and households. If that starts to become an issue, then this is going to start to really bite. But we think we're at least 12 to 18 months away from that really becoming a problem. And so right now we think, this is still Goldilocks. Nominal GDP growth of 7 or 8% is a really strong tailwind for earnings, and ride it while it's there.
Right, and as far as how you're positioning, you favor the U.S. over international. How so? Explain that. What should investors do?
Look, the U.S. It goes along with partly what I just said about the
folded
exposure to
things.
higher rates. In Europe and other parts of the world, they don't have long-term fixed-rate mortgages as the predominant mortgage vehicle. Companies didn't term their debt out like U.S. corporations did to take advantage of the low rates of the last 5 or 10 years. And so we see corporations and households, especially in Europe, being much more exposed to higher rates than those in the U.S. So that is that's one reason to be a little bit more excited about the U.S. than other places.
Oh, I would have had a jack high flush.
The other one is just the fact that technology comes out of the U.S.
That guy's
and we're
chips.
the innovation hub. So if we're going to get
I'm
AI
so
development
loose.
and we're going to get quantum computing development, it's more likely to come from the U.S. and benefit more U.S. firms than it is the more sort of industrial banking auto firms of Europe. The exception to this, though, is going to be Japan. We do like Japan as well. I know I've gone on for a minute, but Japan is the outside market that we like in terms of profitability and in terms of growth, because they've had their first nominal GDP breakout of over 5% in a generation.
Yeah, so at this point now, when you talk about fixed income, because you said your advice also for investors going into fixed income, and they should consider that as part of a diversified portfolio, how would you recommend doing that?
You know, fixed income it's not really a dirty word anymore. You can get reasonable yields, obviously, by investing in fixed income. We would go in the corporate sector because we think that the pickup you can get there between 1% and 4%, depending on what grade of corporate you're willing to take on, is worth it. Because in order for corporates not to work, you need a default cycle. You need companies not paying their debt back. And with the economy how we see right now, we don't see that default cycle as being imminent or being very likely. So we think that 1% to 4% extra you can pick up in clipping coupons on the corporate side is probably a little bit better way to be than just owning treasuries or owning cash and T-bills. That said, we still do favor stocks quite a bit more than we do bonds, even if you can get 7 or 8% in corporate bonds right now. We think you're going to do a lot better in stocks over the next 12 to 18 months because we have arrived at these higher rates. And the market knows how to deal with 5% interest rates in the U.S. stock market. Just look at the mid-90s and the mid-2000s.
Yeah, understood. And you're avoiding China. You really don't want that in your Asia exposure when you're doing that.
Nice.
And final thoughts here on earnings season. What do you think we're going to be taking away from this earnings season? We'll have 40% of the S&P next week. We have 10% of the S&P
I say it's climbing back up for VWAP.
Yeah, I mean, look, we think that earnings season overall is going to be pretty good, and the reason why we think it's going to be pretty good primarily is because we have two things going on. We have declining and stable inflation, so we have a pricing environment that is a little bit more certain, and a little bit more stable for companies. But we also have, probably more important than that, is we have this nominal GDP growth story, which is just accelerating and being really, really strong. The retail sales number today implies, if you kind of run it through all the numbers, it implies a nominal GDP growth in this country of 7.5 or 8% for the third quarter.
Just straight out there now.
That's really, really strong nominal GDP growth, and earnings are nominal variables. And so with that, that 7 or 8% at your back, if you're a company, that's pointing to pretty strong earnings growth in the third quarter, and we think they're going to carry through to the next quarter as well, this quarter as well.
Oh my gosh!
And we don't think that's in the market right now. These earnings growth surprises are not in the market, so we think we're actually pretty optimistic about this earnings season for those primary reasons. That we will listen to what companies say about the behavior of consumers going forward and how they're dealing with things, consumer behavior. But outside of surprises on that front, we're pretty sanguine about earnings in the stock market.
Great.
Scott Lander, great to see you.
I just gotta make sure that we see his cards every time, because it's too hilarious.
Thank you.
Yes.
Coming up,
Would I keep slow playing it with this guy?
160% this year. Kevin Horner standing by, and he's watching that.
I wonder if I raise if that'll provoke him to go even crazier.
And more here on Schwab Network. Stay with us.
Ooh, I like it. I like it. Get into a little pre-flop raising battle. Do it. Do it. You didn't go all in? What a weirdo. Let's see, there's a flush out there. Sixes. For a pocket pair, he probably has 7 and a jack. I'll just stop out of the rest of these. Oh, it didn't trigger. Why didn't you trigger? Dude. Fidelity. The problem here. We're sitting around that price for a while. Why can't you trigger it? I'll cancel it. Maybe he has a 4, I don't know. Gotta get that guy all in. You have a 4? Oh my gosh. You just call with a 4? Wow, slow playing it. Of course he didn't have it. Too aggressive that all in. Fidelity sucks. Yeah, this guy doesn't bluff a whole lot, I don't think. Hasn't done so far. Glad I canceled that stop after it failed. Sold a couple more for profit. A couple left for the homies. Still have a lot of time in the day. You know he's gonna go all in. Pair makes sense. Oh, we got beat by a full house. maker. What? He folded? He doesn't like the all-in pre-flop? Pocket sevens takes it down. Maybe you should have called. Can't believe he folded.
But until it does, the best predictor of what's going on in retailing is yesterday's sales. That tells you what's going to happen to tomorrow's sales. It's the best predictor of 3 months out sales, and it's the best predictor of 6 month out sales. And yesterday's sales were pretty darned good. So the next best predictor after that is pretty simple. Does the consumer have a job? Will he keep his job? And will he or she get another job that pays just as much or more if they lose that one? And if they believe that to be true, and they all do right now, then they'll keep spending. And the final thing is, how do they feel about credit? Well, what do we know about that? yes, credit's rising as far as the consumer goes, but they feel just as good about their credit position as they did in 2019. So all of those things tell me that it could be a pretty decent holiday selling season. Now the question is, where are they going to spend the money? Is it still all going to go to Taylor Swift tickets, or will they buy some sweaters, shoes, jewelry, handbags, and cosmetics? I believe they're drifting back toward things, which is a positive for my kind of retailers.
Yeah, because you were talking about how at one point people were really going for services and travel, but you do think that they're going to be interested in actual things for the holidays. Now, among your favorites are Kohl's and Macy's. Why do those stand out to you?
Well, let's pretend we're going to start buying discretionary again. And after all, it looks like the consumer is going to spend 15 to 20% more on Halloween than they did last year. That's pretty discretionary, and it tells you if it's fun and they can do it, they're willing to do it, and they'll spend on it. So where's the place you go for gifts? We know Macy's is the gift place. And if we're going to see 3.5, 3.8, maybe as much as 5% growth for holiday, and it's going to show up in discretionary sales, which I think is where we're trending, then it'll be a pretty good performance for Macy's. And they've done all these things during COVID to make their sales and business better, right? They've restructured the business. They're better in private label. They've been increasing their off-mall stores. They're doing a better job with Backstage. They're doing a better job with Blue Mercury. They've got Marketplace working. They've got a good shot here. Kohl's is another story. Kohl's is, we've been asleep for 20 years. We finally hired a guy who turned Burlington around. He knows how to do retailing 101. And, you know, they've probably got 2 years of just retailing 101 to do at Kohl's, and they can perform a lot better. Beyond that, they've got Sephora in the stores now, which they didn't have before. That came in right before Tom got the job, so he'll benefit from all of that. I just think Kohl's is in a better place than they've been for a long time. And they've got a guy who's really good at making the trains run on time. And the last management wasn't doing the retailing 101 stuff that it takes to make Kohl's perform.
All right, let's see here.
Right, and that's the whole
I had to
point.
overtrade it VWAP this
When
late in the
you
day.
look at some of the other
Just
names,
holding
and
on to
maybe
the
some
couple
of the
puts I have
more
left.
luxurious names, right? You have LVMH in there, Tapestry. Those are a little higher price point. Where do those stand?
Well, I'm a fan of Tapestry, and I'm a fan of them acquiring Capri. But right now, I think owning those 6 brands is better than owning 3 brands, which is what they'll have when they make this acquisition. And I also think that aspirational retail is coming back, not going away, as some people think. And then real luxury retail.
This guy called, where's he at? 10 king.
LVMH is probably the best of the group there, obviously.
Nothing.
But people are really worried that as we see this trend away from spending
That was mine.
in
Wasn't
the
even close.
things,
He had
that
10
it's going
king.
to affect the upper end, and they're
Sorry about
afraid
those
that the
years.
upper end consumer is going to be really concerned about the recession. I don't think they seem to be really concerned about it, and we know we're getting some life back in the Asian market. So I'm a big fan right now of LVMH, and I'm a fan of Kering too, though I'm more of a fan of LVMH because I think luxury is going to be strong, and I think somebody that's improving the aspirational luxury like Tapestry is has a good shot of also performing well. So I like both of those spaces.
Right, understood. So
Well,
at this point now,
done for the day.
Curious,
Just
how do you think some of the different things
looking
will
for exits
sell?
on these.
You know, you have sporting goods. That's something you were watching. Tell me about a name like Dick's Sporting Goods. And then I just would love to hear a list, you know, your top 5 of what do you think will be hot for the holidays?
Well, it's really hard for most people to like the sporting goods space right now because it was so good during COVID, and we know there's been a little bit of a struggle getting the consumer to continue buy that. However, I think they forget that Dick's is now one of the best retailers in the country, not just good at sporting goods. They're actually taking market share in spaces that used to be specialty store and department store kind of stuff because the customers said, I'm willing to wear sport
We
all
break
the
there.
time,
We
and they
might see
dramatically
it's a
improved
Tesla
their
lows.
ability to
Maybe
deliver that
flush through
product to
there.
the customer. So I'm a big fan of Dick's
But being
because I
supposed
just
to be
think
WAP
they're
again.
executing that business better than anybody has, and
Not
I
the
think they're
safest
mopping up market share.
trade.
And then I also like Academy Sports, right? Academy has been an also-ran. It's a small player in the Southwest, but Ken Hicks turned it around, and it's performing really, really well. And he set them on the course to open a whole lot of brand new stores, and I've been in 2 of the 15 or so brand new ones. And man, they
There
are
you go.
great looking stores selling a fabulous product assortment. And the more of those they open, the better the performance is going to get. So they're also mopping up share in their little part of the world. And they're also expanding their envelope a little bit. So I think both of them can be very successful in the space. And I think that space is starting to get marginally better. And as it does, those are going to be the 2 winners.
Might just get some chop here.
Yeah, understood. You know, I love talking with you because I feel like you go and you see and you check the stores and what's working and what's not working. Just quickly, what do you think is not working?
Well, clearly electronics aren't working and home goods aren't working, and they're not going to work through Christmas because the customer's satiated on that. I think what is going to work is going to be apparel, and that's not been very good recently, and it hasn't even been that good in the most recent report where sales in general were good. But I think we're going to see a real interest in apparel coming through holiday and things that go with it, and things that go with it are jewelry and shoes and handbags. So I think that part of discretionary is where you're going to see the life first, and I think we're going to see that right through holiday. And I think that's a good thing if you happen to be a department store or a specialty store like Tapestry that sells that kind of product. So my bet is on we're seeing a return to discretionary, and we see the return first in those kind of goods.
Yeah, and as you said, apparel may be back in again.
Put a trailing stop in this last one.
Heard Toys R Us
Give it some room to breathe.
Jan. I mean, I can't wait
You
to
know,
see that.
Toys R Us is all over Macy's. There's 400 of those little puppies in the Macy's stores. So are they coming back? Well, they're going to add a real assortment of interest to the Macy's store that really, hasn't really been in toys. So that'll be a great addition to both Macy's and Toys R Us.
Right. I mean, here in Manhattan, we used to have FAO Shorts and Toys R Us, 2 great fun places to go, and they've both since shut down. Jen Rogers-Niffen, great to see you. Jay Rogers-Niffen, WWE.
Queens.
Thank you so
I
much.
love
Really
seeing this
appreciate
guy's
it.
cards.
Still ahead, we'll take a closer look at the space economy. Investments have risen 17% year over year in the last quarter. So what's next? The managing partner of Space Capital joins me right after this.
Phrase, I love it. And all in, of course. Oh, here we go. Here we go. He's got jacks. I've got kings. No jacks. No jacks. No jacks. Got the kings. Got the kings. I don't want to leave this table. Got my chips back from him finally. This guy's playing loose. It's too much fun. He's gone. Out. Leave for me. That's good. He was the only good player here. Volatility, this trailing stop is probably going to get stopped on this leg. We'll see. Maybe it'll just keep flushing. A huge dive. Okay. It has nothing. I don't want to get my chips back though. Gotta call him. Someone has a 10. Yay. In 3. Knew it. Nice pair of queens. Well done. Didn't even have the 10. He called him. That's great. Fidelity broken? Probably should have stopped out by now. Well, you know, another hand he's all in. 2-9. He's like wasted, I think. Sportsmanship. Sure. Gotta put people in other people's shoes. Put yourself in other people's shoes. Or put people in other people's shoes. Uh-oh. Breaking VWAP. Broken. There's... Okay, it finally filled. Finally. Okay, I'm out. Good day today. Oh, Beyond took a reversal. Good. Down 3.8. Get this guy to go all in. It's great. I think he has an 8. Yeah, 6, 8, Jack 9. High rallying a bit here. Oh, he left. Kind of makes me want to leave. The whole reason to be at this table.
landings, the International Space Station. We're really investing in the types of space-based technologies that are powering the world's largest global industries. GPS, geospatial intelligence, satellite communications. These are all the invisible backbone that is powering the world's largest industries today. To date, most
Well,
of
thanks
the
guys for your thumbs up
investment
today.
and the value has been
45, an hour and 15 minutes to close. 18
that are
likes on the stream. I
built
appreciate
on
it.
top of this data that's coming off of orbital assets. Interestingly,
I'm done trading SPY
we've
for the
seen
day.
applications really fall off a cliff over the last couple of years through this market correction. And so we're actually seeing a lot of money going into the infrastructure now. So the thing about this sustained sort of market headwinds now, almost 2 years into this, everyone is chasing government dollars. You know, VCs used to shy away from investing into defense tech and government-funded markets. But in this type of market, government dollars are highly resilient. And so the types of companies that are going after these pots of money that have access to these government contracts that are providing essential data to enterprises and governments, they're proving to be highly resilient throughout these market cycles. And they're the ones that are getting the lion's share of capital. Infrastructure investments make up 75% of the investments year to date in the space economy.
Yeah, and how does AI come into play here? I mean, could this also, it obviously helps these companies along, but for investors, I mean, they can also think of this, at least in part, as an AI play, right?
Fish is up 1.3.
100%. I mean, so AI has captured the imagination, and it's an
RAD's down
area that
58.
every venture capital firm is looking at.
First day on OTC.
AI is nothing new to the space economy, and in fact, you know, a lot of these geospatial companies, the
GME's down
Earth
0.5%.
imaging satellites, have been generating an incredible amount of data for decades. And so they've been applying AI and ML to these data sets for a long time. They're just too big. There's just too much data for humans to get their arms around, to manage and to annotate and to derive useful insights from.
Club's
so
got there.
Leveraging AI for some time.
Drake got there.
We're starting to see that now in, you know, take the next step forward. So synthetic data has emerged as a very useful tool in training your AI algorithms.
Oh, you don't have it.
It allows you to do more with less real data. And that's really helpful in a lot of cases where
you do
real
have
data
it.
might not
Wow.
exist. Or where it's too expensive, or where there's
Slow
privacy
playing, or you
concerns, or you name it. There's a lot of reasons why
very tight.
real data might be hard to get your hands on, but you need a lot
It's
of
a pretty
data
low
to
flush,
train your
but-
AI. And so synthetic data is a key
Yeah, I bet more.
useful tool that
I
is
almost
being
went full pot on
leveraged
like
by a lot of
Plaza.
space companies
Could
that are
have
coming
something.
out with new sensors.
Runs up 2.5.
Bringing new sensors to the market. It's enabling them to have early conversations with customers to get these sensors out into the market.
What do you think about
They probably just thought he had a low
names
flush.
like, and you know, I know you can't talk specific names, so when we look at the UFO ETF, or I was looking at Virgin Galactic, I mean, they all happen to be down for the year. Are there types of space investments that investors should
there,
watch
breaking
more
out of that.
closely than others that you think may
Or
work
resistance.
better than others?
4.5.
Yeah, you know, I think space tourism captures the imagination. It's
Teledocs
fun.
up 2
You know,
1/4.
I would like to do it. A lot of people I know would like to do it. It's an interesting experience, and there is money to be made there, but I don't know how much. In terms of venture returns, we've not invested in these types of companies for the reason that I think that the market is limited. The real opportunity in the space economy is coming from the data that's coming off of orbital assets. You know, we actually make a point in our Q3 report to say, you know, the majority of dollars are going into these satellite technology stacks that we've already talked about. That makes up about 90% of the value in the space economy today. You've also got launch that makes up about 8%. And then you got what we call emerging industries, which is, you know, space stations, lunar markets, logistics, manufacturing, and the kind of fun, you know, these are very fun, interesting, sort of futuristic concepts to talk about. They make up only about 1 or 2% of the value in the space economy today. But they get a lot of attention and interest. But these are government-led markets. We know how many dollars are available and how big these markets are. It's interesting to see how much capital is going into space stations, chasing a relatively few government dollars when there's more dollars available in lunar and other areas.
Another 2 pair.
All right, Chad Anderson, thank you. Space
Gotta
Capital,
fade the
thanks for being
spade.
with us. Still ahead. So we know inflation is here. Now we want to know what our panel thinks, how to discuss the best stocks to target when you're navigating through this inflationary environment. Could names like Pepsi and Costco be good defensive plays with continuing economic
Fine, they're
weakness?
just straight.
Well, our guests explain next.
I have it. Oh no, another pair came out.
Download the Schwab Network app and
That's
join.
the worst. Didn't even see that. Getting dealt some hands. Rum is up 3.6. Let's see a break. Break this resistance. Good to see it's not bear flagging. All these are finally catching a bid. These have sold off so much. Gonna keep pushing here. Maybe I'll get some folds. I'll check this one down. Oh, straight got there. I don't think these guys have any. Maybe they do now, though. Yeah. Maybe it was bluffing, I don't know. See, this Friday's OPEX, huh? Nice breaking that channel. But we're towards the end of the day. Power hour, VWAP, chop. High
allocate
coming
capital.
down.
Let's face it. When
Oh, pretty good
capital
flush
was
there.
free, people did dumb things with it. And that's
Too
what we
low.
have to get away from. And so I think we're just reestablishing a normal process where savers are rewarded and speculators are not.
Freak on that channel actually worked that time.
Hold the thought. I know you like energy as well, names like Chevron and Devon and Williams. I want to get back here to Chris, who said he likes energy too. I mean, this seems to be the go-to. You had a real estate name in there too. Quickly, Chris, tell us what you do like.
We like Evergy. You know, they're at about $50 a share now. We think they got $71 in them. They're uniquely positioned. They've kind of gobbled up a holding company, a number of the smaller energy companies, and we think they're well positioned. They use some technology we like, and we think there's a number of others as well. But Evergy's one we look at and say, my goodness, again, not tremendously interesting. However, we like what they're doing, and winter's coming, and it's going to be a cold one, and we think Evergy's a good buy in anybody's portfolio.
Yeah, and Chris, a few seconds left. Tell me which ones you like. I'm sorry, Tim.
Sure. Like Chevron, and we like Williams, natural gas pipeline distribution. We think that, there's 800 million new people on the planet since 2014, and we are not budgeting for the tremendous increase in demands on the energy complex worldwide. So we think those are really good names going forward.
All right. Thank you both. And I'm going to give some updates on that Chesapeake news, too. Thank you both, Chris McMahon and Tim Pagliara. Thank you. Good to see you. As we're mentioning energy, I just wanted to get a quick check. As I told you throughout this hour, Chesapeake, there's been talks about the possibility of combining with Southwest Energy. And so we are seeing now that Chesapeake has turned into the red, and Southwest Energy, which was jumping on the news, the initial reports right now is trading up about 8% at this moment. Again, these are preliminary reports, and the sources are still undisclosed. So a developing story there for you. Thanks for being with me. I'm Nicole Petalides, live at the New York Stock Exchange. Keep it right here. Market on Close is next.
So I have no idea what anybody has. Also, this guy's betting, this guy's not betting. He's re-raising. And full house. Yeah, did nothing. A higher full house. Yeah, I guess so. I was just looking at this trade. I wasn't even thinking about those pairs and stuff out there. I think two people had full house. This guy's was higher. Interesting. I could get another straight flush here. Oh. Oh my gosh. Do it. You just lost your flush. And we've all got flushes. Now, how does it work? Would, I guess, king high flush work win here? Whoever has the highest? That's me. That is neat. I think 9 would take it down, but okay. That's right, like, I'm a little confused. Because there was an ace out there. So it's not, it's whoever has the highest in their hand then. Not counting what's out here. Man. Support. Remember this stock? This one had the spin-off, right? What's going on with it today? Is it still trading? Over. Over, man. Does that show up on the SRP? Ah, I see. I see. It's on there. Now
this retail print. So on the margin, there is an increase in the odds that the Fed's going to have to hike, but it hasn't sent the yield curve inverting back again. Technically, we're still inverted on the 10s to 2s, but we got real close to flat, basically. And so now the market's having a little bit more trouble trying to figure out if this is going to change the calculus for the Fed. Look at the dollar, and you get a similar message there. The greenback actually was lower throughout much of today. It was pretty quick to fade from an early bid after retail sales. And if we think about the dollar as another indication of the central bank's path, you can see that the market is fairly undecided still. We're at 106. It's kind of the range that we've been in. So the dollar's been chopping back and forth. It seems like we do have the door open to the possibility that if we get a few more data points, maybe the Fed will be forced to do something by the end of the year. But over the last 10 days, too, the dollar was under enough pressure to where we are still below the year-to-date highs of the greenback. And so more evidence here that even though the data are quite compelling on the economy, the Fed looks still pretty committed to try and stand pat and not hike. We do have Powell later on this week, so keep your ear to the ground to see if any of his tone changes. But so far, the Fed speakers have been pretty much locked together in their message about what they're going to do. And so the market's seemingly able to find some silver lining throughout this big bond sell-off, that it's rooted in good economic data and not a forced hike by the Fed. So there's your silver lining on the day. But there's a little bit more actually to it as well. And that is a little earnings related and some financial fundamentals connected with sentiment in the market. The regional banks are up 2% today.
And why have the airlines gotten wrecked? Oil prices?
We've had different degrees and different styles of rate sensitivity this year compared to last year. Last year was very clear. Rates go up, Tech leads us down. Growth
These
stocks
airlines are
lead
looking
us
pretty
down.
pretty good.
Since the regional bank scare and the financial scare earlier this year, we've seen a lot of moments of sensitivity where the financials are punished on days where yields are higher, but we're not getting that right now. And crucially, we're not getting it during a period of earnings too, where we just got numbers from the banks. So you can definitely find, I think, a positive tone there as well, creeping through the market today. Despite this big bond crash, the regional banks are actually getting some firming in the market and finding some buyers, which is pretty encouraging.
Crazy. We're this below
Now,
COVID
big problem
lows.
for bulls generally, probably as big of a problem, if not bigger, than what's happening in bonds. One could argue the NVIDIA sell-off today, which is the biggest of the year, at one point today down more than 6%, definitely puts us on alert for the chips. The chip maker SMH ETF we're looking at here has put in now a lower high. Now, the fall slippage was not terribly deeper than the summer sell-off, but it's still technically put in a lower low in the last couple months too. So now you've got lower highs and lower lows on the chips. NVIDIA's leadership and its stalwart behavior keeping this group, this integral group to the tech trade afloat, might be breaking down a bit as the U.S.-China hostilities on trade, specifically focused on chips, continue with an outright restriction of AI material from companies like NVIDIA. So it certainly is a dual-pronged pressure on the market today, not just bonds, but off too.
Gotta have a
Kevin
5.
Hincks and Renita Young.
Yeah.
Kevin,
King
what
Jack,
do you think is
had
the
nothing.
main driver of the session here? Because even though retail sales sent bonds
I should have put them all in
this morning, the market did bounce back, but NVIDIA never bounced back all the way.
Well, NVIDIA's got its own microeconomic story, Oliver, right? But the rest of the market, you're right, made a valiant attempt at a comeback here, and it was green for a significant part of the day, led by, of all things, the Russell 2000 and regional banks. Regional banks are a strong part of the Russell today, but it's pretty widespread across the Russell, having a really good day. Now, why is that? Well, you can make the case that the U.S. economic data is pretty strong. And you know the Russell's made up of 2,000 U.S.-based smaller companies. So maybe it's the fact that the U.S. economy is doing better than expected or hanging in there pretty strong. Maybe that's why you saw a little bit of recovery in the Russell 2000. It's hard to say, but this recovery is not without notice, especially when you see the other three indices not able to hang in there. They got up, they got all positive on the day. I think when I see a day like this, what really sticks out at me is October chop. The choppiness of October continues, Oliver. Sometimes rallies are for selling and sell-offs are for buying, and that's what we'll see where we end up at the end of the month. But really volatile trade today. Not surprising that the VIX is working its way higher here on some of these numbers. That being said, if you break it down to NVIDIA, you know, we're based in Chicago. I've spent my whole life in Chicago. There's a common joke out there.
They have an alert for the Theta Farm members on YouTube.
Michael Jordan to 15 points a game.
Opened up a trade. Bouncing back up to VWAP.
The only thing that can hold NVIDIA down is the U.S. government, right? Because they'll sell chips to anybody, but the U.S. government is coming in and saying, putting on harsh restrictions on them selling AI chips to China. So that is what's weighing on. Remember, China is a significant part of a lot of U.S. multinationals. So that demand from them is a significant part of their business. You see the effect when these restrictions come in. NVIDIA extremely weak today, Oliver.
I like that. And wow, a fresh new Hinksism to add into our lexicon. The only thing that can keep Jordan under 15 points is his high school coach. The only thing that can keep NVIDIA under pressure is the government. Okay, I like it. There we go. A little Chicago spin. Okay, good analysis. Renita, the other thing that's noteworthy today, I think, is that the actual bastion of the market throughout the day has been financials, specifically regional banks, small cap businesses, and outside of the giant money center stalwarts. Bank of America's been doing well too, but that whole group seems to be getting a nice bid, and I do think that's worth talking about.
I do too. The Bank of New York Mellon in particular posted earnings today that were better than expected. Now, of course, they focus on investments, and so naturally, the higher interest rates benefited the business during this quarter. Adjusted earnings came in at $1.27. That was non-GAAP EPS, beating the estimates, and revenue grew about 2% year over year to $4.37 billion. That beat expectations by around $60 million. Net interest revenue is the big part. It increased about 10% year over year, but fee revenue was flat. Now, provision for credit losses was at about $3 million versus a benefit of about $30 million a year ago. And the investment and wealth management unit had $1.8 trillion in assets under management. That increased around 3% year over year. And that was, of course, thanks to the impact,
back up to
favorable
VWAP.
impact of a weaker U.S. dollar during the quarter and higher market values, and also of the company selling off its European credit and private debt manager business to Franklin Templeton Investments. And just as you said, Bank of America still going pretty strong today. Earnings revenue beat expectations. Of course, it benefited from higher interest rates, but we saw the company said that
Right, so now another one for the Data Farm members.
This one did not benefit as much from higher interest rates when it comes to its own investments in Bank of America, because it was one of the banks that took on longer dated treasuries and mortgage bonds during the pandemic, and has, since the Fed has been raising rates, it's lost some of the value of those assets. So that there, a little bit of a mixed picture, but investors are still focusing on the positive earnings and revenue results from Bank of America.
Yeah, one of the leaders on the day too, and one of maybe the big leaders so far for the earnings this season is JP Morgan rallied, faded, and isn't really catching much of a bid. So interesting that investors are looking to buy the dips on some of the banks instead of those that have been leading. Definitely helping the Russell in a big way today. Like every financial in the small cap world is up. So good eyes on a few of the reports that we might have overlooked there in the case of BNY Mellon. Thanks, Renita. Thanks, Kevin Hanks. Appreciate it, guys. Let's have the macro convo with Zed Francis of Convexitons joining me here in studio. Zed, as you left a month ago, you like whispered in my ear and you said, next month when I come back, yields are going to be at 5%. I wish you said the quiet part out loud.
Well, I'm more excited to be here after you penned a note saying that government debt doesn't matter. Why do people keep caring about it?
I said people shouldn't panic because it's like worrying about the sun burning out. I know you had some qualms with my view. The reason why I wrote that is because people I hear in the last month, really ramping up the deficit talk again. And I feel like that is just an effect of an election, a little more than a year out, as opposed to like any imminent problem. What do you think?
Yeah, well, I mean, there's different levels of it, right? I think the speak that you're referring to are folks that are talking about potential default, which is, that's not the risk that we're talking about here. In my
like dollar collapse too.
Right,
There's a whole, and I mean, the community that used to be just like crazy gold bugs, like, and then some Bitcoiners. I feel that community expanding now to like a lot of kind of mainstream commentary. And to me, it just doesn't resonate when we've got the dollar doing so well.
Yeah, I mean, the point is there's 100 meaningful steps before you get to that, potential horrible outcome that is very, very unlikely.
Build-A-Bear's an amazing stock.
Soon, or potentially.
Right, but it will happen eventually, like the sun will burn out, right?
Maybe, we'll see. But what I think is more interesting is, as you say, over the last week, we've got a lot of hot data. Data in the near term is more meaningful for the front end of the curve. Your spot rates, twos, and as you said, like the flattening of the curve is kind of, stalled because we're starting to see that.
But kind of reversed.
Right, exactly. But what's more meaningful ultimately is the long end of the curve, 10s, 30s, and there's two important factors. There's one, potentially shift in term premium. We were just talking about before, essentially there's a long period of time where you're getting paid less negative term premium because the duration was viewed as an attractive thing within a portfolio. Thus, you were receiving less essentially total return to accept that duration.
Yeah.
We're potentially going the other way. Okay, duration is now risk. You should be paying me to accept additional risk.
You hear me now? I've gone very long here. Very short time to get the goods.
Supply and demand.
This is where it's sketchy in the day near VWAP.
Has, especially like
the complete
30 years,
gamble.
There's not a lot of natural buyers for that type of paper. I mean, who wants to own things for 30 years? That's a very limited set of folks. And essentially, it's central banks themselves, which we kind of know where they're going, at least at this moment with their holdings of treasuries. There's insurance companies. They did a significant amount of the rebalancing previously. We've been at these ish levels, and we're talking range of 1+% for a while. So they've done a lot of the recycling of their portfolios. You have pensions. Again, they've done a significant amount of de-risking. Most corporate pensions have been over 100% funded for almost a year now. So they've done a lot of their de-risking, selling equities, buying treasuries and credit. That's happened. That's one time. Like, they do it once, they're done. Like, their plans and remuneration. And then you have sovereigns, and sovereigns are kind of interesting. They're probably looking more and more like the Fed on kind of the auto sell button here. And that's simply because they care about the total return of their portfolio in their currency, not in your currency, so they hedge that risk. And currency volatility, as you say, like, I'm not saying any specific currency is blowing up, but the relative value of currency has been moving a heck of a lot, meaning the ability to hedge that risk is expensive. So the concept of some foreign investor buying US treasuries, but then they have to swap that back out into their local currency, swapping it back out of the local currency is expensive. So sure, headline yields look really great, in the US relative to other countries, but once you bring it back, once you hedge the currency risk back to your local, it doesn't look so great. And so those folks have been on a little bit of an auto drip out of treasuries as well. So
which you talked to us about, namely like Japanese investors in particular that have maybe had the most dramatic kind of shift in that approach?
Japanese investors definitely most, because they're more meaningful because they hold a lot of US treasuries, but also their currency has become very volatile in comparison to a lot of others. So they're a big one. Chinese are a little bit different. Chinese are less so holders of treasuries from an investment standpoint and more of like a treasury of a corporate. And what I mean by that is for a long period of time, we had significant deficits, meaning they were getting dumped a lot of dollars on them. And like any treasury, you don't sit in cash, you deploy that capital, and a natural means of deploying the capital in a low risk way was buy treasuries. And guess what? A lot of the actions we've taken to move things more onshore means the deficit is shifting and they're not getting dumped all these dollars upon them. Thus, there's less need for them operating that kind of treasury function of recycling those dollars like any corporation would. So a little different than risk related to Japanese, but holistically it's obviously we know the Fed is leaking out treasuries. Foreigners are starting to kind of leak out treasuries mainly due to currency hedging risk. And then the locals, the insurance and pensions that would buy long end type of maturities, they've kind of already done it. They're like, so where's the next buyer coming from? All in a period when the amount of issuance is explosive. Like it's, forget like big numbers, sure 100 years ago GDP was smaller and all this kind of stuff, but we have 10 trillion that needs to be minimum, that needs to be issued. This is not, assuming deficits go crazy, 10 trillion in the next 18 months that needs to be issued. Now, a lot of that is just going to go into bills. Everybody looks at money markets. Like, hey, that's decent. We can just recycle that. That can get placed
when
naturally.
You're asking about who's buying, maybe not for the 30-year, but there's some pretty strong interest in anything maybe 10 or closer right now. Well, I guess it depends. If stocks go up, then it's like, all right, why do I need to lock in 5%? But if they don't, then suddenly, if people imagine that kind of world of lost stock returns, maybe your everyday person is more interested in 5%.
Yeah, possibly, but again, they're going to be on the front end, most likely. So there's ways to potentially
generate, should be, right?
Yeah, generate demand in the shorter end. Longer end probably is going to be consistently problematic to issue out the curve. And why that's important, again, this isn't like credit risk, U.S. in default, dollar, exploding. Like, this is just supply in a place where supply is not going to be easily digested. So that is the government, the Treasury, introducing volatility events into the market. And about 6 weeks ago, we had a Treasury auction that caused a little bit of angst. Last Thursday,
definitely.
Had a Treasury
6 weeks ago, which one caught your eye?
It was kind of just the first one where they actually went out the curve, and we only tailed like 1.5 basis points. It was a tail.
Because up until last week, I've been kind of characterizing it as the auctions have gone pretty smoothly compared to 2022, we had a couple big scares there.
Agreed, but I mean, last Thursday was the biggest tail in 2 years, like 3.5 basis points, like material, and that's why it shifted intraday, high to low, almost 2% in the S&P 500.
Yeah, that's that put that we caught.
If we have to issue this much, we're gonna, and the Treasury's basically doing it, every day the market's open.
Right.
This is a lot of potential volatility events being driven by the Treasury.
They don't need a particular catalyst. That's the term premium element. And by the way, for folks that you're a very smart guy, sometimes your ideas seem like, okay, they're big. How do I wrap my head around them? This is why people have to listen, because you told us about the term premium expansion way before we heard, who was it, Mester talk about it the other day? Nick Timmeros wrote about it very specifically. I mean, you outlined this for us months ago. I think maybe like even earlier than that, like late first quarter, that was going to be the best explanation. Now everybody's kind of searched for this term premium explanation, which I think you've done a good job of explaining here, where that demand is lessening. However, again, I like to sometimes be a simpleton to kind of play the devil's advocate, if you will. If I look at the chart of the Economic Surprise Index, it looks almost exactly like the 10-year right now. Yes, we've had a couple of auctions.
There's your exit guts right there.
Or just the market recalibrating this super apocalyptic economic view. Where does that fall short of explaining it?
Yeah, I mean, you need a strong economy to continue to support higher rates to some extent, unless supply and demand gets really, really out of balance.
So then I guess the question is, when will we know if that's happening? If like the dollar starts crashing too while yields are going up?
Yeah, I mean, I think these auctions are definitely a good, early stage indicator. Nobody shows up. They're going to issue new securities, and nobody showed up to take them down, so they had to pay significant suggestions to actually get it digested within the market. So I think that's a good early stage indicator. And again, I think what's more interesting and more important is we care about the debt in theory every time we run into a debt ceiling event or a budget event, but those are a once, maybe twice a year type of events that are well forecasted. We know the date, so it doesn't have major market impacts, because most people have the assumption, we'll get it figured out.
Yeah.
The Treasury is coming to market essentially every day. So it means every day there's a potential catalyst driven by the government essentially having issues, generating enough demand for their debt. And so that's just a total shift of the potential underlying risks in the market every single day, because it's not a specific event. It's not driven by Congress. This is they need money, and it's a potential catalyst.
It sounds like in the short term, we keep selling bonds basically, or at least being short bonds, aware of the risk like you've told us to be. Just real fast, we don't have much time, but like for stocks, for hedging wise, I mean, equities haven't cared too much yet.
Yeah, no, it's very interesting because, just using maybe the MOVE index as a barometer for rates, that's been high for a year and a half and is remaining so. Equities, very boring. Credits, sniffing a little wider, but nothing of interest. So we kind of have, in terms of like a cap structure of the U.S., the reverse thing kind of happening. Like in theory, the least volatile thing should be treasuries, then credit in the middle, then equities, the most volatile thing. And we kind of have the inverse going on here, which kind of is what happens before significant events in terms of major corrections and such. Where the stress point is in that cap structure is what moves first, and everything else doesn't really talk to it until it needs to.
Fascinating. Love the way you phrase that. Inversion of the sovereign cap structure, basically. Or if I go like hyper, like super mega West Coast bull here, is that Apple's just a better safety and more reliable than the U.S. government. I don't know. I'm just saying. Thank you, Zed Francis. Great convo.
Thanks, Oliver.
Appreciate it. Good stuff. Zed Francis, Convexitons. All right, mixing in some of the big macro discussion. And we're going to continue talking some rates and how it applies to one sector that's traditionally thought of as being extremely rate sensitive. We're going to take a dive into REITs in a moment. Stocks are still hanging in there. The Russell, solid. And the big cap tech trade is now mixed with some green in there, too. Dollars down while bonds are getting shredded. It is definitely the story of the day. The 10-year popping back to 5% almost. Stocks still mixed. Russell's up, but the Nasdaq's having a little trouble. S&P's drifting back a little lower here. Bitcoin turned positive after starting off on the wrong foot and still has a little lingering ETF news around it. Bob Iacchino, founder and chief strategist of Path Trading Partners, here to chat with us about some of the other asset classes. Bob, okay, so all the Bitcoin fun from yesterday, what'd you make of that?
Lingering ETF news. I like that.
It's always lingering, perma-lingering.
Yeah, it was interesting. You could make a sort of a joke.
Yeah, trading last hour with dailies is gnarly.
Gary Gensler was behind.
Especially if you're already around VWAP. I mean, it's just super choppy and pretty much
still have unreasonable
it's just total gambling.
Driven by a fake tweet. Of course, I'm joking. I don't think Gary.
If it's like after a huge rally end of day and you're way high from VWAP, then you can maybe trade it to the downside to VWAP or to the upside to VWAP. You're way below it. But once you're already here, it's just choppy.
I don't know which one will be first, whether it's BlackRock.
Yeah, AMC's coming down a little bit. It's up 4% still.
Or ARK Investments ETF, one of those.
GME down almost 2.
And I suspect it'll be a little bit of a waterfall of spot Bitcoin ETFs after that. But the interesting part about it to me is the price action that we saw. Yes, there was a big pump and dump, but it didn't really dump as far as you would have expected it to. When you look at that spike, it jumped over, I think it was right over 30,000 on that spike high, but then it came down and kind of held in at higher levels than it was at before. Also, the volume was huge, and a good portion of that volume was buy and hold volume. So when you look at it from that perspective, I think people realize the inevitability of the spot Bitcoin ETF and how it's likely to drive new capital and not hodl capital, but actual buy and hold, like the adults say it. The buy and hold capital will be going into Bitcoin once there's ETFs. And then it's just going to be a matter of the
buy and hold, like the adults say. I love it.
Structure of the ETFs.
You think that'll happen?
Which one's a better fit for a portfolio?
I do. There's people waiting on the sidelines, Bob. Family office managers, investment advisors, waiting for that ETF to finally get exposure.
There is a lot of money, and I mean billions and billions of dollars that would like to get involved in this but can't, whether it be because of their charter, their risk management structure, whatever it is. And the ETF cures all of that. Now, I'm not saying that they're going to put 50% of their assets in Bitcoin. I actually think it'll be more like 5 or 10. But those are still hundreds of millions of dollars, if not billions of dollars, and then go into there and say, okay, we've got you covered. You're in Bitcoin now in case this becomes the thing.
Also, like that number, Bob? Those are big numbers. You got some big numbers
those
there.
Those are really big numbers. And also, Larry Fink called it a flight to quality asset, and I think that's wrong.
That's definitely wrong so far.
You coined the term high beta flight to safety, and that's what it is to me, and it still is. It's flight to safety, not quality. It's more a return of your capital than a return on your capital asset at this point.
That also, I mean, maybe we shouldn't go too far down the conspiracy road highway here, but yeah,
let's go.
The Fink comments continuing. I mean, I don't know. If I'm a guy who's got a big suite of ETFs that are largely index-based, I look at stock valuations and I see that the math tells me there's potentially a lost decade ahead of stock returns. I think I'd probably be pretty excited about Bitcoin ETFs too. Am I the conspiracy theorist for thinking that?
Not at all. Look at the rate
structure. There's a lot of fees.
Right now. Look at the rate structure right now. I mean, we had, after that May Fed meeting, we had the first rate cut, according to the CME Fed Watch tool, priced into December. At one point, it was priced into next month, the cut. Now it goes all the way out to July of next year, and it just keeps getting pushed and keeps getting pushed. So if you're going to have, and a lot of people think a 5% 10-year is coming, the 10-year note is special because it covers the entire business cycle one way or the other. Right, every time there's a new 10-year issuance, you're covering another major business cycle with that 10-year interest rate. So if you're going to be looking at stocks versus a 5% 10-year, we have the 10-year get to the highest level in what? Since 2006 today?
Mm-hmm.
And
all right, I forgot to review my trades for you guys.
With a 5%
myself.
risk-free rate, I need product.
Could have improved.
I need other kinds of product that could potentially outperform stocks. So
could have improved. Let's check it out and see how I could have. Good day for trading though. All these days have been pretty good for days for trading. It's this increased volatility we're seeing. Nice big intraday moves. Yeah, look at this. That's crazy. Crazy, crazy, crazy. So I did delete some of the channels just to be clean. I don't like the mess. Well, it won't all be here at this point, but some of it at least. Okay, so a little overtrading today. Okay. Start off 9:45 calls. No, sorry, puts. 5 puts at 9:45. These are tomorrow's options. Buying tomorrow at the money. Right there, so was I. Yeah, it's getting a little scalpy this morning. Five puts here. Closed one for a profit at 9:48. So here. Closed two for a small loss at 9:49. Yeah, I started chopping, then I just wanted to get out of it. Then two more for a profit at 9:50 here. And I was out of that one. So I don't even know if I was down or up, maybe pretty even. Then I bought 5 puts at 10:04. Right here, bought 5 puts. Top this channel. I was trying to just grab the top. Of course, to break the channel, I wanted to get calls, but we hadn't broken the channel. We were starting to reject, so I got puts. This is where a faster brokerage would definitely have served me better. Once we broke the channel at 10:06. Here I closed those out, and then 10:07, it wasn't until 10:07 I was able to get calls, so really late to the calls, but had them on this candle somewhere, I think right around here. Bought 5 calls at the money tomorrow's. Those are 434 calls. Sold 1 at 10:07, so sold 1 pretty much right away. Yeah, probably on VWAP. This is a big candle, so maybe high of the day I sold 1. Yeah. And then put stops on them for break even. And then sold 1 at 10:15. Oh, right up here, and we started consolidating. Sold 1 at 10:30. I missed that little spike right there. Little head and shoulders, but it ended up moving out. And then bought puts. 10:35, bought 10 puts. So somewhere around here. I don't remember doing that. That's weird. And next minute, closed those all out. It broke up. Then this is where I kind of overtrade a little bit. 10:36, bought calls as we're breaking. Kind of the same thing down here. But I shouldn't have got those puts there. I should have, yeah. Waiting for the calls was the right play. So anyways, got 10 calls there, 10:36. And then sold 1 for a profit also at 10:36. So somewhere on this candle, bought, sold. Sold 3 more for a profit at 10:37. This candle. Sold 3 more for a profit at 10:38 right here. And sold 1 at 10:39. Sold 3 at 10:41 here. I was out of them by then. Maybe I had a couple left. I'm not sure. No, I think I was out of it. And this is where this is where my position size was wrong. With the 10 calls here, that was too big for after this move. I mean, maybe it wasn't, but the setup wasn't good enough to increase my position sizing. this setup was good enough to have a bigger position. I only had 5. This could have been 10, 15, 20, 30 something. A larger amount. After it's done it, we're starting to slow down. You start sizing down. And I went bigger because I was trying to, I don't know, it was greedy. It was dumb. So, yeah. Flip-flopping on the position sizing would have made sense. Anyways, and then here I actually was even more, got more, the larger position sizing, which is, I shouldn't have done. So, but my position size today was a little bit off. 10-4, so it was on a break. I think I moved this channel, but it was on this break. Got 15 more for the bullish side calls. And then it was false, and then came down. And then at 10:55, I averaged into it and bought 15 more right here on this candle. Then I had 30, which, yeah, if I held them long enough, those would have been amazing. I didn't hold them long enough. I sold 5 at 11:05. Right here. Little false break. Sold 5 more at 11:06. I was actually trying to position down here. So this was, I'm happy with how I did this because at this point I was underwater on it. Came down, it gave me a chance to average in, and I still thought this could be bulls building liquidity. So I did end up average again. However, I didn't want that big of a size. So once it came up and gave me a little bit of profit, I started closing some. Even if it was going to keep going, I want to just reduce my sizing in case it didn't. So that's where I was closing those up there for a small profit. And then closed 5 at 11:15. So right here. Yeah, I guess I did have these for a good portion of the move. Closed 5 more at 11:18. Oh, this was the problem. This was the taper got me. That's right. Okay. So 11:18, closed 5 more, which was fine. Taking profits. Then closed 5 more at 11:23. This was the problem. So I saw that we were starting to taper, starting to roll over on the top. Our aggressive trend upwards was starting to slow. And so I started considering this was probably the top, or going to be close, or at least this was going to be the top. So I sold off a lot of calls that could have held longer. Yeah, 11:23, sold 5 more. Sold 1 at 11:24. This was still a good trade though. I mean, I made decent on it. It was just too large of a position sizing, and it wasn't patient enough to enter. Need to let it build more liquidity, more confirmation of the move. 11:26, sold 1 more. And this is somewhat unusual, but it does happen. We had this new tapering channel, and then it breaks out to the upside of it. So I left some for the homies, I think, maybe. Yeah, I left 2 for the homies. Trailing stop on 2 of these. It closed at 11:28. Yeah, right on this candle somewhere in here. Those 2 closed. Oh, I guess I had some left. So I had those 2, and then I had 1 manual one left for the homies. It wasn't a trailing stop. It closed at 11:33. But when it retested the top of this, I'm like, okay, there it is. And then boom, it broke it. So got a couple exits higher, I guess. There's still more to be had, but it was definitely starting to roll over then. And then I think I did a little bit of... No, I think I traded better up here. Let's see. Yeah, buy puts. Yeah, I started buying puts at 11:34. Oh yeah, I was early on it because I thought it was tapering. So right here I flipped from calls to puts. Yeah, that was the problem. That was my issue. And then it broke out of there. I'm like, oh boy. And I thought about just closing out if it broke. Sometimes you get a little false break. I decided not to, which of course it worked out in the end, but maybe I should have closed out there. Just had a hard stop right on the break of that, but I didn't. Anyways, bought 5 puts there. Bought 10 more at 12:02. So right here, that was actually a nice little grab. So then I had a pretty good amount. Oh, that was me trying to average into it. That's why that kind of worked. I was trying to just average into it to get out of them in case we kept rallying, not necessarily to get a big position to call a reversal. So average into it, And then 1209, I sold 5, which I think these were for profit. Yeah, these were for profit. So sold 5 there. And then sold 5 more. And then I had a smaller sizing at least. But then I was thinking, wait, this actually is starting to taper and roll over, I think. I could kind of start to tell. Let's see what time it is. 1218. 1218, I bought 5 more. Yeah, so I was starting to buy more. Right here. Bought 5 more. We didn't continue to make that same high right here. Bought 5 more there. But then closed those. Yeah, when we broke out, that's right. Yeah, overtrade up here a little bit. So at the break of this channel, I closed those all out. Closed out all 10 of them. Which of course, hindsight, I could have left them, but I wasn't down too much on them, and I wanted to wait for more confirmation. So close those out there, those puts. Because at this point, I thought maybe just pulling back more liquidity and we're going to rip back up and retest those new highs. There wasn't real confirmation of a lesser high here. There was here, but yeah. So anyways, close those out there. And then bought 5 puts. Let's see, this puts, yeah, bought 5 puts at 1231 right here. Wow, top tick that one perfectly. So that's when I drew this channel, which is actually very, very helpful. I was seeing this, and then it was like here. Then I'm seeing this kind of the support here. So I'm drawing my support on the bottom since the top hadn't confirmed anything yet. And then I just grabbed the top wick, the top candle there. And then it just so happened that that was this new channel that it was trading in. Because then once it got there, it started rejecting. So that's when I bought puts again. Then I saw, okay, it is tapering again. Maybe this one will hold. So 5 puts there at 1231. Closed one at 1243. So I was just kind of starter position, just getting started. I kind of assumed we'd get another rally, maybe not a rally, but another bounce, maybe up to this other shoulder. I was kind of hoping for that to reload, but it didn't really happen. So my position sizing up here was smaller than I wanted it to be. 1243, sold 1. Trying to very slowly sell them because I'm like, I need more. And then, okay, yeah, so then I didn't sell any more, and I bought 10 more at 1257. We did get a bit of a bounce here. Yeah, so right here I bought 10 more. But rejected it getting back into that range, rejected this support. And kind of made a right shoulder here, this left shoulder. So it could have kept coming up, and I would have probably kept averaging in at that point. But yeah, I bought 10 more there. But it didn't. It just went down from there. So that was a nice grab also. And 1059, sold 4. But by this point, I was pretty green on the day. And the rest was just kind of making me more green, I guess. Yeah, the rest of it was just easy street. The stress was kind of over. It got stressful up in here a bit. I had the big positioning to the upside, actually right down here. Big position to the upside. And it was just doing this. So that's why I was pretty eager to close that. Closed it. And then the puts I started getting to here. Got a little stressful, but I managed RX. I averaged in at a real high. And then I closed it out when it broke in case it was doing it again. So once, like this point in the day when I was averaging into puts and looked like it was actually reversing. But at this point, if you remember, I was anticipating it potentially this just being bulls building liquidity and us catching one of these channels, even down here, this one or this one, to go rally back up. So I was ready. That's why I was averaging into puts heavy. I was ready to close them out. I was closing some on the bottom of each of these channels in case it was just going to keep rallying back up. Yeah, so sold 2 of those at 102. So at this point I had like 15, 20. 102. Yeah, 102. So I was a little late on the bounce there, but sold 2 there. Sold 2 more at 119. Right here. So I thought it might be trying to grab this channel. Wasn't sure. It was below it, but within reason. Sold one at 141. Yeah, then it pretty much confirmed it. Oh yeah, this was a VWAP. Wait, is that 141? Yeah, so VWAP. There's 141, sold one. Sold one at 150. I'm gonna go slow about selling them, but then bought 6. I wasn't planning on actually buying back in, but I'm like, if it breaks here, we could actually have a lot more downside. Bought 6 at 152. Around the break of this VWAP. Bought 6. Sold 2 at 153. Sold 1 at 154. Sold 1 at 156. Sold 1 at 2. Right here. Sold 1 at 207. Here. Then sold 1 at 218. Yeah, it's right there, and then sold another one at 218. One at 233. Right here. And then a trailing stop on the last one that closed out at 234. So being close to VWAP towards the end of the day, it's not going to be easy to trade through here. It's going to be hard to read what's going on. Market's trying to find safety. I set up for tomorrow, so and I was done. So yeah, good day. My position sizing today was a little bit funky on this first initial trade. It's just in the morning I'm careful not to position too large, because you can just sometimes chop, and so a lot of times it's just 5 contracts but this had built enough of a channel that was a big enough break that it could have gone larger there. And then up here my positioning was too large with such little liquidity that was built. So on this break I could have had a larger amount, but I got it back here on a fake break that not much had happened, and that was too big. If I'd waited for this one, it could have gone larger. Then on the put side, well, it did this, so I could have closed out on the puts after it broke that tapering range, but I was fine holding it. But I did end up closing it out up here, so I guess I should have closed it back here. And then adding into it, my initial position, though it didn't really get much of a bounce after. That's why I would have had like 25 or 30 puts up here at one of these points, but I was just kind of anticipating a little bit more of a bounce, but it didn't. It just kind of melted down the whole time. Never really had like a proper bull trap. It just kind of like went down here and then like a little bounce, but then the rest of the time was just like pretty much melting, and then broke out of that channel and just melted. So I guess I added pretty heavy right here, which was my only opportunity. So then a little add there on that one, but yeah. Well, I was planning on taking it early, and then I remembered, I should review the trades, and now here we are. It's after the market's over. Thanks guys, thanks for your support. OSTK, is there news? Maybe it's GME news or barbecue news. 3.5. I don't know. Market kind of coming down too. Thanks, Guts. Take some GME to Yum Yum Tendy time. Thanks, Jay. Thanks, guys. Appreciate it. Thanks, Thank You Up. Thanks, guys, for the support. See you on Discord. We'll see you tomorrow. Have a good afternoon. Thank you for your 19 likes. Well done. Thanks, Psych You Up. Good day to you guys. See you this evening.